everybody to be seated. We'll start in a minute or so. Kindly take your seats. Good morning, ladies and gentlemen. It is my privilege to welcome you to the third annual joint conference on macroeconomics, banking, and finance organized by NSE and IIMK-NSE. This year's theme, Information Asymmetry in the Information Age, Markets, Economy, and People, is both timely and profound in the era of data abundance, artificial intelligence, and digital public infrastructure. We are delighted and privileged to have distinguished dignitaries, experts, and scholars join us today to explore this topic in greater detail. Before we start today's conference, I request everybody to stand for the national anthem.
जनगण मन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जनगण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
Thank you. We would now have the lamp lighting ceremony. May I request our esteemed dignitaries to kindly come on stage to light the ceremonial lamp. Shri Ashish Kumar Chauhan, MD and CEO. Shri Amirjit Singh, whole-time member, SEBI. Shri Ankit Sharma, Chief Regulatory Officer, Listing and Investor Compliance, NSE. Shri Dinesh Kharaji, former Chairman of SBI. Dr. Mridul Sagar, Professor of Practice at IIM Kozhikode, and Dr. Tirthankar Patnaik, Chief Economist, NSE.
वक्रतुण्डमहाकाय सूर्यकोटिसमप्रभ निर्विघ्नं कुरु मे देव सर्वकार्येषु सर्वदा
Thank you. I now request Dr. Mridul Sagar to give a brief introduction about the conference.
Thank you, Ashiana. It's a great privilege to meet all of you in this venue. First, let me take this occasion to thank the National Stock Exchange, and especially Mr. Ashish Chauhan and Tirthankar Patnaik and his team for setting up this tradition. This is the third annual conference we are doing. I know Mr. Dinesh Khara was there in the first, and we set a very high standards right from the first conference, where Mr. Anant Nageshwaran was there, he was there, and stuff. So many galaxy of speakers. In fact, Kamath had a very profound statements in the end. That was a conference on global spillovers, and there was a lot of threadbare discussions at that conference, and we set up a tradition to have discussions which are frank, meaningful, purposive. we avoid platitudes and gratitudes just to save the time, because practically everyone who is speaking here is among who is who, and everybody knows them. In essence, the spirit of the conference is to discuss very substantive issues with a very frankness, but avoid any political overtones unless you want to discuss political economy constraints and stuff like that. And basically, that tradition has been maintained. We had a second conference in which RBI Deputy Governor Rajeshwar Rao was there, and later on Governor Subbarao was there. We have a lot of technical sessions. In the first, we had the bond index inclusion from the JP Morgan team. In the second, we discussed how AI, ML and things would change. We had technical officers, the heads of Google DeepMind and Microsoft address that. So this is, the second conference was on finance for growth. And now we are off to the third conference with an equally interesting theme of this is an information age. You all know this is an information age, and yet we have information asymmetries in financial markets, and we need to discuss how we can bridge that using the information age. So that was the theme. It sounds a bit like a Condranum word, like a Janus word, because you have information age and you have information asymmetry. The two tend to be little opposite to each other. And yet this is a reality which exists in the markets. So that is why we chose this theme. It has a number of panels with very diverse themes, as you would have seen from the program. And I don't want to take much time because we have a lot of things which are to follow. Our director, Debashish Chatterjee, unfortunately has a health problem and he couldn't make it. And basically, but he has wished the conference all success. And he has actually noted that there is a transformational change being made in finance, and it is essential to harness information to develop investment culture across for even those who are not so privileged and stuff. So thank you all the speakers, including those who are here and those who would be coming, for having readily agreed to come to this conference. And we have a packed audience which shows the interest which exists. There are spillover rooms which are also being used. So thank you all for being here. Over to you, Ashiana. Then maybe we'll request the NSE, Mr. Ashish Chauhan. Come.
Thank you, sir. We will now move on to the inaugural session. I request Shri Ashish Kumar Chauhan and Shri Amarjeet Singh to please come on stage. I also request Shri Ashish Kumar Chauhan to deliver his welcome address and start the inaugural session.
Shri Amarjeet Singh, full-time member SEBI, Dr. Mridul, IIMK-NSE, Shri Khara, former chairman, State Bank of India, other colleagues, distinguished speakers, delegates, students, and friends. Good morning to all of you, and a very warm welcome to IIMK-NSE third annual conference on the macroeconomics, banking, and finance being organized jointly with URUPPIKA, IIMK-NSE's Center for Excellence in Macroeconomics, Banking, and Finance. For many of you, this may be a return visit to the NSE, and for some, it may be your first visit. It's a privilege to host all of you here at the Exchange. The topic is about information asymmetry, information age, markets, economy, and people. These are like different words. But ultimately, it refers to people. And it's not for today. It's been there for ages. That whatever happens, the fundamental change that happens in the world happens through technology. The society surrounds it. Society falls around it. And the technology doesn't have to be information technology. Technology can be anything that has not been done before. It can be conceptual. It has been done before, but now being done differently. That is also technology. So don't confuse technology only with information technology. And for me, the technology is the only thing which brings wealth. Because wealth itself is a social context. Wealth doesn't exist if there is no society. And because all of us think that particular thing is of value, that is where the wealth comes from. So it's a collective decision at a point in time, almost, not always. And that's where the information plays a big role in figuring out where the wealth is going to be, how it's going to be distributed, and how the society is going to function. Last 80 years, post-World War II have been tumultuous for the world, but they have been also with minimum number of wars in the world. And from literally the day Karl Marx came with a word called capitalism versus communism, entire 20th century was about two different isms. One, which was communism, that is, everyone gets to use what they feel like or what they can, and everyone can produce what they want to produce. There was no, in a way, connect conceptually between who produces and who enjoys the fruits in a way. It was a collective wealth, whereas the capitalism was about person who runs things, who takes risks, ends up enjoying the most. And the ideas came to Karl Marx in London, where he shifted or migrated, and he saw the new technology changing life. Earlier, in feudal Europe, in feudal England, the serfs, the people who used to work on the land, were living in abject poverty. And the nobles, they used to take the money out of them. When the new technology came of steam engines, the textile mills, the masses moved to cities for work. And the London became a center of industry. And Karl Marx happened to be there at that time. And he saw that people with a lot of money could make even more money by the sweat and blood of the poor workers. And so that, he called them as capitalists. The people who had a lot of capital created more capital. And that is the concept of capitalism, that you require more money to create more money. Against that, he pitched the concept of communism, that workers will be free to do what they needed to do. And they are the masters of their life, which is not true. But that is how it was kind of marketed. And entire 20th century, all the wars, all the technological advancements were about the war between capitalism and communism. In 1989, finally, Berlin Wall fell. Berlin Wall is an interesting concept. Some of you might be Googling, but the Berlin city had two sides post-World War II. One side had gone to the USSR, the communism side. The other had gone to the capitalist side, and that fell. And it was a symbolic moment that the communism was defeated. And people thought capitalism won. But actually the winner was marketism. The markets won. So whenever two sides fight, something else comes out. It is like a churn, in Hindu Shastras, we have this churn, and then a lot of things come out, including Amrit and poison, the wish and everything. And similarly, markets won, but none of us knew that markets have won. Now, 89, almost 27 years, and now we have started figuring out that if China is communist, how markets are prevalent there? If Vietnam is communist, how markets are very important to them? If India is a socialist republic, how markets are important to them? If America is capitalist, how markets are important to them? Markets are the winners. And markets have existed for the time humankind has existed. We do barter, we do exchange goods, services, ideas, and that is what the markets are all about. Markets also allow you to efficiently allocate resources. That's what we would like to believe. I mean, it may not be so efficient, but there are other methods which might be not so good. And that's where the markets for resource allocation, that is called capital markets, the markets for ensuring that certain areas get more money, certain areas get less money. Those are the markets either through banking system, which is what is called intermediation. The stock markets are non-intermediation. That is, you give money directly to the companies for bonds or for equities or hybrids. Whereas in bank, you put in money, then banks give money somewhere else, but they do it on a principal basis. On stock markets, you directly give money to the companies, which in the banking system doesn't happen. But these are the two ways modern economies work on. For me, this is a subject I have taught all my life, I have studied all my life, I have worked in all my life, and so it's very close to my heart. And the asymmetry part, why do we have to talk about asymmetry? What is asymmetry? And what is information asymmetry? What are the types of asymmetries in societies? Asymmetries, we know, the asymmetries between rich and poor, asymmetries between resource and non-resource, and so on and so forth. Information asymmetry, why it is required? Ultimately, whatever we do with technology, without technology, with resources, without resources, what are we predicting as mankind? We are predicting the future. The past is relevant only to the extent that allows us to predict the future. And why we need to predict the future is because that's where we are going towards. So if we don't know where we are going towards, and each of us have an idea of what life will be after 1 second, 1 minute, 1 month, 1 year, and it may not be correct because the future doesn't happen the way we think it should. But still, all of us have to predict. The progress of mankind is about predicting the future. We figured out collectively that there are seasons. Seasons, there is going to be cold after 6 months, so we start preparing the wood, we start creating the houses, right? And that's how we survived. If we had not predicted, then how would there be the society? We started predicting that if we put in this many seeds into the earth, after 3 months, there will be wheat. And then we'll be able to take out the wheat and cook. And that's how the agriculture came about. And so prediction is the essence of human life. And for that, more information. It's not necessary to have the prediction all correct. If you are delta correct, little more correct than others, then you are going to be a winner. You're going to survive better than others. And that's why the prediction is very, very important. And you can predict anything. And it's called speculation, it's called anything, but broadly, the human life works on predicting things. And for that, resource allocation, how do we allocate resources to which companies, to which entities, which NGOs, what kind of work they will do, what kind of useful production they will come out with, and so on and so forth. And that's where, in stock markets, we have two types of asymmetries which we try to deal in as regulators. One is I call asymmetry of information. That the insiders of the companies, people who are working inside the company, have a lot of information. People who are outside the company have very little information. And so the insiders can actually predict better than the outsiders on what the company is going to make profits, whether it's going to make losses, what contracts it has got, how many people are there, whether there was a fire in their plant, and stuff like that. So information is of absolute importance in terms of bridging the gap between outsiders and insiders. As regulators, our job is to minimize. It's not possible to minimize or to eliminate the information asymmetry. Outsiders will always have less information than the insiders. We are trying to make it close to zero. It's like a maths problem in limit. Have you ever thought about limit problem as a tending to zero? It never becomes zero, right? So we are trying to bring it closer to zero by ensuring that whatever technology allows, if the company has to have a quarterly information, they should give quarterly information. But if they get a material event, a new order which is large, they should inform. Otherwise, it will have impact on its profits. If there is a court case they lost, which is going to cost them a lot of money, or a contract is going away, that information which is material, they should inform. Why? Is because insiders already have that information. Not necessarily all the insiders in the company will have that, but some insiders will have it. And that same information, if it is material, it has to be made available to outside. And why I'm saying material is because otherwise you will get lots of information which may be not relevant in making decisions. So I can inundate you as a corollary with infinite information which you may not be able to handle. And within that, it's like a needle in the haystack. What is important gets lost. So what is important has to be informed to the people who are outsiders. And outsiders are many. Outsiders could be shareholders who are not working in the company. Outsiders could be media. Outsiders could be government. Outsiders could be anyone who wanting to buy shares have not bought the shares. And general public, because there is a spill of oil or some poisonous things the companies have done, that information has to be available to the entire society and so on and so forth, right? So that's where the information asymmetry is of utmost importance to all of us who study markets, who work in markets. And most of the academic literature on corporate governance is about minimizing or eliminating the information asymmetry. There is another asymmetry which is not discussed, debated in the literature in academic circles, which is more important, is what I call asymmetry of power. That insiders will always have more powers than the outsiders on how the companies run, right? What is a company? It's an interesting framework. Company is an artificial construct. Companies don't exist like humans do, right? Humans exist. You don't have to justify your existence. Cats exist. Dogs exist. But companies don't exist on their own. Companies are what we call legal fiction. They are created by law, under a law, and then we say this is the company, but they cannot act because there is nobody. It's not a company. Company is not a person, except legal person. Right? And so, company requires the agents to run it. And those agents are managing directors, employees, the board takes the decisions, and some of them also may act as agents. And they have more power than the people who also have interest in the company's well-being or workings, but they're outsiders. They have no say in the matter because they're outside. And that asymmetry of power is also a job of the regulator to minimize to the extent possible or to make it more transparent. And India, and both put together, elimination or reduction of asymmetry of information and reduction of asymmetry of power, put together is the concept of corporate governance. The asymmetry of power is not discussed because it's not easy to talk about the people who are powerful. But India has been at the forefront of working on reducing the asymmetry of power. And that's why, if you've heard of related party transactions disclosure, that every company has to disclose if they are giving any contracts to their related parties, that is where companies, directors have a stake or interest, or company has itself given contract to its subsidiary companies or related companies, then they have to disclose and take the approval, if it's beyond a point, approval from the annual general body meeting, which is of the shareholders, which may include outsiders, non-working shareholders also. And why it is done is to also ensure that the companies which are, say, making 10,000 crore profit can actually take away 2,000 crore or 10,000 crore itself by giving contracts to their friends and relatives, the agents, right? And so on and so forth. So that's where the asymmetry of power is also a very important issue, which is kind of required to be worked on. We also have majority of minority. India is pretty much the only country in the world which is a concept of majority of minority. That is, when a company comes with a resolution for the annual general or any body, general body meeting, saying that we need to give this contract or we need to go in this business, people who are interested cannot vote. So only uninterested parties would vote. There is no such concept elsewhere. And there are many, many concepts which the world has which increase asymmetry of power. Like in America, they have golden share. You search for golden share, you will figure out that even if the person has sold out the entire equity capital which he used to hold, but if he has that one golden share, he has a right to run the company, to make all the decisions. So that is, India does not allow that. And there are many, many such things which people have created, rightfully, wrongfully, but Indian stock markets are amongst the most well-organized, most corporate-governed markets in the world today, because we go through all these discussions and always we take decisions in favor of the small investors, who is always an outsider. So in the battle of insiders versus outsiders, the insiders have more powers, more information. And the regulators in India try to ensure that that balance tilts whatever way we can in favor of the outsiders to the extent possible, right? And that is what this debates, these discussions will continue to go on forever because it's never going to be solved fully. But societies which do not solve those issues of asymmetry of power, asymmetry of information, then things start going wrong without your knowledge. So that's why it's very important to guard or control these issues of asymmetry of power, asymmetry of information. When it comes to trading, a lot of us have views. We have views about quarterly derivatives or daily derivatives or second-wise derivatives, but none of us have views normally on how corporate governance functions. But wealth gets created not by trading. Wealth gets created by investing. And what do you invest in? Companies, right? And their workings are much more important than trading in them. Of course, you need to actually have secondary markets and tertiary markets like derivatives. But the price signaling comes for any asset class from just the corporate governance side. And that's why this is an absolutely important part. If you look at, say, China's corporate governance vis-a-vis India's corporate governance, the outcomes will not be seen in, say, 2 years' time, 5 years' time. But if you look at 30 years' time, if you look at 20 years' time, China's index 20 years back was the same as it is today. Nifty has given you 15% CAGR or similar to that in last 20 years. It's largely because in China the companies have become larger, promoters have become richer, but the shareholders have got very little. In 20 years, even inflation has not been given. Whereas in India, because the regulators have been so clear in their mind, even including Ministry of Corporate Affairs, the Parliament of India, the SEBI, that we need to focus on corporate governance, asymmetry of information and asymmetry of power have to be reduced. And that's why, because we have so many young people here, this is the crux where if India has to grow, if India is going to grow over next 30, 50 years to become a developed country, it will grow on the back of stock markets. Last 30 years, India has grown on the back of NSE. When NSE was set up and started working in 94, the total market capitalization of India was around 3,80,000 crore. Today, it's around 470 lakh crore, almost 120 times or more. This wealth of trust of small people, small little investors, we have now almost 13 crore unique investors, 25 crore accounts. We have investors in every zip code in India, every pin code in India except 28 pin codes. India has 19,300 plus pin codes. We are there having investors in Ladakh. We have investors in Andaman Nicobar. We have investors in Dwarka. We have investors in Arunachal Pradesh. Every single pin code you can think of, we are there. Why it has come up, this wealth has been created, is because somebody sitting there, like Mr. Amarjit Singh, is zealously guarding your rights to get that information, reduce that asymmetry of information, asymmetry of power. And that is why we have come that the wealth of trust, that is stock market, I mean, ultimately it's about raising funds and with a promise to share profits. But if the profits come, people take them away without sharing with other partners. Or if profits are going to come, before that they start using that information for their own benefits of the friends and relatives, you are not going to get anything. India has been literally, and there are economic theories which say that lower per capita income countries cannot have well-functioning capital markets. We are $3,000 per capita, which is not a large number. India, why it is not done is because poor people cannot save money. Most of their money goes in subsistence. And if they save money, they don't trust their brothers also. How will they trust somebody sitting 1,000 kilometers away? But today, a person sitting in Jorhat or Dibrugarh is putting her hard-earned 1,000 rupees into a company doing business or having a factory in Salem in Tamil Nadu, thousands of kilometers away, with the confidence that that management will work hard for them, will make profits, not siphon away, and then some small portion, which is proportion to her shares, will be available to her. It's such a great faith that has been created. And India is an exception to that lower per capita income countries cannot have well-functioning capital markets. And today, we are $5.2 trillion markets, 1/3 of India's wealth, but also 4th largest in the world. After US, China, and Japan, India is the 4th largest market. UK, Germany don't have so many people participating in markets. We have largest number of people participating in markets. At literally 12.7 crore unique investors. If NSE was a country, we would be in top 10 countries in the world in terms of population, right? So that is the type of numbers we have, and why is because asymmetry of information and asymmetry of power in corporate governance are two important points which SEBI has been zealously guarding in favor of small little investors. So I just wanted you to be aware that this conference, the topic are absolutely important for future of India, and whatever discussions we have here will be sent to SEBI, will be sent to RBI, will be sent to Ministry of Finance, Ministry of Corporate Affairs, and naturally it will help them make the policy decisions going forward. Thank you very much.
Thank you, sir. Thank you for those thoughtful remarks and setting the tone for today's discussions. Without further ado, I request Shri Amarjit Singh, whole-time member, SEBI, and a respected regulator to please deliver his keynote address.
Good morning, everyone. Shri Ashish Kumar Chauhan, Shri Khara Saab, Shri Mradul Sagar, Tirthankar, Ankit, esteemed speakers, esteemed faculty members from IIM-Kozhikode, ladies and gentlemen, it's indeed a pleasure for me to be here. And I thank the organizers, both IIM-Kozhikode and NSE, for inviting me. It's a very fascinating topic and very timely and very relevant, as Ashish very eloquently brought about. And as Ashish mentioned, as part of his address, that the subject of information asymmetry can be approached from various different perspectives. Since I spent most of my professional career in the securities market regulation space, so I will, give you a perspective from the capital markets, from the securities markets. So let me come to the formal part of my address. We are, and some of these things you all know. I mean, I'm not going to share anything very new here, but still it's interesting to put the facts together and give you some perspective. We are living in interesting and challenging times. The speed, volume, and complexity of what we consume has magnified dramatically. Disclosures are digital, markets move in real time, and a vast amount of research is available at the click of a button today, which was not the case earlier. Yet, as the Nobel laureate economist Herbert Simon observed, that a wealth of information can create a poverty of attention. And that captures the paradox of our age. Also, we are talking about the information age. The attention span, average attention span, especially of the younger population, if I may say, has gone down so to, very low that also further accentuates the problem of information asymmetry in some sense. And that captures the paradox of our age. The divide today is not between those who have information and those who do not have information, but between those who can filter, who can interpret and contextualize information, and those who are overwhelmed, misled, or subtly nudged into poor decisions. The conference theme is therefore both thoughtful and relevant, particularly for regulators. Well-functioning securities markets must be fair and transparent, and Ashish very nicely brought about the asymmetry of power and asymmetry of information, and how regulators in India have given it a top priority. The Indian securities markets has a predominantly disclosure-based regulatory regime, one that relies on placing material information in the public domain so that investors can make informed choices and markets can price risk efficiently. My remarks are in three parts. First, I will briefly outline how information asymmetry has evolved in the information age. Next, I will talk about the regulatory perspective and some of the regulatory measures that we've taken to deal with the issue of information asymmetry in the markets. And then, I will very briefly touch upon one or two emerging challenges as this whole information space evolves. So first, the information asymmetry, how it has evolved over time in our markets. Information asymmetry is a classic form of market failure, and it remains one of the most persistent sources of harm in capital markets. Traditionally, it was most visibly exploited through secrecy and concealment, insider trading, wrong or misleading disclosures. It's very interesting, if you look at the history of how financial markets have evolved, at one point of time, before SEC was set up in the United States, I'm talking about before the Great Depression of 1929, insider trading was not illegal. It was perfectly legitimate at that point of time, to trade on that information. But things changed after the crisis and after SEC was set up. Classic cases include Enron, where insiders knew the company's precarious position while shareholders were kept in the dark. The global financial crisis, we all know about that, also in many ways was a story of opacity. Complex mortgage-backed securities were widely sold with reassuring AAA ratings, and only a handful of players truly understood the underlying risks. These issues persist, but the information age has introduced new layers. Today, information may be out there, and there is a lot of information out there. There's an overload, if I can say. And yet the most important part can still be missed, misunderstood, or ignored. And interestingly, this is not a new phenomenon. This has existed for many, many centuries. If I can, just give you one example from the past, a powerful ancient illustration from Mahabharata comes to mind. On the battlefield, Dronacharya was told clearly and loudly, Ashwathama hata. Ashwathama is dead. The crucial qualifier to that piece of information that followed, Narova Kunjarova, man or elephant. This was either mumbled softly, lost in the noise of battle, or not fully heard by Drona. The statement was technically accurate, yet profoundly misleading. Fast forward several centuries, and the artifice sounds familiar. Until SEBI intervened, the TV advertisements on securities market products often painted a very rosy picture upfront, while the risk factors were relegated to rushed, barely intelligible disclaimers. The gap today is not about what is hidden, but also about what is effectively not heard. This is also why over-disclosures can be as problematic as non-disclosure. When key risks are buried in dense documents, framed vaguely, or drowned in boilerplate, the outcome for an ordinary investor can closely resemble to no disclosure at all. So therefore, more disclosure does not automatically mean better information. Complexity, to my mind, is a close cousin of asymmetry. It can mask conflicts, obscure risky transactions, and make complex products appear better. A related modern challenge is noise, particularly from social media. A recent SEBI investor survey shows that finfluencers, and most of them are not registered with SEBI, they are highly trusted, with nearly 62% of investors making some or most investment decisions based on their recommendations, when advice is blended with entertainment and incentives that are not always transparent, the risk of misleading investors rises sharply. Let me, take it to the next level in terms of cognitive biases. And many a times we are not even aware of those biases. Cognitive biases further widen information asymmetry. Even with the same facts, investor may interpret them differently due to various biases, including anchoring, confirmation bias, overconfidence, FOMO, fear of missing out, or optimism. And I'll not go into the details of these biases in the interest of time. The recent surge in retail participation in options trading illustrates how these dynamics can play out. For example, FOMO, my neighbor is making money on options trading, why should I not make money? So, that sort of bias which comes in. Differences in access to information are relatively easier to address. We can simply bring in a rule saying that you have to disclose this, so it's easy to handle. But differences in perceived reality are far harder to handle. These behavioral distortions can lead to suboptimal choices, mispricing of risk, and adverse selection. Investor education and greater public discourse on these behavioral science aspects are therefore essential complement to regulation. These issues matter even more in view of the rise in retail participation in our markets. See the way whole revolution that is going on in the market in terms of more and more retail investors coming in. As Ashish also mentioned, practically every nook and corner of the country is covered today. The Indian individuals directly and through mutual funds now own close to 19% of the market, the highest level in 22 years. And this is more than the FPI holding. Promoter holdings have meanwhile declined down to 50% in September 2025 from a peak of nearly 58% in 2009. So in this context, the whole information asymmetry issues gain further significance. Information asymmetry can harm markets, the economy, and the people by weakening trust and integrity in markets, by misallocating capital in the economy, and by exposing ordinary households, and I just told you how they are increasing, to mis-selling and exploitation. The challenge is less about availability of information and more about credibility and comprehension. Now let me move to the second part of my address, the regulatory perspective, in terms of what a regulator can do and what we have done, just to illustrate. One key objective of what we do at SEBI is to reduce harmful, either eliminate or reduce as much as we can, the harmful information asymmetry. And this is, we do it through several ways. I have tried to categorize those in 5 broad pillars. So the first pillar is keeping it simple. That's how I see it. One lesson from our market history is that disclosure frameworks must evolve from the mere availability of information to usable information. So let me, just go back in time a little bit, just to give you a sense how we've dealt with these issues. More than 30 years ago, when we opened up the market, we made IPO market free. Anybody could raise money based on the disclosures. And I still remember we used to vet those offer documents. And those documents used to be much thinner than what they are today. But our problem always was, we were also learning as the market was opening up. There was always promoters or the founders of the company would highlight more of highlights, more the positive side than the downsides, than the risk factors. So we always used to struggle that, you have to make disclosures of the risk factors, and risk factors also started coming in. But then the risk factors were very general, relating to external world, relating to general risks, etc. and couched in very generalities. Then we said you have to disclose risks which are specific to the company, risks which are specific to the promoters. Then we also said that the ordinary investor may not have time or the capacity to consume the whole offer document. You please make it a part of the application form. There used to be a physical application form, and there we said you have to put the risk factors there. Again, we struggled with risk factors were put there, but the font size was very small. You needed a magnifying glass to read it. So then we had to come out with a rule saying that font size has to be minimum 10. So, that's how it has evolved. We've tried to, these are all more than 20-year-old developments, but I thought I'll just mention how we have, improved the disclosures in the market over time. Our focus today is to further simplify disclosures and provide an easily accessible summary. SEBI has recently approved a proposal to make draft bridged prospectus available at the DRHP stage itself, in addition to the existing requirement of filing the abridged prospectus at the RHP stage. The board has also approved the proposal to rationalize disclosures in the abridged prospectus. We've been guided by a similar philosophy in the mutual fund space, where we have a key information memorandum and riskometer, which provides very concise, intuitive snapshots of schemes and the risks which are there when you invest in mutual funds. Now let me move to the third part. The third pillar is conduct and conflict of interest. This is the dealing with asymmetry of power. The clear standards around conflicts of interest, suitability, prevention of mis-selling, and accountability, that's what we've been trying to bring about. Because our experience has been that many harms attributed to information gaps essentially arise from conflict of interest or misaligned incentives. That is why SEBI has emphasized transparency around fees, commissions, and expenses, and strengthened disclosures and approval norms for related party transactions. With finfluencers, a key risk was the promotion of products, and this is a fairly recent, in the last few years we've grappled with this, and I think we are one of the few regulators around the world who's made significant progress in this space. A key risk was the promotion of products for undisclosed compensation. Accordingly, SEBI has prohibited its regulated entities from associating with unregistered advisors while carving out exclusions for genuine educational activity. We also work with social media platforms to remove misleading content, and lacks of such content, items of such misleading content have been removed in discussion with the social media platforms. Information asymmetry may also involve unfair transfer of risk. In securities market transactions, agents may gain on the upside but not share the downside. In such situations, disclosures may not fully neutralize the incentive to take excessive risk. That is where skin in the game becomes important. And again, we are one of the very few jurisdictions, just to give you an example from the mutual fund industry, where we've said that the key managerial persons, they have to invest, and there are certain thresholds around that. They have to invest in the schemes they manage. So that's a very important skin in the game requirement. To cite another instance, to address selective access to information, we've mandated public disclosures of earnings call recordings. So every quarter, there are earning calls, and initially, before we came out with the rule, there was not much transparency around what transpired in those calls. So we have mandated public disclosure of earning calls recordings and transcripts, so that the material information is not confined to a privileged few who are there in that room or who are there in that call. We have also introduced a framework for rumor verification, so that price-sensitive speculation in the public domain is addressed promptly and transparently. Now let me move to the fourth pillar. I'm mindful of time, I'll be quick. The fourth pillar is to keep the disclosure framework dynamic. See, as we move, as we evolve, the challenges keep changing and we have to address appropriately. So here I'll just illustrate a couple of initiatives we took in the IPO space again. As all of you know, many new age technology companies, they have started accessing the public markets and they've started listing, where the valuation narratives often rely on non-financial metrics. And some of these companies, when they listed, they were all having losses, month after month, year after year. And there the whole KPI is very different. So we thought just the financial disclosures are not good enough. So we've come out with the requirement of disclosing of KPIs. What are your KPIs? What are your key performance indicators? So issuers are required to disclose key performance indicators that have been shared with the investors at any point during the 3-year preceding the filing of the DRHP. You may be sharing your KPIs with private equity investors, large investors, and so on. Again, we brought transparency there. You have to disclose that when you come to the public market. We've also introduced post-listing periodic disclosure of the KPIs. Just the quarterly disclosure of financial results is not enough in such cases, and we said that you should disclose what were your KPIs which you disclose and what is the performance against those. So this is just to illustrate the regulator has to be dynamic in terms of coming up with the innovative ideas and solutions to the new age problems. Similarly, there were some concerns about 2 years back about or maybe less than 2 years, about froth building up in the small and mid-cap segments. We introduced requirements for mutual funds to disclose stress testing results to help investors better appreciate liquidity risks. The next pillar is the use of technology. The fourth pillar, digital filings have made disclosures more consistent and easy to analyze. System-driven disclosures have reduced manual effort and lowered the scope for errors. See, as the markets expand, as the markets grow, more and more companies list, more and more intermediaries registered with SEBI, the data points are also increasing. And you just can't handle those numerous, thousands and thousands, or maybe running into lakhs of data points. It's just not possible to handle it manually, and technology has to be relied upon. We are also using technology for improving our supervision, but in the interest of time, let me skip that part. Let me come to the fifth pillar, which complements all the four pillars which I just described, and that pillar is enforcement as a deterrent. SEBI, along with stock exchanges, takes proportionate enforcement action against disclosure-related violations, including there could be delays in disclosures, there could be misleading disclosures, there could be incorrect disclosures, and there could be no disclosure at all of some important material facts which we discover later. So such actions, such enforcement actions, they range from monetary penalties, disgorgement of the illegal gains, adjudication orders, prohibitions, and so on. The idea is to reinforce the seriousness of compliance with disclosure obligations under the relevant regulations and protect investors from the harm of information asymmetry. Let me now come to the last part of my address. As I said, a couple of challenges as we see it. We've been witnessing a historic capital shift from financial to intellectual capital. This is should qualify, this is my personal view. This is the way I personally see as an emerging area of challenge. The evidence is overwhelming. The Magnificent Seven, which are primarily, I'm talking about the US market, the Magnificent Seven, primarily embedded in intellectual capital, now dominate global market capitalization. Explosive growth in fintech, climate tech, maturing startup ecosystems, data and AI all confirm that intangibles now drive value. Yet our reporting systems have not fully kept pace, if I may say so. How do we meaningfully measure and disclose these drivers of value, the intangibles, the human capital, the algo advantages, the societal impact, the climate impact, and so on? Until we do, we are navigating the future with yesterday's map. Can we confidently say that today's true and fair reports truly reflect economic reality? This becomes even more relevant as we see new forms of narrative-led communication, including purpose washing and greenwashing, where aspirational language can sometimes run ahead of verifiable action and measurable outcomes. AI, again, no address today can be complete without mentioning a little bit about AI. So AI introduces another step change. AI can be a powerful tool for education, research, and accessibility, but it can also generate, if you apply the lens of information asymmetry, it can also generate convincing misinformation at scale. As adoption grows, companies must be mindful of how they communicate about the use of AI. Exaggerated claims or selective disclosures, the so-called AI washing, can mislead markets and erode trust. We've seen instances of market participants making overstated claims about using AI to deliver exceptional returns. In such an environment, transparency, accountability, and evidence-based communication becomes even more important. Let me conclude. Our goal is towards a market where no one is systematically disadvantaged by opacity, by manipulation, by hidden conflicts, or engineered confusion. If we get this right, information becomes a bridge between households and capital markets, between savings and productive investments, and ultimately between participation and prosperity. At stake is not just market efficiency. Market efficiency is important, but that is not the only thing which is at stake, but public trust in finance as a force for good. Thank you very much.
Thank you, sir. Thank you for the very insightful and a very structured keynote address. We will now move to the felicitation ceremony. I request Shri Ashish Kumar Chauhan to felicitate our chief guest, Shri Amirjit Singh, with the NSE souvenirs. Could we have the souvenirs, please? We have the NSE's bell and the bull and the people of India. These are powerful symbols that represent India's economic growth, financial inclusion, and the modernization of its capital markets. We also have the photo from the lamp lighting ceremony, which captures the essence and spirit of today's conference. Thank you, sir. And I request Dr. Mridul Sagar to please come on stage and felicitate with the IIMK-NSE souvenirs. you, sir. We have come to the end of the inaugural session. I request Dr. Thankar Patnaik to give a vote of thanks and conclude the inaugural session.
Ladies and gentlemen, as we conclude the opening session of the NSE IIMK third annual conference on macroeconomics, banking and finance, allow me to place on record our sincere appreciation to all those who have contributed to a strong and thoughtful start to what indeed promises to be an engaging day of discussions and deliberations. I would like to begin by expressing our gratitude to Shri Amarjit Singh, whole-time member SEBI, for his insightful keynote address. He really mentioned that the idea of asymmetry also extends to what you can do with that information and how the role of the regulator remains in allowing you, facilitating the best decision that you can make with all the information that you get. Sir, your remarks have indeed set an intellectual tone for this year's theme, information asymmetry in the information age, markets, economy, and people. And they've really framed the relevance of information asymmetry in shaping markets. Speaking of information asymmetry, I could do no better than thank our MD and CEO, Shri Ashish Kumar Chauhan, for his welcome address, because the two themes that he put out, the asymmetry of power, not really well discussed, and the asymmetry of information that we really do discuss in textbooks. And in general, for his continued commitment to strengthening the partnership between NSE and IIM-Kozhikode. While Professor Debashish Chatterjee is unable to join us today, his leadership has been instrumental in building and sustaining this academic collaboration. I'd also like to acknowledge Sri Mudal Sagar and the faculty of IIM-Kozhikode for their careful planning and steadfast dedication in shaping this conference. We now look forward to the substantive discussions ahead, and beginning with the panel on information asymmetry, corporate financing, and corporate governance. Thank you, and we invite you to continue engaging actively through the sessions that follow. Back to you, Ashana.
Thank you, Dr. Patnaik. We'll now move to the first panel discussion for today. We have our esteemed panelist, Shri Dinesh Khara, former chairman of State Bank of India, Shri Srinivasan Vaidyanathan, Chief Financial Officer at HDFC Bank, and Shri Neeraj Gambhir, Executive Director of Axis Bank. The panel will be moderated by Professor Arvind Sampath from IIM-Kozhikode. I request all our panelists and the moderator to please come on stage. We'll have the photo session first. The topic for the first panel discussion is information asymmetry, corporate financing, and corporate governance. Could we have the photographer for the photo session, please? So before we start the panel discussion, we have an interesting quiz for our audience. Can we have the quiz slide on the screens, please? So I request all participants to scan the QR code. This will take you to the quiz portal. The questions are relevant to the first panel discussion. Could we have the questions on the screen? Yeah, here's the first question. We have 5 in all and only 20 seconds to respond to the question. The fastest person will get the prize award. You can also see the right answer on the screen. Most of them have got it right. Next, please. Next question. Next. Next. I think this is the final question. Oh. Thank you. Can we have the... So, Namrata, Rohit and Rishi, the top 3. Congratulations, you have won the prize. I request you to come to the stage after the first panel discussion is over. Thank you. And I request Professor Arvind to please start the discussion.
Thank you. Good morning, everybody. It's a pleasure to be again back to NSE, part of this prestigious conference. And it's even a pleasure to be the opening batter for this year's event. So along with me, we have an esteemed panel, Mr. Dinesh, former SBI chairman. We have Mr. Srinivasan, who is the CFO of HDFC Bank, and Mr. Neeraj Kambir, executive director of Axis Bank. So I'll speak from an academic to begin with. So whenever I start teaching a corporate finance class, I always tell my students that all economists begin with a class saying there is information asymmetry doesn't exist in the market. Everybody knows everything that is there to be known. This is the fundamentals of the course. As long as you're studying my class, everything is perfect. Yet, over history, we've seen that as the SEBI member rightly pointed out, we've had the haves and have-nots. People who are privy to information and people who aren't privy to information. So I want to quote a very seminal research work in the field of microstructure by Kyle in 1985, who said that an informed trader is not just somebody who has access to insider information, but is somebody who can make better sense of information than anybody else. In today's world, we have an information overload augmented by all kinds of algorithms and AI. And it's not just from the point of view of the markets, but also from the point of view of corporate finance. Especially in an age where companies are no longer asset heavy, asset light, everybody working on a fintech or an AI or something of that sort, it's more imperative for bankers and lenders because your monitoring costs are no longer the same. It's very difficult to monitor the assets. Earlier, the issue was only with R&D, but now you have to even look at something beyond that. So this is the context. And at the center of all of it is governance. And in governance, India has made some strides in recent times with the Companies Act 2013, the Listing and Disclosure Requirement Acts, and even the IBC. So with this context, I would start my question to Mr. Neeraj. Your experience with corporate banking, what is your assessment of the financing hierarchy of companies? So in a corporate finance class, we typically say that there is a pecking order theory. Companies start by using money they generate on their own, and then there is debt, and then if you have nothing else, you go to equity. How do you see this play out in the real world?
So I don't think there is a one-size-fits-all answer to this question. I think this heavily depends upon the industry, the sector, the particular corporate context. In certain sectors, for example, debt is not readily available. So even if it is optimal, and we talk about debt equity optimality in the context of corporate finance, so even if it is optimal for a company to raise debt and use debt in its working, but if the company is, for example, in a new age sector, debt may not be easily available. So it doesn't have a choice but to default back to equity. The way I think about this is internal accruals is nothing but equity. You have a choice to distribute it to the shareholder, or you have a choice to, kind of plow it back into your business. So really it's a question between debt and equity. And while theory may suggest that there is an optimal structure, companies which have an internal rate of return which is higher than cost of debt should always leverage. But a whole host of factors come into play, starting from whether debt is available in the market for that company, or going up to the conservativeness of the promoters or the management of the company, which may not necessarily really like to fund themselves from the debt. The recent experiences in this context, for example, India has gone through a very deep infra-related asset quality cycle. That has made both the promoters as well as the bankers and the markets a little bit conservative about providing debt to companies which are very heavy, asset heavy, long gestation projects. So again, these are some of the things that come into play. So, to sum up, not a one size fits all answer. Traditionally, asset heavy, long gestation companies have tended to use a lot more debt because of the payback periods being very, very extended.
Thank you. My next question to both Mr. Dinesh and Mr. Srini. If you look at lending in India in the last maybe half a decade or 7 to 8 years, banks lending has come down a little bit. Is it because of supply side constraints, or is it because of lack of demand, especially from capex from the industry? What is your views on this?
Well, I think when it comes to lending, perhaps you have in mind the corporate lending, because otherwise lending is happening, and lending is happening maybe for the retail, maybe for the SME, but not as much for the corporate. There are reasons for that. If at all you will look at it about a decade back, what you have mentioned. Well, of course, part of it is attributed to what was seen in the past in 2014-15, and of course there was no insolvency law, and when the insolvency law came into existence and the actions were taken against the people who were not prudent in terms of consuming the debt which they had raised. So naturally it had some impact, initial impact, when it comes to the borrowing by the borrowers. Then of course what we have also seen is the COVID, which was about almost about 2022 to 2022, almost about 2 years. That was the other area, other period in which actually the industrial activity was quite at its ebb, and that is one of the reasons why perhaps not much of lending happened. And of course, the later part is attributed to the fact that there was enough internal resources which were generated, and if at all you will aggregate the past experiences in terms of the evolution of IBC and also the risk which had emerged, which were unknown in the past. So naturally, the borrowers became little more cautious. And third one, which is equally important, is that the risk assessment and also the risk management at the banks was strengthened quite a lot during that period. And that is something which led to the situation where any such proposal was very comprehensively evaluated, and if at all it did not meet the risk parameters which was acceptable to the banks, of course that lending was not resorted to. And incidentally, during that intervening period, there was enough demand which was seen from the credit side on the retail component. And of course, banks which used to be earlier corporate heavy in terms of their lending, they became retail heavy. So this is the other dynamics which we have seen in the past. So this is how I would like to describe what we have seen.
If I may add, if you look at the credit growth, you have to look at not in a short time period, but you have to look at it over a longer time period. And typically, when you look at through the cycles, economic cycles or event cycles, as he had alluded to even during the COVID cycle, pre, post, and during, the credit growth gravitate towards the nominal GDP 1.1 time multiplier, sometimes 1.2 times multiplier to nominal GDP, but somewhere around that kind of. And that's where it has come. And along the way, it's not just about the one segment, which is the corporate segment. If you look at in the recent time periods, 3 years or 5 years, the credit has moved from large corporates into the mid-market. And that is also both availability, again, due to information availability and the ability for them to access has improved. And banks have embraced and financial institutions have embraced and started to provide that. So you see the credit not in the large top segment, but it is moved across from the mid-market to the retail, and across the spectrum, there is a balanced growth that you're seeing.
It's interesting because my next point of discussion was actually about credit. If you look at the relationship between deposits and credits in recent times, maybe in the last decade, it's safe to say that credit has probably accelerated compared to deposits in the last maybe 5 to 6 years. And this is happening at a time where we are seeing a generational change. We have the Generation X getting out of the workforce. You have the millennial and the Gen Z generations coming in. And their consumption patterns, their investing patterns, their saving patterns are very different to the outgoing generations. So given this context, what is your opinion about the current credit climate? Do we think that the credit climate is, it's a question to Mr. Neeraj and Mr. Dinesh. Do we think that the credit is appropriate? Do we think it's high? Do we think it's on the lower side? That's one dimension. The second dimension is about the deposits. Are banks comfortable with the deposit rates right now, or is it a shift going from savings into the financial markets that's causing a structural change?
Yeah, so as far as the credit provisioning by the banks to the economy is concerned, it may feel like that for the level of growth that we are at, the credit growth in the system is somewhat weaker than it should be. But we need to bear in mind that over the last 10 to 15 years that you described, there has been a lot of change in the market structure. Credit is no longer just provided by the banking system. Credit is also being provided through the markets, debt markets. Credit is also being provided by the non-bank finance companies. Credit is also being provided by the non-bank financial institutions, such as mutual funds, insurance companies. So if you aggregate it all together and then see it in the context of the GDP growth that we are seeing, are we seeing lesser credit growth? I'm not sure that's the answer. I think there is reasonably good amount of aggregate flow of credit into the system if you put all of these together. And that's the same story on the deposit side, similar story. What we are seeing is basically a diversification of financial savings by the households, by the individuals. There is increased participation in the other savings instruments such as mutual funds, insurance. Direct participation in the equity market has actually gone up significantly. all of this has perhaps come a bit at the cost of the deposits that people used to maintain at the banking system. So household participation or household ownership of bank deposits has certainly seen a remarkable decline. But the flip side of this is that corporate sector has become net saver to some extent. A large number of corporates today are net cash flow positive, and a part of that money actually goes back into the banking system. So if you see at a macro level, and it's almost like a tautology, that a certain amount of deposit growth has to happen for it to support a certain amount of credit growth. The question today is, what is the ownership of that deposit base? It's becoming much more institutional, much more corporate deposit base than retail deposit base. And there is an issue for the banking system because some of the Basel III regulations such as LCR and NSFR do not treat all deposits equally. 100 rupee of deposit coming from a retail depositor, bank has a much higher capability of providing funding to the corporates against that or to the economy against that versus 100 rupee of deposit being maintained by a corporate or a financial institution. So we have a bit of a structural issue right now where deposits are becoming institutionalized, but the banking regulation, it does not actually favor this. So there is a challenge for the intimidation by the banking system.
Interesting to know about this. So I'll next go continue on the same lines towards investments now, to the other side. If you look at investments, we always discuss that investment should be in line with the risk appetite of an investor. So SEBI has done a lot of good in terms of educating investors about the risks of investments, etc. But today, do investors really have sufficient information on their portfolio choices? In the wake of so much information overload, especially coming from influencer and so not, what are the constraints still faced by investors? What suggestions would you give to investors who are building their portfolios and some of their trading habits? My question is to all of you on this front.
Well, when it comes to the efforts put in by regulator in terms of disclosures relating to the risk which are inherent in a particular instrument or a particular scheme which is very relevant in the context of the mutual fund, there's a concept of riskometer which has been introduced by the mutual funds. But very important is for the investors to understand what is their risk appetite. Unless and until they have got a very clear understanding of what is their risk appetite, there will always be a challenge because that information is eventually consumed by such investors only. So I think the way I really look at it is that today the investors' decisions are always colored in terms of what their neighbors have earned from an instrument. So actually speaking, and that is one of the reasons why when it comes to F&O and when it comes to retail participation in F&O, we could actually get to see that 95% of the retail investors had lost their money. So very clearly, there was not adequate appreciation in terms of the risk which are inherent in F&O. They were more, the domino effect was seen really playing out in such kind of transactions. So actually taking the same analogy further, if at all people feel that, the securities market has given return to the extent of 18%, 20%, then, at the same time, the leading fund managers are very clearly really tampering down the expectation and are saying that you should not expect return more than 12 to 13%. So that is something which is being talked about. So essentially, India has been a economy where the savers have been looking for the coupon. And actually, when they are looking at the market returns, they are trying to really look at it in the context. I'm actually talking about an average retail investor. They will actually look at it in terms of what the coupon was, but it is not so. It's actually very different. So that is something which needs to be appreciated. So disclosure is one part. The very important part is how is the receiver interpreting it for their decision making. If at all, receivers are not interpreting in the way it is intended to be communicated, then there is a very clear distortion in terms of the communication. That's how I really look at it.
If I add somewhat to that, the disclosure information over a period of time has enhanced, and earlier in the day we also heard about how the regulator has stipulated, insisted, and monitored further more disclosures. However, one other difference from an investment will also be to look at what are the key drivers and categorize them between what is something that is lagging and what is leading, and linking those to the outcomes. That is something, I guess that's a part of the evolution stage. We are at a stage where there is an enormous amount of information that is coming in, but how do you parse this information into these kind of things, segregating between those driver categories and linking them to outcomes, so that a common man could link and reasonably expect what this means, what that information means. Sophisticated investors will figure out, but for the mass to do that, there has to be another kind of a round of process in the evolution that links it. Then it becomes little better and more informed in terms of whatever is the risk appetite and the risk capacity. They are able to match it with that once you get that linkage that is required.
I have a very different suggestion. I mean, if I look at a class 10th curriculum today, the amount of physics and chemistry we teach to our kids is quite a high level, right? How many of them end up using that level of physics and chemistry knowledge in their day-to-day lives? Why don't we start introducing understanding of economics and equity markets and fixed income markets and investment vehicles at that standard? I'm sure if they can handle physics and chemistry of that level, I'm 100% sure they can handle all of this. The reason is that if we don't tell people at a very early stage of their life how to take these decisions and be well informed about these things, we can't expect them to get that information, get that knowledge at a very late stage in their life. This is a skill that all the kids will require when they grow up. Everybody will be investing in markets. It's a fundamental skill now. So we do need to really rethink about how do we educate and teach our kids. Otherwise, we'll keep on having these problems.
I think it's a fantastic suggestion. And if I might just add, studying economics and finance requires 99% common sense. At least as a teacher, that's what I tell my students on the first class. This subject is 99% common sense, which most of us sometimes lack. That's the reason you find it difficult. Pun intended, I tell my students in the class anyways. Thank you for this and hope that one day this gets implemented. Continuing on this conversation about the markets, very interesting observations in the last, again, post-COVID is a lot of participation of new investors. We've got a lot of new investors in the markets, and on the one side, we have explosion on the F&O side, which is the debate, but we're also seeing a lot of explosion on the IPO side. If, for example, there are 3 IPOs which made 100 billion last year, including Tata Capital, HDB Financial Services, and LG Electronics. And we may have more bumper IPOs coming up this year. Regardless of the markets being horizontal or sideways, there are good companies who are still able to come and raise the capital at the level they want. And at the same time, we also have IPOs at the SME level, not just the main board IPOs. SME IPOs are also getting a lot of traction, getting a lot of subscription. A lot of it is due to not just awareness in terms of investing, but also in terms of availability of, say, I can use one app. I'm one app, one click away from an IPO, right? This is where they are. Where do banks stand in this race? Is it possible that this obsession for equity investing and companies also riding the wave, it's like riding a wave. I know that capital is now available at arm's length. So where do banks stand in this particular time where companies are able to raise IPOs, the good companies, and also some IPOs where you see the IPO pricing go down after a few months? Where do banks stand in this particular race right now? Yeah, I mean, this is another question for you.
So, I mean, if you ask me, I'm very happy that companies are able to find equity funding in the markets. It's also a source of pride for us as a country to say that today our capital markets have become so deep that issuers can come and do about $2 billion, $3 billion size of equity issuances, and that gets sold through. Yes, there are some pockets where you can feel that there is exuberance, and maybe there is an overestimation of what the future brings. But on the whole, it's a very good development for the entire economy. Remember, banks can only provide debt capital or credit if there is equity supporting it. So we do need to have a very well-functioning and deep equity market for the promoters or the entrepreneurs to raise the equity capital and then come to the banks and say that, okay, now help me lever it up, right? So it's equity and debt go side by side. If we don't have a deep equity market, ability of banks to provide leverage also actually goes down. That's my fundamental take.
See, in the hierarchy of capital, when you look at it between debt and equity, the cost of equity is, of course, higher than the cost of debt. So when somebody is accessing a market from an equity side, clearly the connection to what is the kind of returns it can provide, it has to pass through that hurdle so that the returns are higher than the cost of capital. Then that is accretive. Where the returns are not, then that is where you see that there is a price correction and so on. So again, one is looking at it in a short time period and then looking at it over a longer time period. And the second thing is also the purpose. What is the purpose of coming to the market, debt or equity? And that also determines, that is what determines what is the likelihood of returns and what is that return likely to exceed the cost. So both the purpose as well as the kind of quantum of returns are very important to determine which one. And of course the right mix, both of those are required in the structure of capital, debt and equity, but the right mix is what moves both together.
Well, I think when it comes to what you mentioned in terms of the SME IPOs, we have of course seen the exuberance, and also this also is a reality that in last about a year or so, the kind of returns which retail investors have made, that remains a question mark in the mind of many. So I think eventually what happens is that when any of these IPOs are being evaluated, one, of course, they are all subject to various kind of assumptions, and the validation of assumption assumes greater significance. It holds good more so when it comes to the SME IPOs. And perhaps I would say that that particular segment still needs to mature. And if at all it will not mature, perhaps there could be challenges which that particular segment might experience. Having said that, I would also like to mention that, when it comes to banks are essentially for providing debt. There's no second question about that. There are some amount of equity investments also being done by banks from their treasury book, but that is essentially from the private, essentially a very small component is being earmarked for supporting the equity markets. This actually goes back when it was being felt that to really encourage the economic development of the country, we need to support the equity markets, and for that, the banking system must come in some way or the other. That was the reason why RBI had permitted that to happen. So I would say that when it comes to equity or debt, now we are seeing that the players who were actually primarily involved into the equity financing, for instance, mutual funds, etc., they're also getting into debt financing through their debt markets. And also, banks are also getting into equity financing to a small component. So I think eventually the players will have a role defined for them. But at the same time, it is not really for equity market or the debt market. Even for that matter, when it comes to the bond market, which is there in the country today, when we look at it, almost about 640 odd billion is a outstanding US dollar outstanding of the bond market, and annually about 10 to 12 trillion Indian rupees are being mobilized through the bond market. So there also, that is also happening through the markets, and which is eventually again the debt. So I think I mean, the way I read this situation is that it is the preference of the instrument. The player could be anyone. It could be either bank or the markets. But yes, of course, this is how the market is going to evolve. And when we look at the global practices also, we have seen something similar happening across the various developed markets also.
Thank you. So I have a follow-up question on this to both Mr. Srini and Mr. Neeraj. On the one hand, we've been talking about this IPO and the markets and everything. Let me come back to information asymmetry here. Is it possible that there are two types of companies? One is a company which is probably R&D, and they don't want people to know what they're doing. They don't want to know what I'm cooking. So I want to avoid the banks who probably can monitor things better, or who probably can make better sense of data. So I go to the equity markets directly. And the second case is a case where I have an SME IPO, or even in the main board IPO, I've got a company which says that, look, I'm probably in need of cash. Let me put in some info in the market, some noise in the market, take as much as I can. Is it possible that in the retail investor IPO frenzy, these two type of situations are having an interplay, especially when it comes to information asymmetry? Is that the reason why some companies are probably skipping debt and going to equity? Is it, what is your view on this?
See, one is going to equity. If you think about the debt or the equity, first is we should recognize that when there is a debt, there has to be cash flows that can support repayment, because there could be periodic repayment or a bullet repayment, and there is also servicing that is required. So the purpose for which it is taken, what kind of cash flows quantum and what timing of cash flows are very important to determine that, right? Where example of R&D or certain projects which have longer time period and so on, when you think about where the cash flows are going to be delayed but could still be very effective, then you gravitate towards to some extent equity and some extent debt. So the purpose again determines that, and if it is neither of those, if it is simply promoted diluting and getting out and cashing and go, so they are again that is also possible. Again, participation broadly, it should be supported by the business kind of what is the future of the business and the kind of prospects that exist. Again, more disclosures will be required, more information will be scrutinized when such is the case, because somebody is getting out for another person to get in.
So I think we have to keep in mind that very early stage business models like an R&D company are not very amenable to debt financing, because there is a high risk of failure, and it's very difficult for you to find people who will actually debt finance these kind of companies, and therefore these companies do require a higher amount of equity capital because they have to invest in R&D, which can have a longer gestation period, and therefore equity capital is the right way of raising funding. Now you can debate whether coming into an IPO market straightforward or whether doing some private equity kind of or venture capital kind of financing is a better way. If equity market supports these kind of business models and an early stage business models, and investors are willing to take that risk, then who am I to say that this is wrong, right? Because at the end of the day, from a disclosure standpoint, I believe the disclosures are there. SEBI does not allow any company to come into the market without a very detailed RHP prospectus which has detailed disclosures about the company. The question is, what is your perception of the risk, right? So if there is a class of investors who are willing to take that risk and fund this company in equity market, I think it's okay, right? There will be some failures, and that's the fundamental principle of a capital market, right? Fail early, fail quickly, and move on. Now, as far as SMEs are concerned, I think the issue is a little bit more complex, because even with very established SME business models, the challenge always is reliability of information, right? And for smaller companies, usually the information is a bit suspect, right? There's less governance, less. So you need to be a little bit more careful about that. And I'm not sure a disclosure alone can actually address it. Like we said earlier, that disclosure is one part of the story, right? Governance is the second part of the story. So I think the overhang of governance is a bit more serious in case of smaller companies. But if that is addressed right and there is confidence, then why not? These companies should also have access to the markets.
Thank you. And it's very interesting that you finish on governance, because I want to next jump to governance. You've been on many corporate boards. So on a scale of 1 to 10, how do you rate corporate governance in India?
I think it's evolved a lot. I would say that as I look around, so it's partly, there are two effects at play. One is obviously the regulators have tightened the regulation, the disclosure norms have gone up significantly, expectations from the managements and the boards are actually increased quite dramatically. It's now enshrined in law, Companies Act, SEBI listing requirements, the whole bunch of stuff is there. But I think more than just the regulation, a large part of Indian entrepreneurship circle and the promoter circle has also realized that if corporate governance has become, or high level of corporate governance has now become the de minimis for you to raise capital from international markets and domestic markets. So if you do want to access markets, and if you do want to rely upon the markets to give you both equity and debt, you do need to evidence a high level of corporate governance, and it is the ask. So I think from both sides, if I may say supply side and demand side, there has been a considerable improvement. Do we still have accidents? Yes, we do. Is there a scope to improve further? Certainly there is. But I think we've come a very long way compared to, let's say, 15, 20 years ago.
A small, quick follow-up. Can you speak about one scope to improve? Where do you think we have a good scope to improve on?
So, I think the scope of improvement, I mean, look, disclosures are heavy today. In fact, I was a bit positively surprised hearing that SEBI is now thinking about, streamlining some of these disclosures, which is a very welcome movement. I go back to the same point, right? I may disclose as much information that I can put out in the public domain. We need to make sure that investors are educated. Because if you don't have an educated investor set, that disclosure is useless.
So I want to now take a rapid fire question. So my first question now is something more postmodern. This is about CSR activities. If you look in the last decade or decade and a half, 3 important letters have probably come up all over corporate world, across the world, called ESG. So I've done some work on ESG, and to give a Star Wars reference, I started as Anakin Skywalker, and I'm probably the Darth Vader right now. Because I started thinking ESG is something, but now I have questions. So this is a question to all 3 of you. What is your position on ESG? Do you think that it is really something tangible that is helping companies probably reduce their cost of capital in distress times? It's a buffer. It's something tangible in terms of valuation? Or do you think it's a bubble that's waiting to be burst?
To my mind, it's very tangible, because if at all, unless and until there's an environment which is in fact conducive, if I may say so, and also the social system which is balanced, and of course on the top of it the governance which is in the interest of all the stakeholders, the entity's existence, or maybe for that matter the society's existence could be at stake. Now, at what level it is being followed in different organizations? Well, of course, I think part of it is thanks to some kind of regulations which have been put in by SEBI and also by Ministry of Corporate Affairs. There is I would say, receptibility towards this concept. But increasingly, I would say, the boards are appreciating the ultimate purpose and are willing to comply with the ESG norms. And on the top of it, when it comes to environment in particular, all those who are going for the global fundraising, they have to be very conscious, and they are going for some kind of a evaluation in terms of their ESG maturity also, and they are publishing in their reports as well. So I think that is the outcome which they are actually highlighting. But eventually, I would say that meaningful actions are happening on this particular front by practically all the leading corporates of the country.
I would agree that it is now embedded in organizations. It's taken its roots and part of the stage that it would get into several stages of progress, but it has already begun. The next kind of a stage to that is, of course, the impact of each one of these actions, measuring those impact and prioritizing those kind of actions so that you get the maximum impact and on a balanced basis across all of those three. That's where the next stage I think it will go, but I do think that it is there to stay and it is there to progress further.
Okay, so my view on this is that the kind of hype that we saw about ESG about 2 years ago or 3 years ago seems to have fizzled out, and we've seen why. Some of the large countries seem to have walking back from some of those things. But it's a good thing that the hype has fizzled out, because now we can talk about real effect, real progress. As the previous two speakers said, it is real, it's important, and organizations are taking it seriously. And I think some real work is happening in that space. The issue is always that, are we able to assess the impact? And is the impact as quickly coming as we would like it to be? I think a lot more needs to be done, a lot more seriously, but we need to stay away from hype.
Interesting. Last question from my side. Again, for all three of you. What is the biggest episode of corporate governance failure in India that comes to your mind? What lessons have we drawn from it? And have we fixed it? And where are we right now?
IIFL. And why? Because the structure was very complex. And it was all folding into one another. And it was very difficult to really identify what goes where. So I think the learning from there is that all complex structures are being discouraged in the first instance. And also there is a lot of responsibility which has come on the board of directors also. I think it has taught the lessons, and now various lenders are very mindful, investors are mindful, stakeholders are mindful, and even directors are mindful. Thank you.
Another way, it's the same thing, which is but another way to think about is the interconnectedness or the intergroup related transactions, relatives, and those those are the ones that have been common themes across various issues that we have seen. I guess some of those regulations that have come, consciousness that have come, and approach of the institutions towards looking at these as a primary level of review has enhanced the approach to solving this.
There are many actually. IFL, as Mr. Khara said, DHFL, and in the past companies like Satyam. I think in each of these episodes there's something to learn. But one of the things that, the biggest surprise in some of these episodes is that these companies were rated as AAA. And they had intense scrutiny by the credit rating agencies, by the lenders, everybody, and yet things unraveled very quickly. And we realized that something fundamental wrong. So I think at the end of the day, there is a higher obligation on anybody who's assessing the financials of a company, whether it's an auditor, whether it's a credit rating agency, or even for that matter for banks who are doing the credit and risk analysis, to actually verify what is being said and not just go by the representations that are being made.
Yeah. So thank you. I hope the audience had a wonderful discussion. Okay.
Thank you. I request Dr. Tirthankar Patnaik to please come on stage. we'll have the felicitation ceremony. I request our team to please have the NSE souvenirs. Sir, Dinesh, sir, we have the. I also request Dr. Mridul Sagar to please come on stage to felicitate with the IIM Kozhikode souvenirs. I also request the quiz winners of the first panel to come near the stage to collect their prize awards. Ms. Namrata, Rohit, and Rishi, the top 3 winners of the first quiz. Congratulations to all 3 of you. They get the NSE power bank. Okay, we have. Thank you everybody, thank you to the panelists. We have just concluded our first panel discussion. We'll take a short break for 10 minutes. Don't be gone for too long because we'll start the next panel immediately. We'll have the setup ready. So please be back in 10 minutes. Thank you so much. I'd request everyone to kindly come back to the atrium as soon as possible so that we can proceed. May I kindly request everyone to come back to the atrium, please? Requesting everyone once again to please gather back at the atrium so that we can proceed. I request everyone to be seated so that we can start soon. We'll be starting in the next few minutes. I request everyone to be kindly seated.
Good morning once again, ladies and gentlemen. I hope you enjoyed the networking tea. We now move into session 3, information, forecasting, hits and misses in inflation targeting. Inflation targeting is not merely a framework. It is an exercise in managing expectations under uncertainty. It depends critically on data quality, model robustness, institutional credibility, and the ability to distinguish signal from noise in real time. To unpack these complexities, we have an exceptionally distinguished panel. May I request our panelists to kindly come on stage. Dr. Samiran Chakraborty, MD and Chief Economist for India at Citibank. Dr. Chakraborty leads macroeconomic research and policy advisory for institutional clients. Prior to Citi, he headed South Asia macro research at Standard Chartered and earlier served as chief economist at ICICI Bank after beginning his career in academia at the Delhi School of Economics. He is a member of CII and FICCI's Economic Affairs Subcommittees and CNBC's Citizens Monetary Policy Committee and is a frequent commentator on leading global media platforms. Shri Shaugata Bhattacharya, Center for Policy Research. He is a senior fellow at the Center for Policy Research and a distinguished economist with over 30 years of experience in macroeconomic analysis, financial markets, and infrastructure finance. He has contributed to several Government of India committees, including the Prime Minister's Task Force on Infrastructure. His current research spans macro-financial forecasting, MSME dynamics, digital public infrastructure in financial services, and urbanization. He brings a rare combination of policy advocacy, analytics, and market insight. Finally, joining us would be Shri Shailendra Jhingan, Head, Treasury and Economic Research at ICICI Bank. Shri Jhingan brings over 2 decades of experience across bond markets, fund management, and treasury operations, offering a practitioner's perspective on monetary policy transmission. He has previously led fixed income fund management at HSBC Asset Management and managed flagship debt schemes at Birla Sun Life Mutual Fund. He also serves as a director on the board of the Primary Dealers Association of India. Shri Kaushik Das could not join us today due to unavoidable circumstances. We look forward to engaging with him on a future occasion. Finally, I would be very pleased to invite Professor Midul Sagar to moderate this session. Professor Midul Sagar is Professor of Practice Economics at IIMK-NSE with over 3 decades of experience in central banking and macroeconomic policy. He has previously served as Executive Director at the Reserve Bank of India and was a member of both the Monetary Policy Committee and the Financial Markets Committee. Thank you. Kindly, I request all the panelists to join me on stage, please. May I request all the panelists and the moderator to kindly pose for a group photograph. Before we dive into the discussion, let us energize the room with a quick Slido round. As before, please scan the QR code displayed on the screen or visit slido.com and enter the event code. There will be 5 MCQs. You will have 20 seconds per question. The 3 fastest participants with all correct answers will win a prize. We can begin the Slido. We may begin with the questions now. Thank you. And now we formally begin session 3. Thank you.
Okay, thank you. So I'm not introducing my panelists. I think all of you might be knowing. So we have very quickly Samiran from Citibank, and basically Sogata is actually the current MPC member, former Axis Bank, and Shailendra is a bond market expert, and he handles basically the financial markets from the side of ICICI Bank. Now, what I saw was that at least all of you have some idea about the inflation targeting, maybe not exactly what it is, but in the sense that it's one of the monetary policy framework. What the monetary policy does is to keep prices under check and help stabilize the growth along its long-run potential path. Now, inflation targeting framework has delivered probably one of the most best results in the sense that it has actually lowered inflation without much output sacrifice. I don't know whether my panelists agree or not, but let me first raise the first question first, because people were asking what is the inflation target and what is the tolerance band. That was the first question asked to the participants. What do you think will be the inflation target and the tolerance band by the end of this month? Do you think there is a need for a change in the inflation target and the tolerance bands? 10 years of flexible inflation targeting framework, has it yielded the good amount of dividends, or has it been a failure, or is it a mixed story? So off to you, Samiran, first on this. And where do you see? I'm telling you, we will have very, very soon the new inflation target. It could be the same. It could be different. I don't know. So maybe you can think what it should be.
So thanks, Mridul, for having me here. Great to be back. The taste of the pudding is in its eating. So if we are 10 years into the flexible inflation targeting framework, and if I compare the 10 years before and 10 years after, the average inflation has dropped from 8% pre-FIT to 5% post-FIT. That's a 300 basis point decline in average inflation over 10 years, which I think is a remarkable achievement of FIT. Where one could get that mixed feeling is that ultimately the way interest rates affect inflation is through inflation expectations. So very interestingly, if you do the same comparison for inflation expectations, the drop is only 100 basis points. So that's a bit curious that why inflation expectations have not come down as much as the actual inflation has come down. So this is probably a good research question for people to delve into more. But I would say that on the face of it, the FIT has delivered big time. Now the question is, can we change anything in the FIT? I suspect one of the things that we economists, crib about is the volatility that gets created in the inflation data because of some items which are really random to predict, like vegetable prices. Now, vegetables might have a very small 5.5% weight in the index, but it induces massive volatility because vegetable prices typically move in a particular seasonal pattern. But if in a particular year that seasonal pattern is not followed, suddenly the numbers could be like 50% higher or 50% lower without any meaningful signal for monetary policy. So this is a very small component. We can ignore that component and still the average inflation turns out to be almost the same, but the volatility of inflation changes very rapidly. So it might become easier for MPC to set their policy without being worried too much on this three-quarter rule being breached just because of some volatility in vegetable prices. And the other element of FIT which needs probably more discussion is to what extent the implementation of the MPC's actions on repo rate, on actual market rates, through the liquidity adjustment. That part is not at all a discussion in MPC. I mean, it's not MPC's remit to talk about it. But in the past, we have seen several instances where the market rates have been quite different from the repo rate set by MPC. Now, in that situation, MPC's role gets diluted if that happens. So to what extent in a sort of rejuvenated MPC framework, we can get that also built into the MPC's remit? I think that's also an important question to address.
Thank you, Samiran. I mean, a very, very bold view you have taken, and I have an MPC member sitting next to you. So this issue that whether the MPC should set the policy repo rate or should also be responsible for liquidity management is a very critical one. Now, let me come to Sogata. Two questions for you now. One about the target, whether those needs to be reset with the tolerance bands or not. And second, this issue, do you feel constrained when you have to decide on the policy about policy repo rate, that it cannot be completely detached with the liquidity operations? I mean, the Fed does have an implementation note on the liquidity management, as part of their FOMC, which is not the case with the RBI MPC. So do you think that is a framework change that is necessary or in terms of the rule or no?
So thank you, Mridul, thank you, Tirthankar, for giving me the opportunity of interacting with my young friends here. To begin with, I want to add one thing to Samiran's very beautiful exposition of the efficacy of the MPC, the flexible inflation targeting framework, and that is communication. Communication is central to the central bank because communicating gives you forward guidance on what it is that the MPC, the central bank rate setting committees, whether it be FOMC, the Bank of England, the European Central Bank does. And having one target in mind, of course, I mean, the flexible inflation targeting framework also has growth in mind as a secondary objective, has growth. So that part of communication has been, I think, central to anchoring inflation expectations and market behavior. Second, on the rate levels, 4% odd, I think more or less, I think it's good because there have been multiple RBI research frameworks which indicates that inflation beyond 6% begins to hurt growth. So that upper limit of 6%, I think, is more or less appropriate. Now, on the third question of liquidity framework, I think I'm more or less comfortable. Remember, theory on rate-setting behavior of a central bank is that the job of the rate-setting committees, the MPC, the FOMC, or whatever, is to fix the base, the base repo rate, anchor the yield curve. I guess all of you know what the yield curve is, the entire set of interest rates from the overnight rate to the 30-year rate, the 50-year rate. The job of the rate-setting committee is to fix that anchor, the repo rate, and then let market conditions, expectations, whatever, credit, demand, supply, or whatever, make the yield curve float. So the yield curve adjusts to market conditions. The MPC's job is to anchor the rate. And for that, even Mridul, your question on the FOMC, the FOMC has a target of 0.5% around the whatever the target rate is. The job of the New York Fed actually does the market operations, overnight market operations, to keep the target rate, the operating rate as it's called, close 0.5% round the actual rate, the FFR, the Fed policy rate, Fed funds rate, round that place. I think it's more or less the similar situation that one arm of the Reserve Bank make sure that the operating rate, which in India's case is the weighted average call rate, that is fixed around the actual repo rate. So I think the conditions are more or less, and remember, liquidity management is a very high frequency operation. Liquidity management is a day-to-day operation. The MPC meets once every 2 months. So it will be very, very difficult. Does the MPC talk about liquidity? Of course we do, because this is very much part of the transmission mechanism. Transmission is the ultimate role, the key objective of monetary policy is transmission into different rates. Yeah? So the MPC does talk about it, but I think in operational terms, it does not, probably it will not be appropriate for the MPC to take a call over that period of the next 2 months or so.
Yeah, so in a way you have articulated the RBI's view on this issue. So I leave it at that. And we'll have some discussion more at another point of time.
One thing before, I'm talking on behalf of myself, not of the MPC. I needed to make that disclosure right up front.
We must make this clear that this is not an institutional view. We want frank academic discussion where individuals are giving their personal views. So let us be very clear about it. And let me turn to Sailesh. Do the financial markets care what the RBI does? A 25 bips up or down? Does it care what the liquidity changes are made? Or they're more worried about maybe, for instance, the stocks in this bourse, are their pricing is a function of the RBI interest rates or not? we need a little better understanding of how markets sort of react to the RBI monetary policy, because there's a lot of buzz around that policy. But do the 25 basis point does anything to these asset prices?
No, it definitely matters to the markets. But what I'll tell you as a practicing treasury manager is this, that what matters to the market more is the price of the asset. So how is the bond yield likely to move? How are equity prices likely to move? How are forex markets likely to move? And I think what comes to my mind is this saying by Howard Marks that there are two things you have to get right as a market person. When you're trading in the markets, I mean there are two important variables which come to mind. One is that you have to get the policy call right, that whether RBI is going to cut or not, that is one call. And the second call is that if that event happens, then how will market react? So sometimes what happens is that you would think, and everyone in the market thinks that if RBI cuts, yields are going to go down. But a lot of time these things are already in the price. And then what market is looking for is the forward guidance which RBI is giving, or whether the tone is dovish or the tone is hawkish. So these things become more important. I mean, a case in point being the last, the December meeting of MPC, where RBI actually ended up cutting rates, but yields went up. So, it's not just about, what happens to the policy rate in a meeting, but, the other dynamics are equally important. What is RBI talking about in terms of future growth? What is RBI talking about in terms of future inflation? What is the outlook for liquidity? I mean, so what's been happening recently, we know, is that, RBI has been doing a lot of liquidity infusion, through OMOs, through what are called forex buy-sell swaps. So these are also ways where RBI infuses liquidity. But simultaneously, RBI has been defending the currency also and selling a lot of dollars, which kind of neutralizes everything. So as market practitioners, these are the other aspects which become more important to us. For someone like Samiran, I mean, getting his policy call is, probably how, his performance will be determined. But for us, it is, how well we, project the movement in asset prices. I mean, that becomes more critical.
Okay, Shailendra, I think that's a wonderful observation you made. And let me stretch you a bit on this. Like June policy, the 50 basis point cut, but change in stance. So this basically meant that the communication is more important than rates, probably a point you were making about communication from the central banks being very, very important. So the policy can get defeated if everything is not aligned. When you look at the latest situation with the government market borrowing program, the gross being so high, whether basically Sogata cuts the rate another 25 basis point next time or not, would that affect the benchmark yields in any way? Or it's the fiscal policy that determines long end of the yield curve?
No, so a very interesting question. I mean, what we have found is, and it's very intuitive and very obvious, I think all students will also understand this, that it is the short end of the curve. Let's say the points up to 5-year on the government securities, which will move more to the monetary policy. Whereas when it comes to the longer you go along the curve, it is the fiscal policy and what we call the demand-supply dynamics, which become more critical to the way yields move. Because what you have to understand is, suppose some investor, like an insurance company, is buying 30-year bond. I mean, he's not going to react whether there's a cut in the next policy or not. In 30 years, you're going to get probably 10 monetary policy cycles. I mean, rates will move up, rates will move down. So, the efficacy of monetary policy or its impact at the long end of the curve, keeps diminishing. So what we find is that up to 5-year, I mean, there's the maximum impact. When it comes to the 7 to 14-year, both fiscal policy and monetary policy have an impact. And I think an interesting thing is that, how a 14-year or a 15-year bond behaves. When you're in a cutting cycle, when, the RBI stands as accommodative, there is a convergence between the 15-year and 10-year yield. Whereas in a cycle where RBI is hiking rates or RBI is done cutting policy rates, what we find is that the 15-year actually goes right up to the 30-year bond yield. So they almost become equal. Whereas the part above 15-year purely reacts to the demand-supply dynamics. So what's been happening in the last 2 years has been that the flows into the long-term instruments in the bond market have been coming down. I mean, all of you would have seen that the flows into the equity markets have been increasing, whereas the flows in the bond markets have been coming down. So because of that, the term spreads on long-end bonds have been widening. I mean, like the 10-year bond today is at 675 for a 5-quarter rate. Normally, the spread is about 100 basis points. This 50 basis extra is also being driven by the fact that there's a lot of supply of bonds. The fiscal deficits are high. States are borrowing a lot. So all these other factors also come into play. So it's not just about monetary policy. It is also about fiscal policy and the overall, trend in savings of financial savings, which, like I said, are moving towards equity and away from the bond markets.
In fact, when I teach finance to the students in my institute, I impress upon that the belly of the yield curve 3 to 7 year segment is the one from where most banks price their products. So would you agree with that, or the 10-year is more important to you?
No, absolutely. I agree. I think the short end is more important. The 10-year has somewhat of a symbolic value because, it is something everyone tracks. I mean, even the ticker which comes on CNBC, for instance, it gives you the only indicator of bond market which it talks about is the 10-year bond yield. Whereas, we find that almost 80-90% of the borrowing of the corporate sector happens at the short end. Today, all the retail loans which banks, pass on are linked to what are called external benchmarks, with the RBI repo rate being the most important one. So about almost 65% of the lending happens on the repo rate. So again, it's the short end of the curve which really impacts, bulk of the economy. There will be some corporates, infrastructure companies, etc., which borrow at the long end. So for them, the movement of the long end yield also matters. But practically from a macroeconomic perspective, it is the short end where most of the transmission happens, and those are the rates which matter.
Okay, let me turn to the two very, very learned economists we have on the panel. The topic of this conference is about information asymmetry in information age. Do you think MPC has superior information when it takes a decision, or is there information symmetry in the financial markets? First Samiran and then Saugata, the insider view will be later.
So Bridul, on a lighter note, we are a 2-member economics team, and RBI probably has, I think, about 400 economists in the DEPR ballpark.
Maybe you have to divide it by 4.
No, can't be. I mean, it's definitely more than 100. So we are significantly disadvantaged in terms of pure numbers. So what it means in real terms is that RBI can.
So let me say, I mean, the numbers would affect the analysis of the information. My question is the information symmetrically available to you and the MPC?
So this is where I was coming to. Let's say I'm giving you a practical example that RBI can have a dedicated person going to every rice mandi in the country and get relevant information about what's happening in the rice market and how rice prices over the next 6 months are going to play out. Now, it's impossible for me with a 2-member team to do the same analysis. So that's where a significant information asymmetry can come in terms of forecasting. The second is that RBI, it's possible for RBI, and RBI does it very frequently, is meeting all global central bankers in different forums. And nowadays we know that global commodity prices have a significant bearing on our inflation as well. So it's possible that RBI has better information in terms of the global linkages that are there for our inflation. But I must say that this is information. When it comes to modeling that information into inflation forecast, I haven't seen a model which does well in out-of-sample inflation forecasting in India. In sample inflation forecasting, you will find enough models saying that, oh, I've got R square at a very high level and I've got a beautiful model run. But when it comes to out-of-sample forecasting, I haven't seen a model which works very well. So that way, all of us, we end up doing more of nowcasting inflation than forecasting inflation. In nowcasting inflation, we are actually just deriving as much of price data from different sources to say that what is the inflation number for this month or for next month. But beyond that, if you want to do 6-month ahead inflation forecasting or 12-month ahead inflation forecasting, I don't think our inflation cycles are as much synchronized to economic models as probably in some other countries.
Very good, interesting observations. We'll come back on this, time permitting, and maybe I'll ask some people on the floor to react to it. I know there are at least 3 very learned macroeconomists sitting on the floor also. So, and we also have an international expert here. So let's see how we get the time. But Saugata, what is your view?
No, so I agree with Samiran, but there is an information, not so much an information asymmetry. I know, I mean, the RBI does a huge amount of surveys. Yeah, as you say, there are regional RBI centers, each one of them does. But the real asymmetry around the time of the policy is that all of you will have access to the survey data after the policy is released. We have access to the data before the policy. That's pretty much the only information asymmetry. There are some things that RBI gives which you probably will not have access, but those are relatively minor points relating to data, etc. So other than that, in terms of the modeling bit, RBI has some very sophisticated models. So one model is based on something like the nowcasting. There is a nowcasting model. But other than that, on a short duration, say about 2 quarters, 2 quarters ahead, there is something which is called an IDG model, interdepartmental group model, which is basically for the technically minded, a vector autoregression model, but far more deep than that is something that the RBI has. It's called a quarterly projection model, which is the longer run, the medium-term projections, 5-6 quarters ahead. It's called a quarterly projection model, which they have developed in association with Dr. Salgado, you would know, with the IMF, with the Bank of International Settlements, 152 equation model with a huge model. Of course, the quality of data that goes into the model will be the final determinant of the outcome. But hopefully, I mean, we are getting better access to more and more information from the markets, from various surveys, which allows you to calibrate those models. Right now, the RBI is in the process, RBI, the Ministry of Statistics and Program Implementation, MOSPI, they are in the process of using these big data, scanner data, various high-frequency e-commerce data, scraping from the web, etc. But these need to be calibrated. I mean, a lot of testing will need to be done as to the efficacy of these models before they can actually be put into the public domain. But things are happening. Things are happening. And by the way, Mridul, one minute. In terms of the previous issue of markets, let me just, for the young people involved, it's not just the actual 10-year, 5-year, 3-year, 15-year rates. There is something called the interest rate swap pricing. One part of it is the overnight index swap. That is a far cleaner view of a cleaner rate view. Rather than, because I mean the actual interest rates are I mean contaminated by the demand and supply, price expectation, or other.
So the OIS rates are a culmination of what the market expectations are.
Yes.
In terms of what.
So that's the OIS curve. OIS gives you a better signal.
So let me turn to Shailendra on this, since you raised that OIS. Shailendra, one information asymmetry which exists is that the MPC knows fully. MPC member knows what discussions took place in the meeting. The minutes come after 2 weeks. So the OIS rates may move after the minutes are available, whereas that information is available to the MPC member. Is it really very material? I mean, Bank of England, of course, does the minutes simultaneously, but there are other central banks like Fed, which have even a longer gestation lag in releasing the minutes. So there is this debate about transparency, but also to curb the noise in the market. You sometime, because also members need certain comfort that they can more frankly discuss. The heat at the time of the policy is very high, and so they tend to delay the minutes a bit. What's the market view?
So I think in terms of the market movements, at least my observation has been that market moves immediately after the policy. I mean, the 2-week lag can be shortened, but I think it is good enough. I mean, if you, like you rightly said, I mean, Bank of England, Fed, etc., everyone has a 3-week to a 4-week lag. Bank of Japan is 6 weeks actually. So, you know, a 2-week lag, I think, is good enough from a market's perspective. But like I said, I think most of the movement happens immediately after the policy. I think what market waits for is that suppose there has been a dissent, or there are times when, you know, there is an expectation that, you know, the policy could be changing, and it's not come out, you know, in the monetary policy resolution. But when the members talk about it, you know, it becomes very apparent. I'll give you a case in point. I think it was probably the June 18 or the April 18 policy when, you know, the RBI stance was neutral, and there were 2 members of MPC. One was the Deputy Governor at that time, Viralacharya, and Dr. Patra, who subsequently became the Deputy Governor, but at that time was an MPC member. Both said that they're veering towards a withdrawal of accommodation stance. On that day, the yields moved by, you know, almost 8 to 10 basis points, because market wasn't really, you know, kind of prepared for something like this. So it doesn't happen very frequently that MPC minutes, you know, make such a change. I mean, you know, like you would get dissents. But what happens is that the markets know that certain people have, you know, so market also classifies all MPC members, including, you know, 2 of you would have been classified in a certain way as either being dovish, you know, or being hawkish. So if, let's say, a dovish member is kind of talking about, you know, that the policy should be accommodative, I mean, market will tend to discount it, because market will say that that is not the central view. So in a way, I mean, you know, market looks for these cues, but I think most of the movement happens at the time of the MPC, you know, meeting. But after 2 weeks, I mean, we have seen that, you know, there's not much of a change in the market levels.
Okay, let me turn back to the topic which emerged initially, but I delayed a bit of discussion, which is about forecasting. Now, forecasting is an information in practical terms, and one needs to understand how good are the RBI forecasts on growth and inflation, because they have market movements for sure. So would you recall first your general assessment about any sort of systematic biases in growth and inflation forecasts, or large deviations from actual realized numbers? So when it comes to large deviations, can you recall one episode of growth, one on inflation, which really made a hell lot of a difference to policy or to markets in that respect? And second, whether you believe that there's a systematic bias in RBI forecasts or not?
Let me respond to Shubhadada first on the models. The models are great. The problem that I find is that because India is such a dynamic economy, that the parameters of these models, they are also very dynamic. So sometimes it becomes very difficult, especially the way the world is changing also very fast, to believe that the parameters that were derived out of last 20 years data, that same parameter is useful for forecasting purposes. And the second challenge that happens is that there are just too many shocks nowadays. If you think of last 5 years and the number of shocks that have come, it's impossible to model shocks. We economists, we are good at trend forecasting. We are very bad at shock forecasting. So if we keep on forecasting the trend based on the most sophisticated model also, we will still not be able to meet the actual. And this is actually what has happened with RBI's own forecasting also. So if you look at this 10 years of RBI's FIT framework, and for every policy, look at what RBI had projected inflation 1 year ahead, and compare that with the actual inflation turnout. That gap is 150 basis points, 150 basis points. But there is no systemic bias. So for the first part of FIT, till about, I think, Q2 FY20, just before COVID, the bias was that RBI was predicting inflation to be higher. The actual inflation outturn was lower. Then from then on till about FY23, it reversed because there were so many shocks, the COVID shock, the Ukraine war shock, that consistently RBI's forecast undershot inflation by as large as 300 basis points. 1 year ahead inflation forecast, undershot by 300 basis points. And then from FY23 onwards, it has reversed in the other direction now. Now RBI is forecasting inflation higher, but the actual inflation is turning out to be lower. So there are three distinct phases that we find. And on a loose way, one can say that there's a bit of adaptive expectation building, that when RBI gets it wrong on one side for some time, it reverses on the other side with its forecast. And then after a while goes back to this side. So it almost, if you plot it in a chart, it almost feels like adaptive expectations. On growth, it has been like this, that pre-COVID, the growth forecasts of RBI were higher than actual growth outturn. And post-COVID, it is kind of reversed, where RBI has been more conservative in its growth forecast, but the actual outturn of growth has been much better. Now, while this is true, Midul asked about specific instances. On growth, the one specific instance really stands out is October 2024. In October 2024, RBI almost did not even a forecast, it's more of a nowcast of the September 2024 quarter.
6.7%.
It was 7%.
No, they downgraded to 6.7 just before the release.
The policy statement still has 7%.
But policy statement says 7,
yes.
But in state of economy, where those model results are presented, it was given 6.7, but that was obviously not the case, because by then second quarter corporate results were known, it was dismal, and actually we got a number of 5.7, which was a big credibility issue.
By the way, whatever I'm saying, I should put one caveat in saying that any of you who take up this job of doing market forecasting would realize how difficult it is. So it's an extremely complex and almost a thankless job, because you rarely ever get it right. So whenever you get it right, give 5 pats on your back that you have got it right. Most times you are not going to get it right. So this is not actually a comment on how many times RBI has missed, but it's just that if hypothetically RBI in the October policy was able to predict that the September quarter GDP growth would be 5.7%, I'm sure the rate cut cycle could have started in October itself, rather than getting started in February 2025.
Yeah, the first estimate came at 5.4. It later got, I think, revised to 5.6 or 5.7. Huh? Very
unusual print.
And it was a big political ramifications occurred.
Exactly.
So if I can add, along with that, what was happening was that the inflation number was being driven by food prices and particularly vegetable prices. So like Samiran made a point earlier that, when we look at inflation, these kind of things need to be excluded. So along with the fact that core inflation was already at, somewhere close to 3%, growth was slowing down. I mean, the cutting cycle should have actually started, much earlier. Had RBI been, looking at the right kind of inflation number. So again, my personal take on this is that, it's a CPI X veggie, which should be the target of the policy. Of course, it's very difficult for people to intuitively understand. So, probably RBI stays with CPI as the target, but I mean, when they take actual decisions, when the MPC looks at it, I mean, this effect of veggie needs to be stripped out. And
I want to bring in Mridul on this, that another episode of inflation is the February 2022 policy. In February 2020, in December 2021, RBI's one-year ahead inflation forecast was 5%. In February 2022, it was brought down sharply from 5 to 4.2. And then in April, it was raised again back up to 5.1. So in between two policies, it just came down by 80 basis points. And I would argue that if RBI had kept it at 5 even in February, we would have seen the rate hiking cycle starting earlier. But because we did not do the rate hiking cycle before, we were forced to do an intermeeting rate hike in May that year. So I'm very curious that what prompted RBI at that time to suddenly, market was not expecting that bigger decline in inflation forecast.
So that was again another very specific thing because that policy where April they held and then May there was an inter-cycle meeting. So remember, this is not RBI. There's central banks all over the world. I mean, starting from the Fed, the Bank of England, Bank of Japan, there was panic there at that point in time. This was immediately after the Ukraine war. So the fear was that if a premature increase in rates for an economy just coming out of the COVID economy might damage the economy. But beyond a certain point, the evidence of inflationary pressures building up became so large at that point in time. Metals prices, food prices, everything had gone up. So then, I don't think I should share some more inside information, but that point in time, they were prepared for an inter-cycle meeting at that point in time, and they responded. They were trying to hold off as much as possible because with a view to avoid an unnecessary damage on the economy for an economy that was just coming out of the COVID cycle. But beyond a certain point, the pressures became so intense that they had to act.
So, I don't know, since this pertains to my period of an MPC member, maybe I shouldn't really tell you like what exactly were the dynamics of it, but in all honesty, there was this issue that basically what you were saying, there was fear in mind of many MPC members that a premature rate hike would stifle the recovery from the pandemic. And I think one mistake which was made was to think that they can recover all lost output in the pandemic. It's not possible. When the potential output falls, you have to adjust the monetary policy to the lower potential level. If there's an economic capital scarring which goes, you need to react policy accordingly. And there were policy options for an early rate tightening, but every central bank fell behind the curve. The Fed was massively behind the curve, and then they decided to engineer basically almost a recession in order to get back inflation down from 9% plus. And they succeeded by tightening the monetary policy. So these are the practical difficulties which arise at the time of the policy which happens. There could have been some market operations which could have been different, but that's what I leave it at the moment. But let me just turn this to Shailendra. Now, let me, since time might run out, we can come back on inflation targeting. But where do you see the monetary policy now in terms of market operations? If the rate is where it is, and the fact that you have a borrowing coming up, RBI hasn't yet to give the calendar. So what is the open market operation size you expect over the next fiscal, outright?
I think, I mean, I've seen various estimates ranging from somewhere between 2 to 4 trillion in terms of RBI's OMO operations, that, RBI will need to be more proactive next year also from a liquidity management perspective. My view is slightly different. I think next year we are going to see a very strong revival in the demand for government securities coming out of banks, particularly. So I think, like this year, the number is some banks will probably buy government bonds in the region of 1.5 to 2 trillion. I think next year this number will be 7 trillion or upwards of that. And the reason for that is, I think it came out in the morning panel where Neeraj Gambhir also spoke about it, that the kind of deposits banks are getting are not very LCR compliant. I mean, we are getting institutional deposits where we need to hold more government bonds, from a LCR and NSFR perspective. So I think given that, I think the banking system has come down to a level of government security holding which is extremely low, and it cannot fall beyond that. So I think next year the demand from banks will revive. Secondly, there were some one-off factors this year. I mean, one important thing was that the National Pension Fund, the NPS, their mandate changed, and they had to increase their equity allocation from 15 to 25%. And all that was achieved in the current year, and they are already reached that level. So going forward, we think that their demand normalizes. We think that if Bloomberg index inclusion happens in the month of June, then there's another $20–25 billion of government bond demand which should come in. So I think next year I am pretty sanguine about the demand supply for government bonds. So I don't think that there will be that kind of need. Maybe 2 trillion or thereabouts would be enough from the RBI's perspective.
So what are the forex operations you are assuming in this assumption?
So we have a view that the BOP will be in balance or marginally in surplus of about $10–15 billion. So which means that there won't be any not much of liquidity drain, which will happen because of RBI's FX intervention. So given that this year, I mean, we have seen an inordinate increase in the currency demand. It's running at almost 4 trillion for the current year on a YOY basis. So I think that number also should come down next year.
Okay, thanks. Samiran, very quickly, size of outright OMO, and should RBI leave exchange rate flexible? Because Shailendra seems to be suggesting that this was extraordinary forex year. Next year we may not have that.
Well, first let me say that estimating that OMO number is a triangulation exercise. It's a triangulation exercise because you can derive that number from how much durable liquidity RBI needs to infuse in the system based on your estimate of how much currency leakage will happen, how much FX reserves are there, etc. But you have to match that OMO estimate with the demand supply estimate of government bonds separately, because the drivers are often very different for that analysis. So you might, in years, end up with very different numbers from these two approaches. And this year, the approach that Shailendra was talking about is more the second approach, to take the thing from how much demand is going to be there versus how much supply is there in the market. And I agree that if you take that approach, then most likely you will see a much lower OMO number this year than next year than this year. Having said that, one element is that there is a new rule, LCR rule, that is coming from April 1st, which will reduce the demand for bonds also. But on the margin, I think I agree. The exchange rate question obviously will require more time, because I am definitely not in the camp of suggesting that RBI should allow the exchange rate to be very flexible. I am of the opinion that.
Are you comfortable with defending rupee the way RBI defended from October of 24 to maybe the first quarter of 25?
So for me, the currency should always depreciate to the extent of the inflation differential. So you should not defend to the extent that you don't even allow that much depreciation. But at the same time, you should not allow more depreciation than the inflation differential, because then depreciation begets depreciation. When depreciation happens, capital flow don't come to the country. Think of a foreign investor. He's going to put $1, which is going to be worth less than $1 in 1 month's time. Why would he put money into India?
Okay, let me turn to Saugata. We have to open the questions to the floor. Last, quickly, shortly, any view on the currency management?
No,
FX?
I mean, I have views on the currency, but I'm not going to talk about them here. You're eminent economists sitting here who can. But Samiran is absolutely right to that extent. Currency cannot be let go completely, because more than any other markets, the forex markets is susceptible to overshoots. So I mean, much beyond what fundamentals of the economy would suggest. Currency markets, because currency markets is not just India's economy, it's the global balance sheet, which drives currency markets. So currencies can move very sharply, then after a while they will revert back. But by that time the damage is done. So I mean, it's very, and RER, NER, what is a fair view, a fair value of the currency is a very complicated question, very naughty question. I mean, so I'm not a huge fan of.
Yeah, but if there's a strong dollar view in the market,
so I mean, RBI typically.
India's central bank capable
No. So I mean, initial research while I was at Axis Bank, we had done some research that typically when the Indian currency is driven by the dollar strength, by the DXY to the INR, RBI steps in more strongly than when it's a factor of other items on the. So when the dollar is weak, something that we had seen recently, the dollar index had weakened.
Okay.
Together with that.
Thanks.
So I think that differential.
So I'll open up the floor and maybe request Soumya Kanti Ghosh if he has any question now. And then I'll come to other people here. And we'll also invite from the other maybe students and stuff. Yeah, quick. Short question, short answers. Tirthankar wants to go first. Okay, go ahead. You can.
May I? So I want to address the elephant in the room, which was not really addressed, frankly. We have information asymmetry, IA, and then we have AI. I didn't see any discussion on the second one here, especially given the technology that was described in terms of prediction. And it is a mug's game. I fully agree with Samiran here. My question is to the panel. What is being done about this bridge that is available supposedly to us in terms of the information asymmetry? Today we have better models to understand. Why should we look at a 150 equation model, for instance, when we have much more data? I know data is difficult. I realize data is difficult. But we also have much better technology available today. So can a two-member team, as Samiran pointed out, do something that they were not able to earlier?
Quick.
How is this being used by the central bank and by...
Fast response.
Tirthankar, it's being done. I mean, that IDG model that I talked about, the vector autoregression, one variant of that uses machine learning, ML. So, I mean, it's been done. I mean, so it's not as if, I mean, that these things are not done. But these need to be tested extensively. Otherwise, the same forecast errors would come in, because these things are also very adaptive. The artificial intelligence neural network based models, they're learning. I mean, with new data coming in, they keep on learning. So it's very adaptive. But these need to be tested, very validated, tested, back tested, out of sample, very, very strongly before they're actually put out into the public domain. So, internally, this is being done.
To this, I mean, Saugata, essentially, the question you raised is very, very important. I mean, we would eventually head to real-time monetary policy making at some point of time as the large language models come up and they enhance the expertise of predicting in that sense. At the moment, the RBI had a lot of reliance on the nowcasting models, which were based on random forest algorithms. And in essence, I think after the Q2 of 2004 episode where it went completely awry, the RBI has reduced its reliance on that, if I'm not wrong. Now, RBI has also set up a full division to capture basically big data. I don't know how far it has succeeded in using it. Maybe he can throw some light whether any information comes to them from those models or not. The Fed uses it, the ECB uses it, but all of them are essentially using the same type of little better nowcasting and based on that. But a lot of further work will get done in this area, and maybe your question is a little ahead of time and it will come in that respect.
Just one small observation is that my work with AI seems to suggest that AI is very good at analyzing what has already happened. AI is still not good enough to say what is going to happen. So from a forecasting perspective, I think we are still some way off from using AI. But yes, something like, can you analyze 4,000 companies' quarterly result to derive an index of pricing power? That is possible. But that is on past data. That is not on future forecasting.
I just want to add 2 points. The first point is regarding that borrowing number, which you are talking about in terms of next year, the deposits of, they could, I think that's something which I don't know how it is going to pan out next year. Because if the overall borrowing number is close to around 27-28 trillion, and if the number will decline depending on how much this switches buyback. So that's one very crucial thing which is going to happen next year, I think. So that will actually have an impact on the yields. The second important point, what is going to be the defining factor is the reforms in the SDL market. I think a large part of the reforms has been suggested in this Finance Commission report just submitted. A large could be also done in the future, but I think some of these things needs to be taken along because there are 28 states and an union. So, and we have to be also fair to the states that the states don't have any other market than to borrow from the SDL. The states don't have access to NSF. The states don't have access to treasury bills. So basically, we have to be also fair to the states in terms of understanding their need. But I think if that part is addressed, the borrowing market could see some structural reorientation in the future. The second point on the artificial intelligence, I think I concur with Shomiran's view. I think just to make an analogy, I have been also looking into the different AI tools which are currently available in the market. AI is basically democratizing the entire landscape. So we remember that we all have Excel and Words with us, but I don't know how much of us are aware of the tremendous power the Excel has, the new versions. So at the end of the day, the democratizing of the tool is important, and it is AI.
Okay, I got your point.
Yes.
Thank you. It's important. I mean, the question I might ask you is, the Finance Commission has not really dealt with SDL reforms in that respect. You were the member, but it's a difficult thing. See, the risk-based insurance is being done. So can you do risk-based SDLs is a question you have to think.
No, I don't. So I think that we can discuss separately.
Okay,
that will create.
Fine. One last question from the students and we close. Short question. Anybody? Yeah.
India is on the path of becoming a $40 trillion economy by 2047. Now, if we have a long-term view, then as per the latest data of RBI, we have an external assets of around $1.19 trillion and liabilities of around 1.5. So we are negative $300 billion. So technically we are a debtor nation. So now if we look at total 180 countries in the world, there are 10 creditor nations and then there are 170 debtor nations. So my question to you guys is, by the time we reach in 30 years a 40 trillion economy, if we do a linear regression in 30 years' time, our NIIP will be negative $8 trillion. And that will lead to a debtor nation status in 30 years' time. Now, if we have a long-term view, what are the policies which we're making in next 5 years, which will be roughly around 2 monetary policy cycles to make sure our 30 years vision of being a $40 trillion economy with a creditor nation status, how will you do it?
Samiran.
All difficult questions will come to you, right? Come to me, right? So, I think
I don't, I'm not even sure where we will end up in 2047, but...
no, but I think the bigger question is that this NIIP being in deficit, this is a mirror image of the current account that we are running.
Yes.
Right? So...
And capital account.
No, I mean, as long as we have the current account deficit, that has to be funded.
Yes.
So then the capital flows will be required.
Yes.
So the good news for India is that from 2.5% of GDP current account, we have now come down to 0.5% of GDP current account.
Agreed.
So in a flow sense, we have addressed the problem to some extent.
Yes.
The issue is that in a stock sense,
yes,
the problem is already there because that stock, NIP is a stock data, right?
Yes.
So that stock issue will take much longer
yes,
to get corrected even if we are addressing the flow problem now.
Yes.
So that's the only thing I can say now over 20 years plus period.
Sorry.
Yeah, so if the flow, what you are doing is you are estimating the stock data for 2047 based on extrapolating the past trend
yes,
of the flow.
Yes.
But the flow itself is coming off.
Yes.
So once you do that adjustment, you will not end up with 8 trillion, you will probably end up with a lower number. But having said that, in countries who have moved into NIIP positive,
yes,
they have to at some point of time run current account surpluses.
Yes.
So that's the question, that what will it take for India to run current account surplus? This year's economic survey is all about that. In
Yes.
fact, goes to the extent of even suggesting that the current account surplus has to come from manufacturing. Only services-led current account surplus will not do. But I think the government gets it that this is the final objective where we have to go in if we have to get to that 2047 goal.
With a creditor nation goal.
Okay. Thank you. Very nice, interesting question and a good answer. So let's close it on that basis. Thank you.
Thank you, gentlemen, for a remarkably rich and technically nuanced discussion. We will now proceed with the felicitation. From NSE's side, may I invite Dr. Tirthankar Patnaik to present the NSE mementos to our panelists, please. Thank you to all our distinguished speakers. I would now request for the display of the winners of the Slido round, please. Kritika, Avanish, and Namrata Deb. May I request the winners to kindly join us on stage? Dr. Patnaik, may I request you to felicitate the winners, please? Please come up on stage. Thank you, Dr. Patnaik. I would request everyone to remain seated so that we can move on to the next session of the day. Before we proceed, a brief announcement. While the agenda would have listed a keynote address by Dr. Saurabh Garg, Secretary, MOSPI, due to unavoidable circumstances, he is unable to join us today. We look forward to engaging with him on a future occasion. We now move directly into the panel discussion titled National Output, Prices, and Industrial Activity, Getting the Barometer Right. I would like to call upon stage the panelists, Dr. Soumya Kanti Ghosh, Group Chief Economic Advisor at State Bank of India. As a member of the 16th Finance Commission, Dr. Ghosh has played a pioneering role in capturing payroll data in India and has contributed to the design of key pandemic interventions such as PM Kisan and the ECLG scheme. He serves on several national technical bodies, including committees for the revision of the Index of Industrial Production, the Wholesale Price Index, and economic classifications. Next, I would like to call upon stage Dr. Ranil Salgado, Senior Resident Representative for India at the International Monetary Fund. With over 27 years at the IMF, he has previously served as mission chief to Japan and India and has led work across multiple emerging and advanced economies in Asia and beyond. Educated at the University of Pennsylvania, Harvard, and Cambridge, he brings a truly global and multidisciplinary perspective to economic policy and surveillance. Lastly, I would like to call upon stage Professor Parth Ray, Director of the National Institute of Bank Management and member ACNAS. Professor Parth Ray has over 3 decades of experience in monetary policy and central banking. He previously served as the advisor to the executive director at the IMF and has held senior positions at the Reserve Bank of India. Finally, I would again like to call upon Professor Mridul Sagar to guide this discussion as well. Before we dive into the discussion, let us energize the room once again with a quick Slido round. Can you have the questions up, please? The QR code, please. Thank you. First question. The relationship between GDP at market prices and gross value added at basic prices can be expressed as. The second question, which survey conducted by the MOSPI provides official data on unemployment rates in India? And the correct answer chosen by 69% of you is PLFS. The next question, the GDP deflator is best described as. %91 of you got it correct. Penultimate question, which of the following is not one of the 3 standard approaches to measure GDP? %83 of you have gotten it correct. It is the monetary approach. And for the final question of this round, what is the proposed new base year for India's GDP and IIP? As correctly done by 47% of you, it is 2022-23. These are the winners. We now formally begin session 4 of this conference. Over to you, sir.
Okay, thanks. So this is a very informed panel that we have here. There is a member from the committee which is revising the GDP base, and so he is with us. Also, a member of the IIP committee is with us, basically Soumya Kanti Ghosh. And we have an international expert from the IMF. The IMF, which actually keeps quite a close watch on national statistics of all the countries and has set certain standards on dissemination and also on quality now. We'll come to the issues later, but what is happening is that base years of the key macroeconomic parameters, the CPI, the Consumer Price Index, the Gross Domestic Product, GDP, and the Index of Industrial Production, IIP, are getting revised. The CPI has already been revised this month. The GDP, the new base, will come on the 28th. The IIP may come in May. That will be April IIP number, but will be released in May. So significant changes in the macro statistics are on the anvil. Now, let me shoot the first question to basically both Soumya and Partha. We don't have a CPI committee member here, but both are quite avid users of the CPI, and we discussed inflation targeting, which is based on CPI. So basically, what was the problem, one or two biggest problems you had with the old base CPI of 2011-12, and now that you move on, to a new base in 23-24? Is that going to get resolved?
Thank you, Mridul, for inviting me to this opportunity, and thank you, Tirthankar NSE, for this one. To your specific point of whether there was any problem with that 2011-12, I don't think there was absolutely any issues with the series earlier. It was the the series we are using till now. I think the new series was launched only a couple of days back. The earlier series was based on 2011-12 consumption expenditure survey. The new series has been updated to the 2023-24 consumption expenditure survey. So I think that's the primary difference. But the best thing, and I think the CSO should deserve a compliment, significant compliment for enhancing the data coverage across macro variables this year. And I think if the secretary was there, he should have been, I mean, it's really a wonderful job the CSO has been doing. To the specifics of the new CPI, I think it's quite broad-based. It takes into account for example, on the housing side, it takes into account now the rural housing. It also expanded the number of brackets to 12 from the current 6. It also has taken e-commerce into account. So on all front, I think it has also reduced the share of the food, which was widely expected to below 40%. So I think on many fronts, and the most important thing that it is now using an updated Jovins index. So that means that you can actually add the new items quickly into the new series if you need to. So on statistical front, on coverage front, it has expanded significantly, and obviously this will reflect in the consumption realities, and as the data is actually progresses on a year-on-year basis.
Partha, may I? I understand for the students, between you and your lunch lies this discussion. So I suspect, Mridul put this instead of the appetizer, that this boring discussion on GDP is going to act as that. But more seriously, GDP estimation, pardon to the non-vegetarians, is like sausage making. If you see the process, you are not going to have it, but end of the day, on a table, it looks nice. So I'm sure all of you are bothered about the final GDP growth numbers, but none of you are interested in what went there. So from that standpoint, I compliment NSE and IIMK-NSE for putting this in terms of this information asymmetry. Yes, there's indeed huge information asymmetry. Now coming to the CPI, please note change of base is a very routine exercise. I mean, there's nothing surprising in that. The question is, as you are far from the base year, newer commodities come up, so you need to find out another normal year. Because of the COVID, the years around COVID was not exactly normal, so they have picked up the new base. They have picked up the new base as 2024. What are the improvements? And I should be factually correct, and therefore let me say it. First, the earlier CPI, there were 6 groups, and now there are 12 divisions, and this is in terms of the international classification of household consumption classification of individual consumption according to purpose, the COICOP 2018. And new additions, already Shomu has mentioned, rural housing, online media service provider, streaming service, value-added dairy product, Birdly and its product, pen drive, external hard disk, attendant, babysitter, and exercise equipment. As you understand, many of these are newer things. So these, when they came up, something has to be deleted. Something has to be removed. The items that were removed was the VCR, DVD players, hiring charges, radio, tape recorder, clothing second-hand, CD, DVD, audio, and choir room. With the new numbers, one remarkable thing happened, and that's rightly so. I would presume that will make the job of the monetary policy makers slightly easier. The weight on food is less now. That's standard. you understand the basic Angel's law, that as you grow richer, the weight on food comes down, and therefore the similar thing that happens to a nation as well. So purely in that spirit, it has come down. In terms of coverage, again, Shomu has mentioned, the number of items earlier was around 299, 300, and that has increased to now 358. And they have also started online price collection for selected items. So all things together, they need to be, CSO indeed need to be complemented. The other important thing is, earlier in rural housing, there was a gap. There was housing item, there was only the urban. Now they're increasing, they are using rural house rent for the first time. So all things together, this is indeed a very, very timely improvement, a very, very timely intervention, and the CSO and the MOSPI needs to be complemented for that.
Great. So that's very, very nicely explained, though basically the devils would be in details, but I think it's important. So let me turn this question to Ranil. How good is India's CPI compared internationally over how they're estimating? Obviously, this move to Koikas is actually a big step forward, but do you think now it would be completely in alignment with international expectations about the quality? How good is our consumption expenditure survey in the first place? Because that feeds into the weighting pattern of the CPI, and what Partha didn't really sort of, he knows about it, but he didn't mention that basically we missed one consumption expenditure survey in between on quality issues, which actually probably if the weight of food is falling now to a little above 40%, 41.2, but in that sense, maybe our inflation may have got overestimated if it was caused essentially food driven for that period. So that I'm just mentioning to the students to understand the importance of collecting the data right, because you tend to make policy mistakes if the data quality suffers. So that's why I'm asking this question to Ranil. How good is our consumption expenditure survey and the CPIs?
Hello? Yeah, it's working. First, let me thank Mirdul and Tirthankar for inviting me here to speak today. I'll start on this question. I don't think there's a major issue concerning about how India collects data, either CPI on an ongoing basis or in the consumer expenditure survey. Now, I'll put a little caveat on that a little later. The issue, I think, that Mirdul kind of pointed was the previous consumer price index was somewhat dated in terms of the weights. And exactly for that reason, it overweighted food, and in the previous session we talked about CPI ex veggies, it probably overweighted veggies. So when inflation was very high because of very high vegetable prices, it made it difficult for the policymaker, the central bank, the RBI, to, at a minimum there's a communication issue, right? How can you be cutting when inflation is above the target band? So that creates a lot of difficulties. In terms of what your target is, there's nothing wrong with what the RBI does. Almost every country that follows inflation targeting has a headline inflation target. But it is called flexible inflation targeting for a reason. You can use internally your guiding target as some measure of core inflation, perhaps CPI ex veggies. But that becomes more a communication issue, right? Because the public is more aware of overall CPI, and especially in countries like India, food inflation in particular. So the real issue with the past CPI that's now already been changed was it was dated and the weights were wrong. Now, from what we can tell, as my two co-panelists have mentioned, there have been substantial improvements. You can see what Partha mentioned, some of the things that dropped out, probably no one bought for years. So, or very few people bought for years. And the food share was far too high in the previous, and now that's been brought down. Rural housing has been brought in. All of these are important improvements. Now, I mentioned back, there's no major issue in how India does its consumer expenditure survey or its CPI data collection. But all countries face certain difficulties, and that's not that unusual, right? It could be non-response. It could be underreporting. That's not unusual. It may be even a little more complicated in a country like India because of the composition of the population. So I'll stop there.
So this very music to the ear in the sense because more lately in Article 4, basically there was a bit of a critique about the quality of data, more about the national accounts, but not CPI. So CPI, it looks like you're pretty comfortable with that. But has there been any departure in the recommendations of the expert group on the CPI from Brian Graf, which rendered technical assistance in this process of improving the CPI data? Or is it completely now in alignment of the IMF? It may be minor point, but whatever it is.
So again, this is by our statistics department, so I'm not an expert here. But to the extent so far they've looked at it, there's no major deviation.
Okay, that's great to hear. So let me turn to Soumyakanti. I'll come to your IIP thing later because that's common to me also. But anyway, we'll deal with it at the end because we both are doing the IIP-based revisions. Let me first ask him, being a market practitioner, what is the impact of the new base CPI on near-term inflation and on more medium-term inflation, in your view?
No, I think we have discussed it in the earlier panel discussion regarding the market movements. So I'll not repeat that, but let me just tell you, I think the new series, if you just took a dipstick analysis of the new series and the old series over the longer period, say for the last 5 years or so, using that adjustment factor, you will see that the difference between them is actually around 20 basis points, 20 to 25 basis points. So from that point of view, there is not much departure from the earlier series. So market has actually taken it very positively. And the second important thing is that there has been significant methodological improvements, which I said that because of the use of the Jovins index, it can now include the items quickly. And the other important thing is that if you know, when these new CPI series was announced, the yield actually declined after the release of the series because the most important factor was the core inflation. Basically, that's the metrics which all central banks look into also carefully, apart from the headline factor. The core inflation actually has significantly dropped in the new series because of a methodological improvement of keeping out the volatile gold and gold metal prices, precious metal prices, which is going to be, which is a very important innovation from that perspective. So if I take this and the fact that there has been research which shows that there is a convergence across headline and core over a longer period of time. So if I take all these factors into account, I think given that the new series is a replica of the old series in an enlarged form, in that it includes items of consumption which has become more necessary right now and change in the last 10 years, I don't see there will be significant impact on the markets. Markets are driven more by noise, other news, other factors, which are actually sometimes not within the remits of the central bank policy actions or the market participant.
Let me raise the issue of housing in the new CPI. So basically, and of PDS. These were two of the debatable issues when the new CPI was being dealt with. So you go ahead. Take it. You seem to be. No.
Housing, I have a take. I mean, this is perfectly fine to take the rental value. The only deviation from international norms there is that we do not have imputed value of owner-occupied housing. That should have been there. We are yet to go there. That's an effect. But when it comes to asset price, I'm perfectly fine. In the sense, CPI is not a reflection of asset prices, and legitimately so. If for any policy purposes, the central bank or anyone wants to follow what's going to the asset price, a separate index has to be developed. But as far as in terms of prices of the flow of commodities defined over a year or a quarter, I'm perfectly fine with the rental value, and asset has a different purpose. You develop another asset price index and follow that, but that has nothing to do with CPI.
Okay, and state-owned houses, like to basically people who are allotted the state-owned houses, how do we deal?
Again, as I said, the imputed values are often not given, so therefore in terms of state-owned houses, there has to be an element of this. And as you understand, as far as government servants are concerned, after the last pay commission, there's a substantial amount there in terms of state-owned
Some
houses.
have free PDS, free food.
No, I agree with you. I think something which is free and which that should be. I mean, there was a concept paper which was floated earlier, and I agree complete with the view that the PDS prices should not be considered because something is free, and that, I mean, at the end of the day, it's a decision which has to be taken in the wider interest of the overall price index. I think from that perspective, I think the decision was well taken.
Sorry?
The decision was well taken that PDS items not to be included.
Not to include.
Something
It's
which is
also
free and which is
consistent with the international
because that
practices.
creates, yes, that is an concept international practice, and that introduces a systemic bias in the prices. It has happened in the past also.
Okay, let me turn to Ranil, and we start with him on the GDP issue because national accounts were graded C grade to India in a 4 grading system of A, B, C, D. The quality issues were raised by the IMF. They had actually, to be honest, raised it not just this time around, but even in the previous Article 4, if I'm not wrong. But in India, people don't tend to see the importance of statistics at that stage. But when all this revision is occurring, everyone seems to be jumping, and sort of it had a lot of political connotation. So let's avoid that and try to understand why the C grade and what can be held to improve.
So let me put it this way. We were quite surprised it got a lot of attention this year. So the IMF changed how it looked at data because our executive board wanted us to do a deeper dive into whether the data was adequate for what IMF calls surveillance, which is basically monitoring the economy, using developments in the economy to then have a discussion with the country authorities. Then we all put this all together in what is called a staff report, which is then discussed by our executive board. So one of the roles of the IMF since it was founded in 1940s, 47 I think, is this peer discussion at our executive board where you get inputs from other countries, and the idea is this peer discussion will help influence countries' policies to the extent, and this is particularly important for the very large countries that have large spillovers to the rest of the world. So India benefits a lot from these discussions because they get to give their inputs to discussions about the United States, the European Union, etc. So a few years ago, I think about 3 years ago, our executive board wanted us to do more in terms of looking at the data. So this C grade first came up a couple of years ago, but no one noticed. It was in an annex. For some reason, this year they noticed. But also in both staff reports, there's a separate annex that discusses all the good things MOSPI is doing right now, right? Whether it's the CPI revisions, which are already in place, or IIP, where Mudul and others have been involved, but also the national accounts. And I guess we'll see the answer on the national accounts in less than a week. But I can go into what were our concerns in terms of the national accounts. The main one gets back to what I already said about the CPI, is that the base year is outdated. So think how much an economy will change over, it's more than a decade. The base year will move up more than a decade. So think how almost any economy, how much an economy would change over a decade. On top of that, you have India, which is a fast developing country. We like to say, you know, the fastest growing large economy. Sorry, the fastest growing largest economy. So for every country, things are changing rapidly. I mean, back in 2011-12, probably few of you had heard of artificial intelligence, right? Now that's becoming a big issue. But over time, you've had artificial intelligence incorporated, even though it's made headlines in the last 2-3 years, into various activities that individuals and companies do. So one was to look back at whether the weights were appropriate, as we already discussed with the CPI. Then second was a concern about how real GDP was calculated. And it's really here the issue of the deflator. So lots of elements of real GDP are first calculated by looking at the nominal values and then deflating them, meaning, I think most of you know what that means, deflating those values. So the concern there was how they were being deflated. So the perfect way to do it is deflate separately output and input prices. India was, except for, I think, agriculture, was not doing that. So that was leading to some biases, sometimes up, sometimes down. When I was working across from Mirdul from 2017 to 20, we thought on average those balanced out over the longer term. So on an individual year, you could have an upward bias or a downward bias. Over the longer term, they should roughly wash out. But that, along with this base issue, it became unclear whether they were still washing out. So it was important to, one, update the base year, and two, to the extent possible, update how deflation was being done. So the perfect solution already mentioned was to have both input and output prices. You need a very good producer price index to do that. That's not easy to do. Even in other countries, especially emerging markets, it's not easy to do. So my understanding of what MOSPI will do in the new series is they will do a combination of some double deflation where they can, but more volume extrapolation. So working back from the volumes and extrapolating that based on indicators. So still India needs to follow up with improving producer price index so you could get to that ultimate point where you have double deflation. The second issue was, I think earlier in the day there was some discussion about the discrepancies, the statistical discrepancies between the production side and the expenditure side. You have had some substantial gaps between the two, and is to try to narrow those. And here, it's again a technical issue. You need to develop supply and use tables on an annual basis. That helps you try to narrow the gaps. Again, what I understand is MOSPI is making progress with that as well. And then the final major issue we had was lack of seasonal adjustment for the series. So, the United States, the advanced countries, will not only produce an unseasonally adjusted, but the main thing they produce is a seasonally adjusted series. For India, that has proved difficulty, I think mainly because of the agricultural cycle. At least that was when I worked more closely with the data. That really led to the complication in terms of producing a seasonally adjusted series. So I will look forward to seeing some progress on that as well.
Thank you. I think this is wonderfully clarifying the issues which existed, because there was a lot of haze about this whole thing. So over to Partha, because he is the member of the advisory committee on national accounts.
First,
how far have you solved all these?
No, so before that, I have a comment on Ronil, and he has not promised me to treat me for this. In the IMF assigned the C grade while it assigning, you should remember that it gave India B for granularity and A for timeliness. So the C thing, which has been hugely over-exaggerated in the media, missed this B in terms of coverage, A in terms of granularity, and A in terms of timeliness. The essential question was that of the coverage. And Ronil mentioned number of things. The primary thing perhaps being this is double deflation. For the benefit of the students, let me explain. In national accounts, in calculating GDP, you calculate the value added. Value added is a final output, the value of the final output minus cost of intermediate inputs. Now, do you deflate them in arriving at the real series separately or use the same deflator? This is the question. The ideal solution will be to use different deflators for input and output, but unfortunately we did not have, Ronil mentioned, a good producer's price index, and therefore this was an unhappy compromise. In the committee meeting, and it will be unwise for me to predict because these numbers will be out only on 27th, there was at least 3 days detailed discussion on the double deflation method, along with the different constituent departments. So each department of Government of India came and we discussed in terms of what is feasible. So end of the day, as you understand, as Keynes reminded us, it's important to be roughly right than precisely wrong. So in that spirit that was taken, that whatever is feasible, the first base is double deflation, and Ronnie will be happy to know number of sectors have been covered now with double deflation, but some of the sectors also single deflation remains. So I would be, I would expect that it is in the next assessment of India's statistical system, this C will come with a glorious A.
Yeah, so actually I had predicted in Delhi stakeholder meeting went public that we will have an improvement in grading. I won't force you to give a view on that. We will wait for a year. But before we go that route, let me have more clarity on where the double deflation and where the single deflation stays. Manufacturing, yes, you're moving to double deflation. What about services? What is feasible, not feasible, that you don't have a service price index, and how to deal with that?
Yes. So I can only say this, that the new improvement will not cover all the sectors in terms of double deflation, but it's an improvement over the last 2011-12 series, and this is a continuous process. It's not that completely single deflation to double deflation we will transform, but large number of sectors will be covered by double deflation, and there are elements, there are huge issues about services sector.
Okay, so go ahead.
Just one more thing, I think, which you have doing, but you have not, I think you may not have just, you are also doing disaggregated in double deflation, because for sectors like export-import. So that is another revelation. This apart, I think the other thing which the CSO has been doing is the reconciliation of the volatility in the quarterly series by using a proportional input method. Earlier so basically the share will now remain the same along the output. So that actually will reduce the noise in the quarter. So these are other things they are also doing. To your specific question on the service sector, I think we are actually I'm also a part of a committee that is looking into the service sector. The problem in the service sector is that I think there is two distinctions. One, in the financial market service sector, there is a non-financial market. In the financial markets, for example, the regulators like SEBI or the RBI, most of the data are published on a quarterly basis. So therefore, the monthly is not available. But on the non-financial side, for example, the telecom or the civil aviation, they are published on a monthly basis, but the base years are actually different. For example, for telecom, so that is one. So basically, at the end of the day, it will not be possible to combine the service sector into a comprehensive service sector index. So therefore, that problem will remain. But interestingly, I think in a couple of months' time, maybe after the IPCD is released, there will be also the release of the service sector price index, possibly across several disaggregated indicators, and that I think could clear a lot of, I mean, that could show, that would be a very interesting the data to see how the progression of India has moved in terms of the distinction from manufacturing and services.
Okay, on a lighter vein, it's very difficult to find out an input cost of public administration.
Okay, let me come now to more often we hear this critique that there is slowly becoming an over-reliance on high-frequency indicators for the GDP calculation, and that comes at the cost of capturing the informal sector. The formalization process in the economy is not getting correctly captured. Did this issue come up in your committee? Was there any thoughts how to address that?
Yes, this particular discussion about high frequency indicator, big data, all have discussed in the committee, and selectively they were taken. But as you understand, that often these things people suffer from, people like to have the data subjected to a smell test. And depending upon where you are from, the smell test might differ. Therefore, often anecdotal evidence about GDP or prices may be at variance with the more seriously constituted data. Now, this high-frequency indicator might add certain value to it. At the same time, it adds the data, makes the data hugely noisy. So, end of the day, it is the statistician, the national accounts compiler, there will be certain judgmental issues. Look at all these high-frequency indicator, but make certain synchronicity with the more traditional approach to this, and then that we should act as a cross-check.
Yeah, what formula for capturing either the formalization process or the informal sector economy, what more high-frequency indicators can you suggest, Soumya?
No, I think on the informal sector, let me make it very clear that in 2025 November, the new NIC classification has come out. So that in itself actually will take a large part of the problem. This covers the digital part, this covers the e-commerce part. That's a very comprehensive classification. So that's point number one. The second point is that now the CSO has started giving the annual survey of unincorporated enterprises on a quarterly basis. So that I think used to have an annual basis. So that I think is a huge data which one can use to understand the movements in the informal sector. And to the third point, I think IMF in 2017 talked about this proportional benchmarking method. I think earlier we used to do the other things. So we used to, yes. So that I think that is one of the ways to look into this linking between the noise and the other things. But overall, I think most of the aspects, and as also Ranil pointed out, has been taken care in the CSO. Of course, there will be point of improvements in the future because IMF has come out with the new, I think that we can discuss if we have time, BPFS manual, other things, which the RBI has to adopt, and then that has to be adopted by the NA. So those are separate things, but I think overall, we are on the correct path in terms of data dissemination, in terms of enlargement, formalization, and coverage.
Okay, thank you. Very quickly, Ranil, how many of the emerging markets are able to capture service sector with a double deflation? Any significant, I know Brazil does something.
Right. So I actually checked, but I didn't get a full answer on that. Brazil is the one country, I think, that does a very good job. They have well-developed supply and use tables. They have mainly do double deflation. My guess is this is a fairly comprehensive issue. They referred me to a report on the IMF website, but I'm not sure we have the full answer on exactly how many countries fully use double deflation. Now, many countries like India already use it in some form, right? There are a few that use it comprehensively in terms of
So how does
national
Brazil
accounts.
capture the service sector prices,
So,
input and output both?
the service sector prices, I'm not as sure, but in terms of their national accounts, they do have supply and use tables on an annual basis. They're actually now, Brazil chain links as well. So they use the supply and use tables to chain link their GDP. Chain linking means every year the base changes, right? So it's ongoing adjustments in the weights. The benefit there is you're tracking the economy well. The negative there is things don't necessarily add up when you look at an annual basis. In terms of the service prices, I'd have to check how well Brazil does that.
So probably that's why you give Brazil A grade and we get C grade. It's
So
essentially the double deflation
on
issue,
national
or
accounts, it's the
there
double
are
deflation and using supply and use tables.
Huh?
It's the reason Brazil gets an A grade on national accounts is because it has double deflation to the extent we think is appropriate, and it uses supply and use tables.
Supply
and use tables.
Okay. So that clarifies some things. Okay. You want to add something? You're
On the
looking
informal sector, as Shobmo said, the very important source is this annual survey of unincorporated sector enterprises, ASUS. That's a goldmine of information. The students may like to have a look. That's a very important thing. In fact, in terms of two very important additional information, one is this ASUS, the other is, of course, PLFS, the Periodic Labor Force Survey. These two have emerged as when we were students, and now these two have emerged really as very important data sources for Indian economy, where very contemporary information may be available.
Maybe I think there could be a quiz for the students over here. You look into the PLFS survey and found out there has been always a saying in the India that India's labor market 5% is formal, 10%, but I beg to differ. I'm just giving you the hint. I beg to differ with that number. This number is given in the PLFS how much of India's labor market is informal and formal. You'll be surprised to know the difference. I think you can find out from the reports, and this could be a quiz for all of you.
Okay, so good suggestion, but let me raise a larger question. When economy grows fast, the pace of structural transformation of the economy also picks up. And over a period of time, basically agriculture loses its share, and eventually manufacturing also loses its share, and it essentially becomes a service sector driven economy. Like economies like UK have 80% contribution coming in the GVA from the service sector. India is already at 62-63%. And India somehow also is about kind of wanting that manufacturing should improve its share, which looks a trifle difficult thing given that structural transformation itself is a phenomena of development, and we are developing. Now, the point is, we are not having good indicators for the service sector. I mean, I'm very blunt on that. Maybe I don't know whether you have a different opinion. We neither have a good volume indicator nor service production index. There are countries which have service production index. We focus on index of industrial production, which have been assigned to me and Soumya, to be jokingly. But eventually what we need is the service sector indicator. Or do you think we should have one production index combining industry and services? Ranil, what do you say on this?
So I don't think there's an issue with having a separate IIP, right? The two of you have been working on that. Yeah, no, it is not easy to put
Ranil has saved my job. Okay.
And I think other countries have different measures, right? You put it all together when you construct the national accounts in some sense, right? So if you look even at advanced countries, they'll have some measure of industry and some measure of services. Even the surveys that you do, one is a manufacturing, then you have services surveys as well. They're very different, so I don't think it's needed necessarily to have just one index. But I agree, it is not easy to put together a services index, right? It's especially in real terms, right? Because services, you can get at least some evidence of what is happening in nominal terms. It's not easy even to capture that, but at least in advanced countries, you can probably capture that better. So again, it is to determine what are the appropriate prices, right? That is the key issue. And that is why we think it is important to develop a very good PPI, including PPI for services. So I'll stop there.
Partho, you want to add?
No, nothing
Okay.
on that, but I
So-
thought you and Shomo should shed some light on the new IIP.
Okay, so the new IP is coming last. So we have still not taken a few critical decisions. So they will come through very soon, but honestly, we haven't taken the critical decisions. And in essence, what we are trying to do is to capture the more sort of current production base, and we have already put out some working papers, discussion papers in public domain, which we do expect people to comment on to make us wiser. Now, the point is, what is the biggest problem with IIP is that production sector structures change very rapidly, more rapidly than in GDP or any other, even CPI weights or anything like that. So we have Industry 4.0 or whatever. There are this creative destruction phenomena where basically industries change their production lines, factories close, new factories come up, and IIP becomes obsolete very fast. Because if there have been cases we have seen a factory which stops a production line of a chemical and substitutes with a more value-added chemical, suddenly you'll find, because that's not in the index, you have to zero it out and you miss out on the production. So we are thinking of substitution of factories to be allowed. I don't know what Ranil will say on that. We are also trying to introduce chain-based indices, and deseasonalize indices. So let's see where we end up. There is a lot of struggle in terms of the data. It's when you sit with the compilers, you realize how difficult it is for them. A lot of data comes from administrative ministries, and what administrative ministries do become fait accompli. They have to tally it with the annual survey of industry. So that becomes a constraint over what commodity you can include, you cannot include. So it's not going to be an easy process. Another issue which comes up is whether we can use, we don't have a business registry, and I'm banking Soumya to suggest something how to develop business registries, because that is where the crunch lies in improving the database. But one option is you use tax data, which many countries use. But how good is the tax data in India? Are we sure about it? Is it going to be available? The sensitivity of it, basically, because it's basically proprietary data. So all these complications do exist. It's not going to be easy. But what is your view, Ranil? How do we go about it? Yeah.
So I think in terms of substitution of factories, that's clearly important to have. That would be international best practice as well. And then the other one, I think, is when you have missing values, to have some methodology for imputing those missing values. So I think those are two of the key things. Yes, in terms of the factory.
Yeah. In fact, that's one issue we are considering. IIP, the notion that IIP should be volume-based index has to slowly give way, because you have to move to the value-added system, because
Exactly.
that's where it is. I'll try to explain to the students how complicated it can get. Ready-made garments. Now, ready-made garments would include a hanky you are carrying in your pocket. You count that as one, and it may have a designer wear you are wearing, that is also counted as one. So unless you have a value coming in, the data can get very biased. So that's the complication that exists in many sense. So we are heading that way, trying to do as much as we can. It's going to be a multi-year phenomena, but we want to make a beginning. Some may you want to add on these issues?
I think you have added most of the points. The important factor is that the other thing which I think the committee is also we are doing is that we are ensuring continuity in the substitution factor also. So there is a 12-month overlapping one, so that so even if and there is also some criteria I think is being put. The substitution is basically the factor is producing the same item or in the group, so that there is no drastic changes in this factor is another thing. So these things have been taken care of, but at the end of the day, hopefully, I think it will reflect the realities as it is today.
Okay, let's open the floor because time is running out. Questions from the floor.
Any questions from the audience? Can we please provide him with a mic? Can you please raise your hand so that he knows?
Hello. Yeah. So my question is on the rating of India that goes to C. So if I'm not wrong, I went through one research work by Prachi Mishra from Ashoka University, and what they've empirically proved that is that whenever the rating agency, in particular S&P and Fitch, what they do is they give higher weight, in fact, very much higher weight than the on date in comparison to the primary balances. In fact, the weight is actually sometimes 9 times higher than what theory suggests. So how, I mean, in your case, when IMF is giving this rating C, is it actually like, how are you giving it to? Are you like factoring in those date and primary balances, or, I mean, what's the process?
So this is actually quality of the macro statistics that they are rating. That process is very different from sovereign credit rating or a bond rating. But yeah, so there is this.
How good the number is. This is nothing to do with a company, a corporate, or a country. A particular economic variable like GDP, how representative it is, whether it is in the norm of international norms.
Okay, let me turn this question to Ranil. Forget about IIP, GDP, and CPI. What about quality of our other macro statistics, especially fiscal and external sector? Do you have any observations on that and suggestions on that?
Right.
And especially the fiscal part.
Yes. So the issue on fiscal, first of all those sectors are better rated. I believe they're Bs across the board. Overall, India's, except for national accounts, India gets either Bs or As, okay? So most of India's statistics, even in this assessment, are rated well. And again, I'd like to emphasize, the C is a backward-looking indicator. We will see changes coming up in a week even. And in the past 2 years, we've tried to highlight that already there were steps being taken in train to improve that C. But going to other statistics, in terms of fiscal, and Bill is asking me about all of them, but fiscal I know well. So fiscal, the real issue there is not the central government, it's the other governments, right? You have the state governments and very little data on the third tier, right? So in terms of the state governments, sometimes the accounts are not as timely as we'd like to see, but the biggest issue is the consolidation of the center and the states. So in the IMF, we have a general government number, and it's very difficult for us to be able to have a consolidated number even for the previous year. And that, in the old days, and the RBI tries to do some of this in the state report on finances, I forget what it's called, state finances report. But in the old days, even the Ministry of Finance would produce some consolidation, and we like to see more efforts into consolidating.
So you want us to go for the PBSR, the public sector borrowing requirements, or just the general government?
Step one is just general government. Well, they're components of general government, right? First, it's center and state. So the first step is to have a consolidated center and state balance sheet, which actually the IMF in our reports calls general government. But a true general government would also include the third tier as well. So you have it across all three, and we have little information about the third tier. Public sector borrowing requirement, I don't think is really, very few countries can do it. It's complicated to do. Some of the state-owned enterprises are actually profit-making, right? So I don't think that's as urgent. In the long run, maybe you want a consolidated public sector accounts as well.
How do you count the SPVs out of the state-owned entities?
So right now they are not counted, I believe, in what we have. But again, some of these, I mean, we face this issue in other countries, not just India, right? Okay. So this is...
I just want to add one point to what Ranil mentioned. On these public finances is well appreciated. I think the issue is that central government public finances have moved a lot in the last couple of years. It is now, everything is now on the table. For the state governments, 28 state governments, for example, one of the items is off-budget borrowings. So all these things have this, if this is disclosed in the budget, I think large part, that I think will create a mode. And regarding the local bodies, I am completely agree. A number which is for everybody, tax to GDP ratio of center is 12%, states is 7%, local bodies is 0.4%, where rural is 0.002 and urban is around 0.3. So there is no
thank you. I think the times is up. We had the last word from the 16th Finance Commission member, so I think we can close on that basis. Thank you all for the interest shown.
On behalf of the audience, I would like to thank the panel for such a deeply insightful discussion. We will now proceed with the felicitation. From NSE's side, I would again like to invite Dr. Tirthankar Patnaik to present the mementos, please. Thank you to all our distinguished speakers. I would now request for the display of winners of the Slido round for this session, please. It's Kritika again, then Aditi Gupta and Om Pathak. May I request the winners to kindly join us on stage. I request Dr. Patnaik to felicitate the winners, please. Ladies and gentlemen, we now break for lunch and we'll reconvene at 2:45 p.m. Thank you. I'd request everyone to kindly settle down. Welcome back, everyone. Our next session moves from macro measurement to digital architecture, examining how technological transformation intersects with personal data protection, regulatory frameworks, and financial markets. I would like to call upon stage the panelists for this session. Shri Vijay Shekhar Sharma, founder and CEO of Paytm. Shri Sharma has been a central architect of India's fintech revolution. Under his leadership, Paytm has expanded from mobile payments to a broad suite of financial services, catalyzing digital financial inclusion at scale and reshaping consumer access to credit, remittances, and savings. The next panelist is Shri Behram Vakil, founder partner at AZB and Partners. Shri Vakil is one of India's leading attorneys in restructuring, insolvency, infrastructure, and project finance. He played a significant role in drafting India's insolvency and bankruptcy code as part of the Vishwanathan Committee and the Insolvency Law Amendment Committee. The next panelist is Shri Dilip Asbe, Managing Director and CEO of National Payments Corporation of India. Shri Asbe has been the Managing Director and CEO at NPCI since 2017. He has been instrumental in scaling UPI into one of the world's largest real-time payment systems. Under his leadership, NPCI has scaled UPI into a global benchmark and expanded through subsidiaries such as NIPL for internationalization and Bharat Bill Pay for bill payments. The next panelist on the stage is Dr. Ashok Thomas, Assistant Professor of Economics at IIM Kozhikode. Professor Ashok Thomas, prior to joining IIM Kozhikode, was a doctoral researcher at the University of Pisa, where he also earned his PhD in economics. His research spans pension economics, household finance, and health finance. Please join me in welcoming the moderator for this session, Professor Rudra Sen Sharma, Professor of Economics, IIM Kozhikode. Professor Sen Sharma is an applied economist with research spanning banking, financial markets, and regulatory policy. He holds a PhD from IGIDR Mumbai and an MS in quantitative economics from the Indian Statistical Institute. I'd request the panel to please gather for a group photo. As before formally beginning the session, let us kindly have a quick slide around again. You can scan the QR code or you can go to the website and drop in the code for the program, which is #IIMK-NSE. I think we can begin with the questions, please. The first question: privacy concerns become more serious in investing platforms when? %92% of you have gotten this correct. Moving on. Tokenization in card payments primarily helps because it Again, 91% of you have gotten this correct. The next question is, which statement best compares tokenization versus masking? Again, 91% must I say. The penultimate question, the Digital Personal Data Protection Act 2023 mainly focuses on privacy and responsible data use, 93%. And the final question, replacing sensitive data with random non-sensitive values is called? Masking, only 18%. Thank you for your enthusiastic support throughout up until now. I would like Professor Rudrasen Sarma to now formally begin the session. Please, sir.
Thank you very much. So hope everybody had a good lunch, but we'll try to keep you awake. You know, post-lunch session is the hardest, but I have the responsibility of shaking you up. So a very interesting topic and very distinguished panel. You know, we have a legal luminary, we have the mastermind of digital public infrastructure in India, and a fintech pioneer. So when we think of financial services, obviously technology has transformed the way financial services are delivered in many ways using AI, blockchain, mobile, computing, etc. And all this ends up collecting huge volumes of data. And that's what we are going to discuss about. And you know, as an economist, you know, I always wonder, you know, what is the role of data? Is data an input in the production function? Or is data a quasi-public good because data has non-rivalry characteristics? Or is data a personal property which is to be guarded through property rights? And of course, you know, when it comes to data, there's an issue of trust because financial stability, you know, depends on users' trust. So all these things come together in this panel where we will be talking about data privacy. Particularly, you must be aware that the world over, laws have been introduced to protect data of users. So Europe's General Data Protection Rules, GDPR, then also in other countries like China, Brazil. In India, of course, the DPDP Act, the Digital Personal Data Protection Act, has finalized the rules in November last year, and it's in the process of being implemented in the country. So we would be discussing, you know, what are the implications of data privacy laws and data handling, user consent, and the technologies that enable it. What are the implications for markets, for the economy, and for people? So that's our discussion now. So I'll start by requesting Mr. Vakil to give us, you know, a broad overview, a higher level overview of the DPDP Act rules, and how do you think, sir, it compares with other such acts or rules that are there in other countries? So in terms of the balance between a over-cautionary or over-protective law and a law that enables innovation, how do you place our DPDP Act?
Okay, thank you so much for this wonderful opportunity.
I think, depending on your perspective, and I am going to ask you a question by show of hands, also to keep it interactive. You all have been listening for a long time. So I would say that it is largely based on the European model of GDPR. I think it's closest resemblance that, but it is even more stringent than that. So it depends how much you value your privacy rights. I'm sure that for both Dilip and Vijay, I don't know if they think it's a good thing that it's even more stringent than EU, which is known to be a pretty strong regulatory environment. And I will also tell you upfront immediately that there, the consent requirements are not as onerous as they are under our DPDP rules. Our DPDP rules are very much based on consent. And I think once again, the government perspective, but I would love to hear your views on this, is that India doesn't just live in our metros. India largely lives in our villages, and therefore you have to be even more protective than you need to be in Europe. And therefore the consent requirements are detailed, they are use specific. The exemptions that are there in GDPR or in, say, a Singapore or Japan. I mean, China, as you can imagine, is a different regime. But even if I compare it to these, it is more onerous. Even the legitimate interest exemption which is there in GDPR is narrowed in India to legitimate use. But the question I wanted to ask you, just to make it also, less legalistic and more contextual, is the world. One thing that India is very focused on, and I'm sure all of you will agree with that, is for children, it has to be very stringent, because the bad side of the whole AI and this insane amount of data that you're flooded with is that it can have a really, really negative effect as well as a positive effect. But on children, the negative effect is something that as a society we have to protect. So countries like France and Australia and New Zealand also now are, they use the word ban social media for under 15. First of all, it's not banned. The age limit was 13. I don't know how they figured out 13, and they have increased the age limit from 13 to 15. So it is an increase of the limit, not a ban. As for India, just to get a sense of what the audience thinks, do you think we should, again, because of the massive summit in Delhi, they asked, and the French president was here, so he specifically asked that India should also join this Committee of Nations and we should not allow our kids to be engaged in this. What's the view? Should we increase the age from 13 to 15?
The older people seem to have raised their hands,
And
not the younger ones.
we should leave it at the age of 13?
Leave it unchanged at 13? Show of hands?
Nobody? Okay. But you want to leave it? Hike it to 15. Oh, okay. So even higher than. So I mean that's the sense of it broadly, but of course we'll get a chance to discuss more in detail.
Okay, thank you, sir, for setting the context. And it's interesting that you say that India's DPDP is more stringent than Europe's. So then, of course, we need to talk about the implications, for which I'll come to the other two panelists. So moving from legal to the infrastructure side for digital payments. So in terms of the implications, Mr. Asbe, how do you think it impacts NPCI in general or digital payments systems in India? Do you think it's going to slow down onboarding, or will it increase customer trust and therefore is helpful?
So
I think first of all, one difference which I have noticed as far as the GDPR and India is concerned, I think there is a risk-based approach on the size, shape and form. I think that's one change. And second thing is they have also allowed the regulator to also participate in defining the rules further to this. So it kind of acts like a minimum kind of boundary. But, for example, RBI's data localization for the payment system, right? Payment system data assuming to be more sensitive and critical. So it kind of fits in well with the government making a law and the sectoral regulator playing around on the over and above that. So I think that's one thing which I like about it. See, look, I think any law or regulation, right, which is primarily created to create the trust in the ecosystem, right? Today RBI controls the assets, creates the rules and regulations around it. Similarly, SEBI has on a Companies Act and variety of other, the IDA on insurance. I think the regulators or regulation job is to create a trust in the ecosystem. Yes, the ecosystem it increases some sort of a compliance cost in the ecosystem, but in the long run, it always proven to be a very important activity, important discipline to be abided by the stakeholder. Because, one bad apple can actually spoil the whole party. And I think the objective of the law and the regulation to ensure that the market and ecosystem is behaving orderly. And most important, it protects the citizen. I think that is the objective. That it is a primary responsibility of the government and regulators is to continue to protect the citizens irrespective of the need of the hour, right? In that sense, the need of the hour could be innovation, and that's where the regulator calls it responsible innovation, right? So I think it's never. And I think while we have put the law and the rules, I believe that the law is fairly simple. If you really look at it, the rules are created extensively. So I think now it gives the opportunity also to the government to continue to keep evolving the rules over the next 10 to 20 years' time. And it will take some time to stabilize in that sense.
Thank you. Let me turn to Mr. Sharma. Paytm, as we know, has revolutionized digital payments in India. But what is going to be the impact on fintech or on Paytm? What do you think in terms of data governance, user consent, security infrastructure? How are you looking at it?
Yeah, first of all, to the question that sir asked, the age should not be 15. It should be 16. Because 15 is also a naive age, in my opinion. And you should not take a decision about, for example, like, because you are from law and you would know this, that 18 year is considered as an age of adulthood when you can sign on your behalf. Then you're publishing on your behalf. What you're publishing, you do not know the repercussions, and what you're consuming, it is more addictive than many other drugs or very other substances that you can talk about. So it is extremely, I mean, I rather would want to say this. What is the advantage that you're getting on it? And social media is not necessarily the perfect media. I would rather say that you need internet access for certain things, but not necessarily the social media. I mean, I'm totally against it, absolutely against it. It's no confusion. And India, as a federal, should join plus 16 year, not state-wise, as we are discussing right now. So that's my point number one. And as sir is asking, what happens to the fintechs or the financial services ecosystem if Data Protection Act comes in the play? The best part is that financial sector is one of the most foundational sector, as we all understand. Everybody needs a formal financial system. These bad actors that Dilip is talking about, remember the case of Chinese loan apps some days back, and so on and so forth. So government and regulator needs tools and responsibility of state that I'm able to curb those things or misuse of things or not let the formal financial system's value get compromised. It's a very critical thing. I'm going to say everything that supports that, whether it is today's, let's say, DPDP Act or tomorrow's some other act, it is an important asset. So the fact that we are in a formative years of economy where we want more trust to be coming in financial system and formal financial system, it is even more imperative and important to have tools and responsible and acts that give the more power to that responsibility. So it's good for the overall system when you do not have, let's say, quote unquote, if I could use the word informal, or I mean, informal is the wrong word, I would say underworld. You know, that kind of word. I mean, if you want a law and order of system, you don't want somebody who's playing not by the law and order that you want, and there should be an act that stops that. So it's not just good, it is necessary and obligated. So in my opinion, this will give access to the formal players and the responsible players, and it will give them more legitimacy and acknowledgement, and that will grow the sector. So growth of sector is not just challenged by the, let's say, certain things, the rules and regulation, it also empowers the sector to become more formally available. So it's net positive, I'd say. And I have one extra line to add to it. Typically, tech word, when we call it fintech, they consider that, oh, regulation is bad. And I would rather say it in a different way. The regulation is the obligation that makes you a player. And so it is always important to understand the obligation and responsibility of the regulation and appreciate that. So it is, I would say, necessary component of somebody's business. So it has to be rather the primary obligation of a business to take care of it.
So what about the preparedness? Is the industry or is Paytm ready?
I think obviously we've been talking about it, and our company was doing it even before the act got notified, because government had before notification given at least 1 + 2 years. I think there were 2 years. So we had a lot of preparation time. I understand that we are talking this as a sweeping directive. It applies on way too many people for its preparedness and readiness. But at the same point of time, the importance of this will start from the largest data fiduciaries to the lower scale data fiduciaries. So when the implementation deadline shows up, I'm sure the first check will be done on the larger ones. And I'm sure most of them are understanding acknowledging the value of it. Some of them are global players, some of the local large players, and everybody understands the need of it. So I don't think it is a delay in preparation that should be a concern. I would rather say that people have understood the need of it, and government has given enough and optimum time.
Okay, thank you for that perspective. Let me turn to Mr. Vakil again. So in terms of the legal provisions or the obligations of the data fiduciaries, do you think there is sufficient clarity and the rules are robust to potential challenges, or do you think there will be a surge of litigations because of interpretational disputes or confusions?
No, so that's a very good question. But I think, it's fair that any new law, I mean, I just take one example, the bankruptcy code. When it came in, literally any law, when a new law comes in, it is susceptible to challenge and constitutional issues. So already there have been challenges. There are already cases filed in the Supreme Court, and I think the hearing is next month. So just to give you a few examples, the journalists have an exemption under GDPR, Japan, etc. As you can imagine, not in China. But that exemption is not there. So they say this is a chilling effect, is the words used in the petition. RTI is also very upset because they say the whole idea was to protect individuals, which is the idea, exactly as Dilip says, it's based on trust. So how can you hurt RTI, and how can you not have an exemption for RTI? So that's another challenge. And the last one I'll give you, I don't want to get into a legal lecture here, is that the government appoints the board. So they are saying again, there's a conflict of interest. So our Chief Justice has said it very nicely that these are complex and sensitive issues that need to be discussed. And there may be, there may be some watering down by the court. I wouldn't be surprised. Especially the RTI one, I think, and maybe even the journalism one. So there will be challenges.
But these are very important points. Can you share your view on the RTI exemption and the journalistic exemptions?
No, I think I have sympathy for both those. Because there was, the RTI again is a question of trust. You want to hold your, public and government officials to RBI for that matter, goes through a lot of RTI queries. So not to allow for that, I think, is a bit going too far. And journalism, again, as I say, you have to have a balance. There is a lot of Supreme Court case law. Puttuswamy has laid down, balance of convenience, etc. So that again, I think they will give some kind of exemption. And as I said, there's international precedents. I mean, Japan has it, GDPR definitely has it, Singapore has it. So I expect on those two there may be movement.
And what are the chances, do you think, that the court will overturn the rules?
No, I mean, they don't have to overturn. As I said, there's always some challenge. I can't second guess the court, certainly not. But I gave you my view that there may be some suggestions to change. And I think Dilip mentioned this. I mean, we are in a very dynamic world. So this allows you to keep evolving. Where you see the issues, rules can be changed much easier than the statute. You don't need to go to parliament.
Yeah.
So it was a smart move to do this through regulations. So I'm sure if a court suggests something, the regulator will take a view of this.
Thank you for sharing your views. Mr. Asbe, I want to talk about the concentration risk that has been talked about a lot even globally, where there's a dependence on a few cloud providers, where payment systems are over-reliant on just a few providers. So do you see such a concentration risk happening to NPCI or Indian systems? How do you see things like data redundancy or other kinds of protections to prevent such concentration risks from happening because of the infrastructure dependence on a few providers?
See, basically, the cloud as a business is an infrastructure play, right? And naturally, any infrastructure play will not. It's a little expensive play, right? And long-term returns, maybe over 10 years or something like that, compared to the other standard, the ROI matrix on capital. The infrastructure is the longest asset class. Now the question is, the people who will play the game will have the deep pockets and a long-term vision, both, right? It will not happen that somebody is looking at a short-term vision and a short of capital will try to invest into this. Plus, with this whole AI coming in and, the cloud providers will naturally kind of, right now they provide the commodity commodity hardware layer and the services business. Now this whole story will become AI-led, right? In the next few years, few months time, right? And you would see that there are new age cloud providers. You must have seen in AI Impact Summit, the announcement coming in on the creating the AI-driven AI data centers and AI-driven data centers, both. So I think it's going to be a very interesting game that, and I always feel that there is going to be a combination of some domestic players, because we have seen some of the announcement which has been made by Adani, Ambani and a couple of others. And we also see that standard cloud providers, which is Amazon, Google, and the Microsoft, are also now trying to up the game as far as this whole story is concerned. And there are some native providers like Yota and a couple of others are also trying to play the game. Again, I think I don't foresee much of an issue on concentration as far as the cloud is concerned. In my assessment, the way the cloud has been a community even today the switching cost from one cloud provider to the other cloud provider are not that expensive. There are some switching costs, and maybe I think Vijay can also throw some light on that. But I think in my assessment, we are a national critical infra, so we mostly use on-prem and on-prem cloud. The public cloud switching costs are not that expensive in my assessment, or rather, most of the large organizations have already started building the multi-cloud environment, so that they are not dependent on one cloud provider. So I don't foresee that the dependency will be created on a single player or a couple of players. However, I think it does not take away the need of skill, the need of expertise that individual companies will have to prevent. Because see, look, whether it's a public cloud, whether it's a private cloud, the security is what you know and what is that you have implemented. While they might have the overall framework, finally the data security, the cyber security attacks, all the things, the engagement to deal with the data theft, the standard detect, prevent, respond and recover framework for cyber security, it's all have to be implemented by you and not by your service provider. So I think irrespectively, I think the organization has to start getting smarter and smarter, continue to ensure that they have a multi-cloud compatibility, they have good cyber security framework implementation, and their board is fully invested and involved in overseeing that whether the companies are fully compliant. And in a way, the DPDP Act kind of mandates that, right? Because the fines are up to the range of 250 crore, right? So I'm saying one fine and one data theft and you're out of the business tomorrow. So I think it's, of course, goes without saying, it's an ongoing journey. Nobody can say that they're fully ready for any eventuality in that sense, but at least it's a journey which the companies will have to undertake in the next few years' time.
Okay, let me move to the implications for the fintech ecosystem. Mr. Sharma, between banks and fintech companies, how do you see the impact of DPDP? Does it advantage or disadvantage anyone?
If you look at it from the number of steps a customer has to do, it can be called a disadvantage, but at the same point of time, you're giving more power to the customer, so it is an advantage situation. So in my opinion, it is overall net positive, because financial systems are where there is the most sensitive amount of information beyond your personal social media or identity information locations. So bringing them as an obligatory data fiduciary is a perfect thing and obligated thing, because you do not want your data to become available to someone. एंड ऐसे ही हम लोगों को लग रहा होता है कि हमारा फ़ोन सुन रहा होता है हमारी बातें और हमें ऐड दिख रहे होते हैं, तो हमें तो बिल्कुल सबको डर लगता है कि ये सब कुछ सुन रहा है. और कम से कम पेमेंट इंडस्ट्री और बैंक तो सब कुछ देख रहे हैं, वो सुन रहा है तो ये देख रहे हैं, ये भी बहुत इंपॉर्टेंट है. तो अगर आपने पैसे कहीं खर्च करे और आपके फ़ोन पे ऐड दिखने लगे कहीं और के, तो आपको डर लगने लग जाएगा कि ये क्यों हो रहा है. सो इन माई ओपिनियन, financial system may have a couple of more steps. For example, you have to give consent, and if you know, financial services companies are more conglomeratic in nature because of multi-regulator structure. A particular brand name will have multi-regulator companies which are unique, and then they will have to consent to each other. Which another good thing is that our domestic regulators have already implemented very significant percentage of it already. So it rather does not impact them incrementally so much as would be, let's say, for a separate company. Let's say you are a messenger company and you are under disguise of something, taking consumer data and then holding it up to some other company, and then you are in the court. And the court says that, do you want me to tell what is this? You know which case I'm talking about. Versus, you've never heard this for the bank or a fintech because they are themselves regulated. So I would say regulated companies do not have much more incremental impact as much the unregulated companies will have it, because regulator, by virtue of oversighting on them, has been able to take care of what they need to do or not.
But between banks and fintech companies, who will benefit?
Fintech has a word called tech inside it, so it sounds like that they should be more techy, but they are more techy.
I just want to add, I think again depends on the size and shape, right? Because as Vijay was saying, some of the larger fintechs in the country will also have the similar compliance obligations and similar responsibility, if I may say so, right? Whether it's a Paytm or some of the other large players, in the insurance market, the brokerage market, the zeros, the grows. I'm saying the leaders in fintech will have very similar compliance structure as far as bank is concerned, in my opinion, and I don't think their cost will differ to that extent, is my belief.
Yeah, it is not materially costly or cumbersome on customer. It is already factored in their business model because they are expected to put these laws. And data sovereignty has been part of financial system much before this is asked for.
So, Mr. Vakil, I would like to come to you if you have the time, because I'm told you have to leave, or no? Okay, sorry. You need to leave. Then just stay back for one more question, please. Okay, so then let me come to you, Mr. Vakil. So, what about the international dimensions? So, do the rules apply to international transactions? And if so, does it impact India's international digital services, ambitions?
So the goal is to protect the data of Indian citizens. So the international dimension is that if it is, the data principle is Indian, then it affects. So if I make an order for whatever reason, I know today it's pretty bizarre, but some UK entity or whatever, then they would have to, because I am an Indian citizen. But otherwise, it does not affect an international transaction. And I should say that, you know, there are I talked about the exemptions that are not there, but the exemption that are there, GCCs, now that everyone knows is a huge thing for India. So there are exemptions for them, for BPOs. So that part has taken care of. And also, unlike other countries, some other countries at least, cross-border, except for what they call blacklisted, which we'll have to see from the regulations. But largely cross-border is no issue, because otherwise, again, for a country like India, it would make it very, very difficult. So yeah, I think the international part is actually not very complicated. But it's great to see that two of our largest entities are taking it in such a positive way. I hope a lot of the others feel the same way. I mean, what I hear from both of you is also that like RBI has this scale-based regulation. So the larger you are, I think it would be great if they follow that same model. But that would make sense, because expecting a SME to come up to speed immediately would be very, very difficult. So, I mean...
So, I like to ask a question to Vakil Saab or Vakil Sir. You quoted about SMEs, and this is typically like US is right now saying regulation is bad, and you see US president and the team currently talking about that Europe is penalizing American companies. Do you foresee that kind of situation for India to become that, or India will be far more pragmatic, like you are quoting about SMEs? So one side we have SMEs where the earnest regulation is considered cost of compliance and actual limitation because of the size limitation and their efficacy. And at the same point in time, the other side, if you deploy these rules, then somebody elsewhere will say that, what are you doing to my companies? How do you go between the two of the other side of the spectrum?
I think that we will take the pragmatic approach. I don't think that, because we all know that for several reasons, whether it is jobs, which is the most crucial thing for us as a country, whether you take percentage of our GDP, I mean the experts are all sitting here, MSMEs are too important. So I cannot imagine that they would take any negative steps on that. But you know, it's again just to mention, but I mean really it's very positive the way Vijay and Dilip are seeing this, because I remember just again at my age, examples are always children, grandchildren. But when OTP came out, my kids were saying, look at this, you have such high regard for RBI, nowhere else in the world you need OTP. But today we realize how fantastic the concept of OTP is, because it's again trust and...
You know, the first 1 year, the volumes went down actually. The first 1 year of the two-factor authentication, and then in the next year, it actually grew over the first year, the base year. So you could see that, you know, how regulator looks at the long-term policy making as a priority than a short-term to create a trust.
But you mentioned growth, so I have some data and I want to ask you on that. So I saw that Economic Times said in the last 3 years, UPI expansion is showing signs of fatigue. The QR network, the merchant QR network has grown by 5%, and only 45% of India's merchants accept UPI payments. So the reason I'm asking you this is, do you think it is related to the absence of cost recovery because of the zero MDR? And is it sustainable to carry on like this with government subsidies? I saw the RBI governor statement, which is very interesting. The RBI governor said that I never said that UPI transactions will not remain free forever. So it's a double negative. Do you think UPI transactions will remain free forever? And if so, is it possible to keep scaling up?
No, look, I think, I cannot, I think the policymakers will have to talk about it. I think I may not be the right person to speak about it, but the way I look at the situation, and I'm sure the Vijay will agree on this, what I'm trying to say, is UPI still has the 10x growth possible from where it stands. I think this is the point number one. The second point is, if we, the UPI is kind of creating the way Jam Trinity helped UPI to come over. Now the UPI has taken over the role of the infrastructure layer, right? What it means is, whether you want to look at the consumer for credit, whether you look at consumer for insurance or investment, we can be fairly certain that he or she is the UPI customer now, right? And what it means is, he's digitally onboardable, right? Point number one. He has a bank account, and tomorrow the cost of collections or cost of servicing is going to be near zero, right? I think these are the important kind of foundational assumptions which I'm trying to make here. And if these are true, it is utmost important for us that the country must try to get 1 billion people come on digital payments, right? And many of them will use their own money, many of them will use the bank account money, and many of them will also use the credit money, right? Today, whether we look at the street vendors and some of the people who are not able to really get part of the formal economy now, because of UPI, they are able to accept payments, and that creates a digital footprint, and it kind of helps the banks and financial institutions to kind of give them a sort of a short working capital, right? And now that's what we are trying to do with the credit line on UPI. So I think, coming back to the point, that I think UPI still has huge growth. It's very, very critical for a country like us that, we get every Indian to be on the digital financial services because of the formalization of it helps formalization, it helps economic speed of money, it helps in variety of different, it helps fintech startups to kind of create services models so that they're able to onboard and collect in a near zero cost. And I think it would need some amount of investment. Now, that investments, if we required, I'm just making an assumption that, if we require more than 10,000 crore, now it's a decision of policymakers that, how do they decide? Do they continue to think that, is this a right time to let the rich merchants pay a reasonable amount for UPI, or for some time government continues to subsidize for all, or in the long run government only subsidizes for the small merchant and let the market-driven approach for the rich or large merchants. So I think it's a very complicated subject, and I'm sure government will take the decision at appropriate times.
Would you have time for one quick question?
Yes, please.
So, you were talking about the UPI being the rails, and a lot more innovation can happen. So I'm just thinking of other kinds of digital assets like cryptos, NFTs, digital gold, digital silver. What do you think of the future of such digital assets, and can UPI or NPCI in some future point of time provide the rails for these, or will there be risks?
See, again, this is a question in the regulatory ambit, and I may not have the right skill set to give that answer, but let me answer that on a first principle basis. I think when we are creating a citizen scale system, right, when we are allowing ease of fund movement, ease of paying or receiving money, right, it is very important that, the citizens of the country are using it as far as the investment. I'm just using the asset class what used as investment in a well-regulated assets, right? I think that's very important. Vijay spoke about Chinese lending apps and the scam and social issues it created. right? So any sort of highly fluctuating, the kind of gaming, and government has done again a great thing by coming up with a law on the betting or those kind of activities using the games. And I think it's very, very important that the country has well-regulated assets for the citizens, because India is not like Europe or US. Our social security issues, our education and awareness issues are very, very different than the Western world. So I think, and I'm sure that regulators are doing that job in terms of ensuring that the consumer is fully aware that what he or she is doing. And second point is the consumer is fully protected when the asset realization is not immediate, right? Normally number of times, the asset realization and most of the schemes what you spoke about, the asset is promised to deliver its value in some time period, right? And now when that is the case, assurance that the consumer will have the ownership of the asset after that delayed period is a very important factor, at least as far as India is concerned, because India is a developing country. The middle class, the lower middle class, and the poor section, right? We must ensure that our systems are designed more starting from the bottom, and that's where the well-regulated assets become a very, very important aspect of what you spoke about. So I don't want to go back inside that which assets are well regulated and which assets are not, but I want to answer that on a principle basis that the need is the large-scale citizen platforms must be utilized so that the long-term good of the consumer is protected, because the education and awareness levels may not be fully there yet.
Thank you for sharing a lot of perspectives, but I'm curious to know your views also on these issues. So, for example, on should UPI remain free? If you have any views, Mr. Sharma and then Mr. Vakil.
I think we started the free culture in this country, 2014 to 2000, all the time. Paytm has been free for both merchant and this. We invested 25,000 crore we paid to the financial system so that merchant can receive free. And like Dilip said, it is apt time to consider the large merchants which are getting the benefit of free. Should they need
and it
to
has
get
served the purpose now. When it came in January 2020, the decision has served more than its purpose to for a country to accept it wholeheartedly, in my assessment.
So it's like saying we should do Robin Hood. I'd say the big should fund for the small. The tax system works like that, if you will. And in my opinion, the big guys, the big merchants who do hundreds of crores of business, crores of every month business, they can pay for it.
Do you have any view on UPI being free?
I totally agree with Vijay and Dilip. I think time has come.
And a consumer should not be charged. I just want to tell you one thing. This is the misnomer.
Oh yeah. I think great point. I think the consumer should not be charged.
Consumers are never charged, should not be charged, will not be charged. I think this is a question of the business for whom you are working for it.
Sorry,
Yeah, I was saying that this is the whole point of evolution. So as Dilip was saying, there was a purpose. It's worked fantastic. It's probably number one in the world. By the way, you were mentioning about QR fatigue and all that. We because we are not, thank God, I can say openly, thank God we are not a crypto country. There is no useful purpose. Stable coin, the theory is that especially for cross-border, domestic again because of UPI and Dilip, there is no need for domestic.
Yeah, because the service, it's well served.
It's done.
The domestic market is well served.
You can't be quicker, you can't be more cost effective. So we are in a situation where we have to do bilaterals. We have done with Southeast Asia, we've done with Middle East. We're even looking, I'm sure they know much more than me, with the US. But what is the problem? They don't have the QR infrastructure. So I think that is one of the amazing things we've done as a country. So so we've reached that stage, and now if you're a rich merchant, why should it be free? I don't get it.
So, Mr. Sharma, how have you seen the consumer? Thank you. consumer's mindset, customer's mindset. So do you think they are concerned about data privacy? Are they willing to give consents? Are there challenges?
I think if I take example of a very popular messaging app, it has been able to make people understand that it is end-to-end encrypted and it does not misuse the data it has, except that Supreme Court found something else. So it's a very awkward statement for me to make that the consumer goes by the perception that is imposed upon them, while the reality may be not necessarily the perfect way of looking at it. So I would rather say Indian consumers or mass level of consumers are significantly gullible because they trust what it is saying, because the words meaning of what those precisely put legally worded words mean is something else than what they may just impart the impression of being that. For example, like it is end-to-end encrypted, but I own the encryption key, so I can decrypt is a half statement. It's a very interesting way to say, yeah, it is end-to-end encrypted, but I own the encryption key on the destination. Now, the consumer may not believe or know till the time period the trigger shows up. So that is why I would say this act and the fiduciary and the responsibility of somebody on top of them is required. Consumers, we will trust what endorsed and acknowledged trust shows up, and that is why the state.
So in terms of implementation, where are the most difficult challenges? Is it in
the
security?
Biggest company? No. Biggest companies will lobby against it biggest, and they are the toughest to implement. There is absolutely no other limitation. The lobbies of those who do not want to abide by it will be the tougher to crack, and regulator understands or government understands that. And that is where the challenge is. Otherwise, if you were to say this is good for common people, why would common people and common businesses not want it? It is not mal-intended, it is a well-intended. So I think the short answer is the largest data, I don't want to use the word, any other metaphor which may be very heavy duty, but largest data fiduciaries of today's definition who may not be buying into the way their current business models are working versus they will be required to work will be the biggest challengers. And they will have wherewithal to challenge it. Otherwise, I don't think people will learn the way. The other businesses.
Mr. Vakil, how do you see the impact on the economy? Will it increase retail investors' participation or consumers' participation in digital systems and therefore help growth of the economy? Or will it create higher costs of compliance and be a burden on business?
No, I think initially, I think Vijay said it very well and very politely. Given our culture, we are very trusting people. We are not very big on privacy because, that's the way we live. It's a whole joint family, lots of friends kind of culture. But in today's world, I don't think we can continue like that, because the harm that can come by the misuse of that data is really huge, which we have seen. And I mean, he didn't want to put names, but we all know the guys who have the masses of data and how they use all the algos. So just one example of the Byte, which will, I mean, we are far away from that, but Meta was fined 13.2 billion by under GDPR. Yeah. So those guys are going to be kicking and screaming, and they have the deep pockets to kick and scream and go to the courts, etc. But overall, I think as a country, because again, remember, this is for each individual and to protect that individual's rights. So is privacy important in today's world? There's only one answer. It has to be important. Otherwise, it can be misused badly.
But do you think ordinary people worry about their privacy, or are they happy to let it be
Ordinary people
used?
do not worry about what goes in their mouth. And that does not mean that we should not have FSSI. I mean, come on, that is not the justification of not having the regulation and obligation, because ordinary people do not know how materially it matters for them. incidentally, the ordinary people behavior is the data that stays from the country, goes outside of the country. It is a huge geopolitical risk. Common people do not understand that what level of geopolitical risk they are generating if they do not implement this data. And this is where the big picture versus small picture zoom in level also comes out. Let us understand, guys, the single reason this data is captured and misused is not simply the commercial. It is a larger arc. It is a geopolitical reason. If my country's economy's movement of nuance is happening and this is somebody who's an adversary is getting access of it, it is a concern of the country. It is a sovereign risk. It is not about that common consumer bothers about it or not. Kids don't bother about who gives them food. Parents bother about who gives them food. It should be bothering of the parents to bother about who gives them food. I mean, I'm not going to say that they don't bother about. Their wherewithal, their cognitive skill, their understanding of big picture is not up to that standard. That does not make them. I mean, it is a responsibility of a big state to take care of individual, sovereignty of the country, and everybody together. So it's not a question of whether people understand or not. I told you, end-to-end encrypted. I understand that and I will trust that, because it is being imposed upon me and I trust that what is being said because it is being publicized. But if it means something else, somebody else has to poke into it and tell. Why were we discussing a few minutes back that journalistic independence, RTI independence are certain things that should be there? Because we do want what is being told to us is truth or not. If, you know what I'm saying.
Also, you know, to take it exactly what he's saying, the phrase data is the new oil. Why is Google and everyone, we were talking about all these data centers. So why is India so attractive? Because the huge new Saudi Arabias are China and India, right? There are no other places with 1.4 billion. Africa is a continent, but it's not a country. So how can you then not protect such a valuable asset is exactly what he's saying. You have to, and with the whole geopolitical overlay.
Yeah, I consider common individual to understand that their behavior generates a geopolitical data trail, which is even more important than they can individually understand the value of it.
One last thing on this is also the level of cybercrime. Okay, that's, you have to be concerned, no? And you're opening yourself up for it. It's again saying that putting security systems, how good are we with security systems? It's only, even today, I don't have any fancy security in my house. But if the world, if cybercrime has become so sophisticated and so prevalent, you have to do it, right?
आपको पता है वो digital arrest Cambodia से हो रहे थे? I'm sure most of us learnt it. It was not happening somewhere physically within the realms. And why could they do it? Because उनको मालूम है कि IP address से तो मैं कुछ भी जा सकता हूँ ना मैं. तो borders सिर्फ अब उसके नहीं हैं जो physical world के हैं. Borders, air, sky, land, space के अलावा cyber border भी है. And cyber border के लिए तो rule ही नहीं बनाया हमने ना.
So on digital crimes, I want to also talk about data breaches. Earlier you talked about Meta being fined. So in June 2025, there was one of the largest data breaches in history. World over 16 billion usernames and passwords and tokens were stolen from Google, Facebook, Telegram. In India also, we have had Aadhaar data being sold on the dark web. So do you think now we will be safer because of the DPDP Act? Will there be less data breaches?
This is Tom and Jerry race. So I'm not going to say that this will single-handedly make us safer, but this will single-handedly bring responsibility to everybody who holds the data. Another level ahead of than it is today. It does not mean that we will become safer, but people will be bothered about it. That, oh my God, there is now a direct act about it. I could have not bothered so much. So all these things, again, whether it makes us safer or not, it makes the people who are holding up the data more responsible for sure.
Yeah, exactly. I mean, as my friend Nilesh would say, that you should have investor education. So this is again education. The self-awareness is important, no? Then automatically it will become safer as you go along.
Yeah, in one of the morning sessions also, we heard that the solution to information asymmetry is better financial education. So somehow things coming back to the professors at the end of the panel. So, but yeah, quick.
If you can do physics and chemistry so well, surely it's not that sophisticated.
So since we have just 8 minutes left, let me try to take some questions from the audience. Gentleman over here wants to ask a question. So could you just wait for half a minute? They are supposed to have mics. Sir, can you come
सर आपकी
forward?
आवाज़ मोदी
and
जी
use
जैसी लग रही है सबको सुनाई दे
Okay,
रही है
behind you. Yeah.
आ रहा है
So my name is Yogesh Srivastava, and talking about the impact of DPDP Act on people, common man like me, do you see a scenario, and my question is to Mr. Vakil specifically, and of course Mr. Sharma can also chip in. Do you see a scenario that 2 years, maybe 2 years down the line, when the implementation, formally happens, I will be getting less unwanted calls from NBFCs for loans, credit cards, real estate developers, and insurers?
Definitely, you will be, because the consent requirements are very specific. So as long as you're careful, there's no deemed consent, nothing like that. So you should that should reduce, no question about it. It's not 2 years, it's 18 months in May the following. And if it goes scale-based, then Nilesh may have to suffer it by December.
Thank you, sir. Any other hands? Tirthankar?
So I had a clarificatory question. So we are pushing for no forced localization at the WTO. We're basically saying there should not be, we are against that JSI, which looks at no forced localizations. We are saying we should keep that option open. And yet in bilateral treaties, we are looking at relaxing some of those ideas. The other question I have is at the moratorium on e-commerce, downloading, electronic transmission, should they be taxed? There is a movement saying they should not be, but India says, like developing nations, we have there are untapped numbers of around $5 to $10 billion every year. Why should we lose that revenue opportunity? Just some thoughts there.
वैसे मैं यूज़र की तरह बोल रहा हूँ टैक्स कम होना चाहिए तो ऐसी जितनी चीज़ों पे टैक्स नहीं लगा उन पे नहीं लगाना चाहिए बाकी अभी ये किस जगह पे ढूंढा गया है टैक्स ये एक खुफिया काम आपका और जो टैक्स बनाने वाले हैं उनका है बट टैक्स नहीं होना चाहिए इतना ज़्यादा बहुत टैक्स हो रहा है कॉमन आदमी के ऊपर
I couldn't agree more.
बहुत तालियां बजा दी लोग तो ऐसे जो कॉर्नर केस जहाँ पे टैक्स नहीं लग रहा वहाँ टैक्स लगाने से होता क्या है कि लोग फिर और कॉर्नर में जाके निकल के भागते आते हैं देन यू आर लाइक टैक्स कंप्लाइंस नहीं हो रही रादर सिंपल टैक्स कम टैक्स सबको टैक्स मतलब ऑब्वियसली एक लिमिट के आगे
Would you like to add?
Yeah, I think, no, I totally agree. I mean, the answer to your question will be on those specific issues will be what leverage, negotiating power, the geopolitics of the situation. But basically, exactly as Vijay said, and the main thing is once and for all, I wish all of you can convince government, no retrospective. We were speaking about it at lunch also. I mean, even on the gold bonds, for them to go and make it retrospective, first you say, understand. I understand the contract, you do a deal. Oh, gold has gone up a lot, pay more tax. Ridiculous.
Thank you.
Any questions from the students?
मेलेडी इतनी चॉकलेटी कैसे बनी
Okay, I don't see any. There's a hand over there. Yeah, behind. Keep passing the mic.
Thank you for this insightful discussion. My question is regarding some arguments that I have gone through in newspaper articles. They have criticized this particular act by arguing, apart from the RTI thing, that if this act comes into force, then companies will have to bear a higher burden of compliance that will also impact their cost structure. And it may happen that they would try to shift their resource base to compliance thing rather than focusing on innovation or expanding their businesses. So what's your take on this, sir?
You are one of the prize winners, right?
Yes, sir.
So it's scary to get a question from you. No, congratulations.
Thank you,
So,
sir.
no, I think that's a nonsense argument. without being rude. Because there's nothing to do with, compliance, as Vijay said, is something that if you're in this business, you have to take care of it. All of us have some level of compliance. So there's no question of saying that, and compliance and innovation, I don't see the trade-off. I think maybe with AI regulations, which is a big debate, that should we be having AI regulation in today's world, again following the EU model, or like the US, even China has AI regs, but the US naturally, we all know why, does not have any AI regs, because you know who makes that decision. So for that, the balance is between innovation and regulation. But in DPDP, this is not an issue at all.
Thank you, sir.
So we have time for just one more question. So maybe the gentleman with the tie.
So as you told about monetizing the UPI thing, so like initially people accepted the UPI because the main problem for the business was like if they take cash in rupees 100, so they are getting 100. But just soon you monetize it, they will get 98, 97. So that is a pinch of salt for at least a small businessman. So like if you monetize it, so what subscription, it would be a model like on daily transaction you will charge a percentage, or it will be a subscription model like Netflix or something. And like even if you like put it, so, and if any other company comes it, so which has
Can you keep it short?
Yeah, so that's the basic question. What would be the model?
Okay, I want to remind you, when zero MDR was, I quoted a line called zero MDR is a force multiplier for India's economy, because of this very reason, that people do not have the cognitive understanding that a few bips that you pay should have a yield and benefit of it. So let's remember it. People, you will be ready to pay something as a convenience fee if you get a benefit of it. Now, we have to think what benefit the small merchant can get and what benefit the big merchant gets. Right now, if you heard Dilip, and I do fundamentally believe that small merchants should not be charged. And I fundamentally believe that they are understanding of whether it is 50 paisa or 100 paisa. I gave a very interesting case study, case discussion in person in an event where very senior government and regulatory officials were. I took the 100 rupees. I said, this is the customer 100 rupee, and it goes in my pocket, and it is 100. It settles now. If I do not make digital equal to this, it will never win. So let's just understand, zero MDR is an obligation, not a choice. On one day, I even said that. Now, I'm going to say this once again, the big businesses for whom the cost of payment collection exists, for whom the value of this business exists, can be charged. And doing this Robinhood is not pricey. I would rather say, and maybe you know it or not, large GMV or large payment volume is actually processed to those guys. So for example, like in other words, I can take an example of, let's say, Zomato or Swiggy. The volume of payment that they handle will be more than many small shopkeepers or restaurants they will handle. So if you charge them, it is not that you need to charge them. So the business model will always inevitably be, and suggested discussion that we've been doing is that charge the big merchant, the one who is earning in hundreds of crores, and that can fund a significant amount of requirements. Small should not be charged, and that is what in sync is.
Thank you, sir.
So on that Robin Hood note, I think we have run out of time. And thank you to our wonderful panelists, and thank you, audience.
Thank you.
On behalf of the audience, I would like to thank the panel for that highly informative and analytical session. We will now proceed with the felicitation. I would request Dr. Tithankar Patnaik to present the mementos to our panelists now. Thank you to all our distinguished speakers. May I now request for displaying the winners of the Slido quiz for this session, please. The winners are Vijay Kumbar, Rishi Nair, Vedant H. Godambe. May I request the winners to kindly join us on stage. I request Dr. Patnaik to felicitate the winners, please. So he's from that side. So we've got 3 new winners this time around. We would now break for tea and reconvene at 4 p.m., please. Thank you. This is just an announcement. I would request everyone to kindly be seated in the atrium as soon as possible so that we can start at 4 p.m. sharply. Thank you. I request everyone to kindly gather back at the atrium so that we can start with the next session.
पानी के बॉटल्स निकाल लो ना ये वाले ये पानी का बॉटल
Thank you, Bhaiya. Sorry. I kindly request everyone to be seated in the atrium as soon as possible so that we can start with the proceedings. I request everyone to kindly remain seated or take their seats in the auditorium if they haven't, so that we can start with the proceedings as soon as possible. Thank you. Welcome back, ladies and gentlemen. As we approach the final leg of the day, we return to a central theme of this conference: information versus noise, this time in the context of global asset markets. I'll begin with the introduction of the panelists. Dr. Sajid Chenoy, Managing Director and Chief India Economist at JP Morgan and member of the Economic Advisory Council to the Prime Minister. Dr. Sajid Chenoy is currently serving his second term as a part-time member of the ESC PM. He has previously served on the Advisory Council to the 15th Finance Commission and was a member of the RBI's expert committee to revise and strengthen the monetary policy framework. A former IMF and McKinsey professional, he holds a PhD from Stanford University. The next panelist is Shri Ridham Desai, Managing Director and Head of India Equity Research at Morgan Stanley. Shri Ridham Desai has worked at Morgan Stanley since 1997. A rank-holding chartered accountant, he is among India's most influential market strategists and a key voice shaping global investor perspectives on India. He is a regular commentator in national and international media and serves on the advisory board of Project Mumbai. Over nearly 3 decades, he has consistently guided institutional investors through India's macro and equity cycles. The next member on the panel is Shri Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company and member of ESCPM. Shri Nilesh Shah, with over 2.5 decades of leadership experience across Kotak, ICICI, Axis Bank, and Franklin Templeton, has worked across debt, equity, and real estate markets for domestic and global investors. A gold medalist chartered accountant and merit-ranked cost accountant, he has served on multiple SEBI and exchange committees for market development. Returning to the stage in a panelist capacity this time is Professor Sagar, who brings both academic and policy insight to this discussion. To moderate this session, I'm pleased to invite Dr. Tirthankar Patnaik, Chief Economist, National Stock Exchange. With over 2 decades of experience in macro research, equity strategy, and market analytics, Dr. Patnaik has been at the forefront of interpreting global macro shifts for Indian markets. Beginning his career under Consumer Banking Analytics Division at Citibank, Dr. Patnaik later went on to lead equity strategy for institutional clients at Citigroup Global Markets and Religare Capital Markets. Prior to joining NSE, he served as chief strategist and head of research for India at Mizuho Bank. May I kindly request the panelists to come on stage, please? May I further request all the panelists and the moderator to kindly pose for a group photograph. Thank you. Before we formally begin the discussion, as has been the ritual, let us have a quick Slido round. Kindly scan the QR code and join in. I think we can start with the display of the questions, please. The first question. The 2008 global financial crisis was largely triggered by which bubble? %89% of you have gotten that correct. It's the housing market bubble. Moving on to the next question. Greater fool theory in bubbles means? %93% of you have gotten that correct. Next question. FOMO in markets most closely refers to? %96% of you have gotten that correct. Fear of missing out leading investors to buy after prices have already risen sharply. Next question, please. When many investors focus only on recent returns and ignore risk, it is best described as 69% of you have gotten that correct. It's the recency bias. Final question of the round. Information asymmetry in global asset markets means? %94 of you have gotten that correct. Some investors know more than others. With that, the Slido winners are Alhad, Atharv Dikshit, Suraj Khangde. As far as my knowledge is, these three are first-time winners. Okay. I would also like to thank all the audience for their enthusiastic participation through all the Slido rounds. I would like to now give the mic to Dr. Patnaik.
Thank you, Taruna. Today, in this conference, we've had discussions on corporate governance, inflation targeting, national statistics, digital transformation. Some questions were really very, very interesting. But one theme that has persisted is how information is generated and how it is acted upon. We had a call in the morning about how asymmetry of information has to be seen with asymmetry of power. We also had a sense of how it's not just about information, but the ability to act about that information. Today, we are going to look at this context in a very specific area, which all of us willy-nilly are probably experts. Maybe not experts, maybe we feel we are experts. See, over the past decade, global asset prices have seen extraordinary monetary expansion. They've seen rapid technological change, particularly now around AI, and certainly the rise of passive capital. In India today, about 1/5 of all mutual fund assets are passively managed. Right now, valuations in advanced nations, they remain very, very elevated. Even earnings concentration has been significantly high, whether you measure it from the top 4 K out of N or a Herfindahl. Alongside, we also see a lot of interest in gold. We see a lot of crypto vol, and we see again, debates on what the dollar would be, about the future of dollar dominance. So the question we are going to ask today is, are markets efficiently processing information, or are liquidity, positioning, narrative, they are increasingly driving outcomes? So Taruna has already done the job of introducing my panel to you. I think I can jump in straight to the questions, but just to get the interest going, are valuations justified by fundamentals? I know there is a probably long answer. Let me ask this question straight to the audience. How many of you are expecting a significant correction in the global markets in the next 12 months? Show of hands, please. Panelists, just a thought for you. Yep. So we have somebody who represents global investors. We have people who represent global Indian investors. We have economists, and we have regulators here, past regulators. The first question to you, Mr. Desai, would be, you see global equity evaluations are elevated, concentration is very high. Do you see this structurally justified, or are we just in a late cycle liquidity jump and we'll wake up anytime soon?
So there is no straightforward answer, unfortunately. So late cycle, yes, it does seem that way. So that is true. Liquidity, so you mentioned passive flows. The market plumbing has changed from where it used to be 20, 25 years ago. Uh, the impact of that is that actually today there's a lot more juice in active investing because of the way passive moves. And in fact, if you ask me the single reason why Indian stock markets are refusing to react to pretty positive changes that have happened over the last 1 year, whether it's RBI's actions, government's tax cuts, reforms, it's largely to do with market plumbing. So back in September 24, passive funds took India's valuations to an extreme level, and now the same thing has gone the other way because India's index weight keeps falling, so people have to keep selling. So it does tend to exaggerate moves on both sides. So that point also is valid. However, I think what is happening out there in terms of AI is truly unprecedented. There is a lot of comparison with the tech bubble. I don't think the comparison is justified. During the tech bubble, most of the internet companies had no earnings, zero earnings. They may have got their earnings, but it only came 10, 12 years later. Today, the AI stuff already has earnings. And the earnings are actually growing. So there's that difference between the tech bubble and today. So I think characterizing this as a bubble may not be the right characterization, but a lot of other things that you said are true, are definitely true. For example, concentration. So there's a fair bit of market concentration, there's earnings concentration, and historically the market has been unkind to concentration. So it does unravel at some point in time. Now I saw there was, I think maybe 50% of the audience thinks that the markets are going to go down this year. That timing is always very tricky. You know, does the concentration unravel in 26 or does it unravel in 27? We don't know. All I'll say is that if I add up all the AI capex that the top companies in the US are doing as per their earnings and their public statements, 228. Only 20% of that has so far happened. So 80% of that capex is yet to happen.
Yes.
And if the market gets suspicious about the return on investment, then it can trigger a sell-off. But we'll come to that a little later. I think it's true that passive funds could be distorting things. It's true that there's concentration which doesn't end well usually. But it's also true that AI is a real thing. It's not a fantasy, and that it's about to change a lot of things that we have done in our lifetime.
No, that's very fair. By the way, for the audience, I should say that out of all the panels here today, this panel is the one that's going to make a dent in your portfolio, if you listen carefully. Yeah?
Dent is a very negative word.
Positive, positive. Positive dent, positive dent. A push. Nilesh ji, what do you think? For domestic investors, it's the same premise. We have flows, we have SIPs, which used to be 10,000 crores per quarter, about 2016. Now we have 30,000 crore coming up per month. Are flows driving fundamentals, fundamentals driving flows? What is happening here?
Hi, good afternoon, everyone. Any market is driven by three things: flows, fundamentals, and sentiments. Stocks are slave of earning power. So in the long term, there is no price for guessing that fundamentals will drive the prices. In the short term, flows can influence prices for a while, but eventually fundamentals prevail. Now, today, compared to last 18 months, next 18 months looks better. Our earnings growth in last 18 months was mid-single digit. Next 18 months, subject to President Trump, is likely to be in double digit. In September 24, with the benefit of hindsight, our valuation was 24 times forward. Now it is 20 times forward if you believe an optimist. or 21 times forward if you believe a pessimist, but certainly lower than September 24. FPIs are underweight India. Passive FPIs on emerging market have started getting flows. So selling intensity of FPI in next 18 months could be lower than last 18 months. Now sum this up together, earnings moving from mid-single digit to double digit, valuation down by about 18 to 20%, FPI selling intensity likely to come down. There's no price for guessing what happens to market in next 18 months. It should deliver, in our opinion, better return than last 18 months.
I would like a kind of a follow-up question, and to both of you, actually. We've had a very positive sense of what AI is all about. We've seen people commit, the number that you said, Rhythm, is about $600 billion or maybe more that AI companies are, or hyperscalers as we call them, are putting in. But we've also seen companies like Alphabet raising debt, even 100-year debt, in the zeal of putting in so much cash. And we've had famous investors like Michael Burry taking a contrarian view on what is happening, what these companies are doing, and how will they be able to justify the kind of investments that they are putting in. Yes, earnings are there, and but where do you really see, given particularly the point that Nilesh touched about, Mr. Trump? We've seen that the last 12 months of tariffs have been now struck down by the Supreme Court, only to be told that we will have a 10% global tariff, and then we'll have a 15% global tariff. So that level of uncertainty continues. Seeing in this context, what do you think now?
See, you make money only in uncertain times. When everything is certain, you don't make money. That's a bond. Coupon is certain, you get your 6% return. So uncertainty is the bedrock for good equity returns. So it's good to be in an uncertain environment. It's not a bad thing. Of course, you need stomach to deal with it. But if you don't have stomach, you should not be in the equity markets. Yeah. Regarding the views on AI, of course, there are fragmented opinions, and it's not going to be a one-sided opinion. If it were a one-sided opinion, this would all be over by now.
I agree.
So clearly, we don't know what the future has in store. But all I can say is that between, say, where we were at the start of 25 and where we are today, in 12 months, what AI models have achieved is exponential. Yes. So the likelihood is in the next 12 months also it will be exponential. And therefore, we have to hold our breath and see, and there will be things that will happen. Now, whether these investments will eventually yield a fair return or not is not something we know with great clarity today. And we will not know that actually until the event unfolds. So that uncertainty will remain. On your point about companies raising debt, I don't think that's a particularly bad thing. The balance sheets are pretty light. They are actually very cash rich. So it's okay to raise debt. So I don't think that's in fact,
just that these companies hadn't done it earlier.
No, I know, but you see corporate India today, it's sitting at cycle low debt to equity. I would rather wish that they started borrowing money and spending it, and it will actually help growth, but they are not doing it. So, at this stage, the tech companies, where they stand in their balance sheets, I think it's okay. It's not a problem.
Nilesh, on that theme, same theme. So we had the twin balance sheet crisis for so long, over leverage. Now they're at cycle low leverage. It is actually going to have effect on ROEs going forward if nothing happens. What is happening? Why are they not putting up?
So before I answer that question, to every investor, if you watched yesterday's cricket match, South Africa ने हमें धो डाला. इससे बुरी तरह तो हम हार ही नहीं सकते थे. But there were two players which performed well above expectation, Jasprit Bumrah and Arshdeep Singh. market kitna bhi kharab ho, to make money, you have to go and find out your Bumrah and your Arshdeep Singh. I have been repeating this story, but I'll again repeat. About a month back, I met a gentleman with whom I'm superbly impressed. He was an engineer working in a multinational company in India selling engineering products, got bored, left his job, went for MBA in US, worked on Wall Street, managing fixed income through quant, made money, got bored, decided to pursue the passion of space tech, aerotech in India. Came back to India about 10 years back and came back to India to set up space tech, which was only for public sector. Fast forward in a decade, he is now sending satellites in low orbit using aviation turbine fuel. No other company in the world uses aviation turbine fuel to launch satellites. Only Indian company is doing it. It's launching satellites through mobile launch pads. Most countries require specific locations to launch. Third, almost all the rocket launches in the world has two parts. One, fuel tanks. Second, vehicle carrying satellites. SpaceX catches fuel tank falling from the sky, but most others let the fuel tank fall. And even SpaceX does not catch the vehicle which is launching satellites. This company, run by an Indian, converts the vehicle itself into satellite, so there's no wastage. And in next 3 months, it's going to attempt catching the fuel tank. He could fail, but he is making an audacious attempt. And today they have announced something which I have to study, but it is for the first time in the world, an Indian startup in space tech is doing something which no other company has even attempted. This is Srinath of Agnikul. As long as this kind of entrepreneurs are there, even in a match like yesterday, there will be Mumra and there will be Arshdeep Singh. उनके ऊपर bet करेंगे, पैसा बनेगा.
Thank
and
you.
ये लोग investment करेंगे. बाकी जो dinosaur है ठीक है.
Thank you, thank you, thank you. Sajid, to you next. I have to ask you a macro question. You see, real rates, they've risen substantially since the pandemic, okay? But if you look at risk assets, you know, they still remain quite richly valued. We just discussed that. I mean, what does this, in your understanding, indicate? Are we really confident in growth, or are liquidity conditions still more accommodative than we are kind of led to believe?
Thank you, Tirthankar. And let me start by thanking Mridul and you for inviting me here. I think there are many levels to this question. The first is, you know, when we say real rates are elevated, there's a judgment we're making about our star. And we've just had a long conversation about, you know, the investment boom that we've seen in the US is unprecedented. You have to go back 30, 40 years to the telecom boom to see these levels of investment. When you got those levels of investment, our star should be rising. So by just looking at nominal rates, we can't make an assessment that real rates are high in the US. If real rates were very high, you should have seen core inflation coming down to 2% and below. It's stuck at 3%. The proof of the pudding is in the eating. Added to that is the fact that financial conditions more generally have been very easy in the US, right? You look at equity markets, you look at credit spreads, there's no element of stress here. So financial conditions have been very supportive. And to be fair, there is some resilience in the underlying economy. The US consumer has been a bedrock of growth in the last 5 years. And there's a huge distinction here that we don't fully appreciate. As you know, we left the GFC with really wounded balance sheets in the private sector, right? Both households and corporates. The opposite is true of the pandemic. Public debt surged, right? But private balance sheets, especially in the US, were very, very sound because there were massive fiscal transfers, A. You've had huge wealth effects, B, and until recently, a very strong labor market. So all engines were firing and US consumption has been very strong. Now comes the tricky part, and I think there are two dimensions to this. There's a near-term resilience test we have to get through, and there's a medium-term known unknown that Rhythm touched upon. The near-term resilience test is you've seen GDP and employment diverge in the US. Growth has held up nicely. Ignore the fourth quarter number of 1.3. It was all the lockdown. It'll rebound in the first quarter of this year. Right? GDP has held up nicely. Employment has been very soft. Progressively more soft when you consider revisions of the last year. And so what you're seeing is how come consumption is held up when employment has been softening? Because households have been dipping into savings to smooth consumption. Now you can do that for 2 quarters, 3 quarters, 4 quarters. You can't do that for eternity. So there has to be some kind of recoupling between the labor market and growth. Either growth slows to the labor market and we go into recession in the next 4-6 quarters, or the labor market re-accelerates because households smooth through the soft patch, demand doesn't fall, and corporates start hiring again. Of course, with all the tariff stuff that doesn't help animal spirits. So that's the first recoupling. Will you see employment pick up? And there were early signs in the January report with all the caveats, it is, and that will sustain growth. The million-dollar question is the AI question. There's no answer. But Nouriel Roubini told me something very interesting in the October meetings in DC. He says, you know, previous industrial disruptions, typically the production function there was concave. You eventually, many years in, hit a concave patch. So it paid to be the second mover, because the first mover would actually hit a concave patch, you'd learn from their mistakes, and you would then not repeat it. This is very different. AI is the first technology of its kind that's seen to be convex. This is going to be exponential. It's going to build on itself. Now, why does this matter? Because on an exponential production function, by definition, the first mover cannot be caught up, right? It's a winner take all, almost by construction. And therefore, you're seeing this massive FOMO. And I agree with Rhythm, we're in the second or third innings of a 9-inning baseball game in terms of investments in AI. Because now there is no downside if you overinvest and that's excess capacity, right? But there's huge downside if you miss this and you didn't invest. So my sense is we don't know where this is going to go. We know there's lots of FOMO. There's the belief that this is completely convex. It's a belief that needs to be tested.
Exactly.
And therefore investment. And the last thing I'll say, because there's going to be one tricky patch here where when you were investing out of your own cash, it's one thing. When you start taking leverage,
which is what is happening now.
But if this technology is not easily monetizable, you could be in this uncomfortable period where leverage is going up, but you're unable to generate revenues to monetize it. And that's the uncomfortable patch that we will experience in the coming quarters.
Thank you, thank you. Mridul, now to you. You know, in all this, in this sort of gung-ho story, we're also seeing renewed demand for gold. We're also seeing high vol in, as I mentioned earlier, crypto assets. We're looking at renewed discussion on the demise of the dollar dominance. How should we interpret this churn? I mean, are people wanting to diversify? Is it speculation? Or are these, and I had to say this, early warning signals of stress that's coming up?
Okay, Tirthankar, first, I'm a bit amused that you asked me on the gold when Elisha is sitting to the right of me. So I thought
I had to do something unpredictable. I won't leave gold out of the picture. Sona aapke liye aa raha hai, sir. Into the picture.
But let me attend the question, and I think it's a serious question. So, let me start from where Sajid was saying about the convexity of the AI. Now, it does, many of the works do suggest that, but there are also serious works, none other than by Darren Esimegolu, who doubts this convexity in a very certain film. He's saying that your large language models, now presently you are using AI with easy to learn sort of space. And as you move ahead, that easy to learn space will go off. And in fact, his calculation on easy to learn space was a moderate TFPG growth of 0.71 over a 10-year period. See, it's not very large total factor productivity growth that it shows. And now, if you also count that easy to learn has gone out, so that means it should be much lower than that. And look at the valuations where AIs are going. I'm not doubting that AI has huge potential, but when you look at the valuations, it does scare me where the bubble is going and getting built. I'm not saying the bubble is going to get burst this year. Nobody is able to predict when the bubble is going to get built, but maybe a 3-year period is a good enough period where we will have the next crisis coming in, either because of AI or because of cryptos. And I don't think equity as an asset is kind of distangled with both of these. So equity is very much entangled with this, and therefore when it happens, we could have a repeat of a big dimension crisis. So investors need to watch out. I mean, I'm not saying because if you operate on FOMO principles, you might miss out the rally for another 1 year or so, but things are getting riskier by the year. If you have seen what happened to the Bitcoin over the last 1 month, a 25% fall within a 1 month should scare everybody. I mean, it's not that it has not recovered earlier. Also, these roller coasters on the cryptos were there. So that can happen. What really stuns me is the ease with which people now are dispensing with the financial stability concerns. So the Genius Act, for instance, has virtually taken away the segregation between banking and e-commerce, for instance. So the big techs now are very much part of the finance space, and they are not regulated, and they have a very light sort of environment in which they operate, and we don't know where this thing will go. So there is systemic stability concerns that are building up, where consumer protection is becoming more redundant in our policy game. So we need to see how this thing might turn out eventually. Coming to the goal, yes, when I think about it, with this kind of an environment where uncertainties are so high, I mean, we don't know which side of the bed Trump would be getting up from the next morning. And would 10% tariff become 15% tariff or anything of a different kind? We don't know. Businesses are operating in a completely uncertain world. So where would we end up in this phenomena? It's very difficult for productive activity to continue the way it is continuing. And this, essentially, they are continuing because there is excess liquidity dumped by the central banks all over the place. The day there is a liquidity shock, this bubble is going to be really minced up. So I think the balance sheet sizes have already been used by the central banks. The space is just not there, and financial stability doesn't come in the mind of the present political dispensation. So that is a grave risk which I see building up, and I see maximum a 3-year, and could be 1 year, we don't know. But this is really, really getting very, very concerning to me.
Can I just take 30 seconds to add? I think the right analogy is the telecom bubble in the US 40 years ago, because both things can be true. All those fiber optic cables were laid. They were very useful in time to come. Yes. Right? So the technology will be, even like AI, will be very useful in time to come. But that's not inconsistent with markets running up too rapidly and having a correction. So in the telecom case, both things happened. You had a bubble, it corrected, but then you found that the real assets that were created were very useful decades and years later. And the other quick thing on Nidal's point, you know, we grew up in a world where there was a risk-free financial asset. It's called the US Treasury. Now there is no more risk-free financial asset. And so you have to physically hold gold, right? Yeah. You just think about that for a second. I don't think people believe now there is truly a risk-free financial asset. This, the whole dollar debasement issue is going,
That to me is adding to the volatility because you don't have a risk-free asset
There's no anchor.
to price on.
Yeah, exactly.
Yeah,
exactly.
so the whole lot of pricing is now a sort of a fluid situation in a gray area. I'm saying there are various kind of tail risk. If you'd seen some of it, and this is what Arvind had once shown me, the Truth Social declaration by Donald Trump, that he has instructed to release the files of UFOs, whatever exists. Now, to me, that is a tail risk. Maybe he's trying to divert attention from where now the current problems are. But suppose something comes out, what is the financial stability risk that exists in the markets? Are the markets prepared to take it? So these are various kind of real concerns that are building up while hunky-dory party is going on. But that at some stage may just blow up is my fear.
So spoken like a true central banker. The audience, do you see the natural grouping here? So we've had two economists tell us, just be careful, be aware, and things might go wrong. And then we've had two people in the center looking at, telling us that without uncertainty, there's no money. You have to make money with uncertainty only. And then we can always find our Jasprit Bumrah. So long as you do that, things will be okay. I was in a recent business school where they had a 4-day course on what you can do in a VUCA world. That term is no longer very unfamiliar to many of us. In fact, they have extended it to VUCA Bani world. You have to find out. Google it up, please. VUCA Bani world. Life is difficult. But then I do see, equity markets at lifetime highs. We do see, our markets also doing very well. And so the question here now to me is, on one side, I have to be cautious. On the second side, I have to be in the game. If I stay out, there was a very, it figured on the top of the FT's most read articles just 2 days back. Stuart Kirk, if I remember the name, he just asked ChatGPT, please make me a portfolio. And ChatGPT then tells, it just acts as a proper portfolio advisor. And by the way, he just adds, don't kill Stuart Kirk. When you eventually take over the world, don't kill me, please, don't kill me. But the interesting thing was the question that he posed, that I have 640,000 pounds in my assets. I'm in my mid-50s, and over the next 7 or 8 years, I need to get it to $1 million when I can, million pounds when I can retire. So the letters were, and that's what my point is here, they said, if you are you write to us every week about portfolio management and you have 100% of your net worth in cash, what does that say about you? The point I'm coming to here is, I would lean on the side of my strategists here, Ridham and Nilesh, that you have to be in the game here. We are in an uncertain world. I fully agree, defer to what Sajid and Mridul are saying, but you have to be in the game.
Can I say something here?
Please, sir.
See, I think people should be reminded this, and I constantly tell people that equities is a very long duration asset. It is not meant for 12, 18, 24-month games. If you want to play those games, then you are not an investor, you are a trader. And you trade at your own risk and your own peril. If you're in this for the real long term, and if India's long-term story is going to play out the way we think it is, even if you invest, and assuming this is the peak of the market for this cycle, so assume you invested in January 2008, Sensex was 21,000, you're up 4x. It's not a bad outcome. Assume you invested at the top of the internet bubble. Sensex was around 6,000, you're up 14x. So even if you are investing at the top, so far as you have a decadal view, you'll actually come out okay. And then assuming that you don't have everything in the market at every point in time, you will always have buying power when the market corrects. So systematic investing is so powerful in that sense, because if you were a systematic investor starting at the 2008 peak, you've actually made more than 4x, because you also bought the market every time it declined. So stick to that plot if you are a genuine long-term investor. If you're a trader, then good luck to you, and I'll give you an anecdote about trading later on.
Nilesh, you must add to this, please.
Rhythm has summed it very well, and I'll just say more people have lost money waiting for correction than in actual correction.
That brings me to the second round of the panel. Actually, see, if global markets are where they are, in an uncertain phase, in a volatile phase, volatile, uncertain, complex, ambiguous, that's what VUCA kind of stands for. The next question we should kind of look at is, how is transmission? Because transmission is important, as it came out earlier on in our discussion as well. And we are in India, after all, here. So the question I would ask is, have we structurally reduced our dependency on global shocks? Or, tomorrow such a shock comes up, as Dr. Sagar was, pointing us to, and then we'll all be coming back to square one. Before I ask my panelists, I would again ask the audience, are we vulnerable today more than we were, say, 12 months back to global shocks? I see Lata raising her hand there. No one. Lata, you're in a minority. I don't believe many people feel that we are more vulnerable today than we were 12 months back. Now, I think this is a demonstration effect. Some more people are raising hands now. So I have to ask my panel. It seems they think that we are no longer as vulnerable as we were 12 months back. We'll start with Rhythm, of course.
No, I think, I don't know about 12 months, but I'll say we are a lot less vulnerable than we were 10 years ago. The macroeconomic of India has evolved. Our balance sheets are much stronger. Our current account is much narrower. We have lower dependence on imported energy than before. So if you go back over the past 35 years, ever since we opened our economy to foreign flows, and if you look at the first 20-year journey, every global capital market cycle brought India to its knees. In 2008, our banks were absolutely fine. We had nothing to do with the GFC, but there was a down cycle in global capital flows, and that caused pain in India. In 2013, the Fed chair just said taper, and India was in pain. From there, where we are today, I think this economy is a lot more resilient. I dare say extremely resilient to global shocks. So I don't know about 12 months versus today, but I can say that over 10 years, we have achieved a lot.
Thank you. Sajid, would you agree? I mean, we've structurally reduced our dependence on global tightening or easing cycles.
I completely agree with Rhythm, and I think like the equity market, you should take a 10-year view, not a 12 or 18-month view. See, the best measure of this is to look at the differential between India's policy rates and US policy rates, right? Because what that tells you is if you haven't built buffers, right? When the US moves, you have to move in tandem. And you can only cut when the US is cutting. And you had a great example of this in 2022. Massive hiking cycle from the US. Latin America had to move earlier and move some multiple of it. Yes. So US moved 100, Latin America had to move to 150 preemptively to create a large enough interest rate differential buffer to prevent instability. True. If you look at India's differential with the US, it used to be 400 basis points consistently.
Yes.
Where is it today? It's 175 basis points. That's the proof of the pudding that we've earned ourselves some monetary policy independence. And that independence comes when you build buffers. Mridul is here and he's been part of the buffer building process. See, in 2013, to pick up where Rhythm left off, the rupee were, 30%, 35% in a summer. The fiscal deficit was in 10% of GDP. The current account was 4.5% of GDP. Inflation, CPI was close to double digits. We've come a very long way. And I think over the last 13 years, there has been this determined effort to institutionalize monetary policy. Inflation targeting, which happened, the process started, we were on the committee together 4 months after the taper tantrum, yes, was a way to institutionalize low inflation. The building of buffers has happened since 2013. We've gone from 270 billion at some point to almost 700 billion. Fiscal frameworks have gone down. So I think there's been a concerted effort to build buffers that allows you to buy monetary policy independence, which for me is the best way to structurally deconnect. I'll say one last point. Let's pick up the cricket analogy, right? So macro stability is like playing in Headingley on an overcast morning test match, not T20. And the first couple of hours are very tricky. And you have to learn to leave the ball outside the off stump like Rahul Dravid. And India has done that very well through macro stability. But what we've seen in the last years, you also need growth. Why have capital flows dried up in India? Not because there's a macro stability problem. I would argue because we haven't seen a private capex cycle for the last 10 years. FDI for me is more strongly correlated with private capex. So now, apart from stability, you also need, to build growth. When you get growth, then you will get the FDI flows. When you get the FDI flows, then your BOP will be in surplus and healthy again, and the rupee is well supported. So the cricket analogy is you've survived the morning session. Now the sun is coming out, and you have to score some runs. And for India, it means how do you translate macro stability ultimately into higher private capex and more sustainable growth.
Thank you, Sajid.
I may just quickly add, we have been so successful at macro stability, right, the 2 hours, that we are now hesitant to take risk. But the time has come, and I'm seeing that change actually both at the central bank and in the government, that the risk-taking has increased. So my confidence is growth is coming back. And therefore, this situation on BOP and flows will change with a little bit of lag.
Nilesh, do you agree?
See, when Rhythm and Sajid says, you better agree. But let me give a different perspective from market point of view. Market is always learning from experience, either their own or someone else's. Now, if we get a global crisis like subprime, we know we can survive it. The correction in market will be much lower. If there is a crisis like COVID, again, correction in market will be much lower because we know we can survive. If there is a crisis, let's say US-Iran attack, my gut is that market's reaction will be muted because we have survived such kind of crisis earlier. But if there is something else which we haven't experienced, then the first reaction will be to secure yourself, and correction could be sharper. It could be temporary, but it could be sharper. So a lot will depend upon what is market's experience in dealing with such crisis in the past.
Very well put, sir. Very well put. Mridul, I have to ask you this. Do you think anything more needs to be done on macroprudential front?
So of late, we haven't used macroprudential tools much. And that's also a bit of global phenomena. See, we have had a regulatory step back in the United States. And while India thankfully hasn't done that, India has been trying to modulate its financial stability policies, macroprudential, but it hasn't gone full hog on the macroprudential tools. So one thing which is there is basically the flight of deposits could become a lot more speedier than they used to be for a number of reasons. The most important being that you have more and more of digital internet-based deposits, and they can be pulled off in no time sitting at home. Now, that requires a new set of calculations to attend the liquidity risk for the banking system. And there is this tussle which is there. As Rhythm says, we need to support more growth. And I'm not disputing that. Everyone wants growth. We have to do that. But it's also coming in way of some of the stability tools which were on the anvil, which have been pushed back. So where that fine line is to be decided has to be very carefully seen. As of now, the Reserve Bank has been also doing steps to increase, basically, to lower the risk in the system while taking a step back on some of the anticipated policy measures which were there. So it must be very carefully calibrating which one might work better, which won't work better. So that tussle is there. But the time-tested rule which we had was that you have to use macroprudential tools in good times. You can't use them in bad times. And if you are saying it is good time now, then you have to have some macroprudential tools kick in at this juncture.
Audience, the sense I'm getting is caution pays, but don't be afraid to take the swing. The sun is actually out. Right now, the rain, the cloud, or in the morning session is off. The pitch is, I don't know cricket that much, but let me just guess. I think the pitch is no longer very wet. So it's kind of dry. You can actually hit it now. Forgive me if I have missed something here. But I'll open up now to the audience here. We have 6 minutes remaining and we can take some questions. Arvind, yes.
Can we have the mic, please? Arvind, sir.
Hello. Okay. So my question is about AI bubble only. It is not when it's gonna happen. It is if it happens. What could be the repercussion of it and how far it can go? So the sir, like sir said, it could be in the 1 to 3 years. Say it's all in the 1 to 5 years. If the global economy is currently ready for it, or could it be ready in the next 2-3 years, similar with Indian economy?
I think we got a sense that we are much better placed today than earlier, but if you want to field the question. The question is if it happens, if the apocalypse kind of sense that Nidal pointed out, that over the next 1 or 2 years things might go really wrong, are we well prepared for it?
Market will correct at some point in time. Markets they have to correct. So, and they will correct everywhere in the world. I suspect India will behave with much lower beta than it has in the past. So unlike in 2008, I don't know how many people in this room recall, India was the second worst performing stock market in the world that year. The worst was Russia in US dollar terms. I don't think we will have that status now. We will be much lower on the list. But correction at the bull market peak, of course, it will be ripe for a correction. What I don't know is whether the bull market peak has arrived or not. That I don't think has arrived, but we'll find out in time.
Thank you. Arvind?
So, my question is something more fundamental. Looking at the R&D levels of this country, tech companies in specific, there is one side of an argument that they aren't investing in R&D and the cash-rich companies are going for buybacks regularly. That's one debate. And you've got all kinds of people on the street saying they should be building the country's LLMs. Or is it a very calculated measure that let's not jump too much into building LLMs where we still don't know what's happening in the West? What is your take on that? Do we think that companies in our country are R&D heavy in general? Or relatively, where are we from, say, 2008?
It's a very fair question, by the way. I mean, if you go by the convex production function analogy, first mover advantage. But if you go by, let's say, automobiles or music industry, sometimes the profit pools eventually belong to people who did not come first. So how do you guys see it?
So when we met IT companies, their feedback was, I am using products and tools of companies like Oracle, SAP, and so many others. If I start making a competing products, there's a very good chance that my access to those products will disappear. It makes sense not to go for those kind of R&D investment. Second, today, credibility of Indian IT services is established. But not so long before in the past, they needed to show cash on balance sheet to give confidence that we will survive. That cash was needed to get more business and credibility. Albeit now we have crossed that phase. Third, it's not that we haven't created products. Infosys is world leader in Finacle. TCS runs exchange software. And forget that, we, the mutual fund industry, in '97, when I was working in Franklin Templeton, we created a product called Quantis. And it was created with the help of entire mutual fund industry coming together. That product gave competition to Charles River Trading System, which was the default program or default product in entire global asset management industry. When I joined Prudential ICICI Mutual Fund, I was told that we have to use Charles River Trading System. And I said, I'll be happy to do it, provided it can match the cost of Quantis and provided it can match the features of Quantis. Till such time I moved out of Prudential ICICI, they never asked me that again. Now, is today Quantis replacing Charles River Trading System? Answer is no. Because the company which bought that product, they couldn't invest into it. It could never scale up. Our entrepreneurs were comfortable making money in India rather than taking this product to the globe. It was single country, single currency product rather than multi-country, multi-currency product. So it's not that we don't have domain or we don't have coding experience. We can create a product as good at a much cheaper cost than global product. And I've given you 3 examples. Challenges, do we have the ecosystem to support our entrepreneurs? Today, when someone launches Indica, our expectation is that it should be like Mercedes-Benz. But if we accept first motor car as Indica, eventually Mercedes-Benz will come out of India.
Thank you.
Can I say
Please,
something?
please.
I think this debate is a very intense one, and we need to contextualize it. So first, I'll make a macro comment. So what people do is, they look at India's R&D expenditure, India as a country, percentage of GDP, compare it with China, compare it with the US, and say we are not doing anything. But you have to adjust this for per capita income. And the curve is not a straight line, which is, it doesn't go up, it's a non-linear curve. As you get richer, you can spend a lot more on research and development than you can when you are as poor as India is. Let's not forget, India's per capita income is $3,000, and we're comparing with countries at 20 and 80. It's not a fair comparison, it's not going to happen. When we get to 20, we'll see how much R&D we have. My belief is that our R&D will be as good as anybody in the world today at 20. So that's the first point. Second is, let's not deride the IT services companies by saying that they are not doing R&D. They should not be doing R&D. Their business is to provide services, and they are enormously successful. If there is one sector where we have beaten the Chinese hands down, it is in this sector. So let's recognize for what we have achieved there. And of course, there is an AI debate right now, but you must have all heard what Nandan has said. It's a challenge, and we are going to overcome this, and we're going to proceed further. So I think IT services, phenomenal what they have done. So we should not be thinking that they need to change their model. This is the only sector where we have beaten the Chinese hands down.
Thank you. I'm conscious that time is up, but I have a choice. I can either summarize the debate or entertain one more question. All right, please.
Thank you. So there is a lot of discussion on AI. So what AI runs on is basically data centers, and we have seen India give 20-year tax holiday for data centers. But in America, citizens are protesting when a company builds data centers in their locality, and they're protesting when they stop the data center building. So I want to know if data center sector is a net positive or net negative for India over the next 20 years.
Who wants to field the question?
See, as always, the answer is going to be, it depends, and it's going to be in between, and I'll tell you why. I think in this world, and I think Mark Carney's speech was very important, when the global policeman ceases to exist, everybody has to make a fortress around their world. So they're going to be around their home. So they're going to clearly be cases where for strategic national security concerns, you want to have your data centers, your data, you want to, right? And even though there's redundancy. But one has to be careful about going down that path for national security and resilience versus it being a growth model. And I'm saying this because of what's happened in Taiwan the last 12 months, right? And this is not fully appreciated. So Taiwan has been the biggest beneficiary of the AI boom in Asia. All the high-end chips, GPUs, servers that are in US data centers are made in Taiwan, right? Export growth is running at 40%. GDP growth, 9%. This is an economy that's potential growth is 3, is running at 9. Do you know what the government of Taiwan did in November? They announced unconditional universal cash transfers for the entire economy. Why? Because data centers and AI is so capital intensive that it created virtually no jobs. You had one small sector of the economy booming, strong export growth, strong GDP growth, no spillover at all to employment, no spillover to consumption.
Your classic Dutch disease.
Classic Dutch disease. Even without the Dutch disease assumes there's an exchange rate phenomena. Here, the sheer capital intensity meant you're only hiring machines and not workers. Malaysia, same thing. Malaysia's got this huge pipeline of data centers. Strong GDP growth, strong tech growth, strong export growth. Look at Malaysian employment and wages. So one has to be careful. Yes, of course we need data centers. Yes, of course we have to go down an AI path. But we have to be aware that AI is getting more and more capital intensive. For a country at our level of demography, where for the next 15 years we've got this demographic dividend, you also have to find sectors that are job creators. And I think that's the balance we need to be striking.
Thank you. Thank you, everybody. It's been great. Thank you to all my panelists. We looked at questions on the asymmetry of information for the global asset markets. We did touch upon several topics. We actually asked if the markets are going to fall. So I will not, and like our panelist just said that Chief Vital Statistics in asterisk and obliques, he has a fear that the sky is going to fall on our heads. So no such thing happened actually. And I think we've had the view I will take is, I promised I will not summarize, but I have to do it. You have to be in the game and you have to be right. That's the takeaway I have. Thank you. Thank you, everybody.
Thank you, sir. On behalf of the audience, I would also like to thank the panel for an enriching session and providing fresh perspectives like comparing macro stability and risk-taking through cricket analogies. Thank you for that deeply insightful discussion. We will now proceed with the felicitation. I would like to call upon stage Professor Arvind Sampath to present the souvenirs, please. Thank you to all the panelists here. I would now request for displaying the winners of the Slido questions for this round, please. So it's Alhad, Atharv Dikshit, and Suraj Khangde. I would request the winners to kindly join us on stage. I also request Dr. Patnaik to felicitate the winners, please. Yeah. I'd request everyone to be gathered back at the atrium so that we can move forward. We now arrive at the valedictory session, a fireside chat that brings today's conversations full circle. It is my honor to invite Shri Injeti Srinivas, Chairperson, National Stock Exchange of India, and former Chairperson, IFSCA. Shri Srinivas is a former IS officer of the 1983 batch with over 4 decades of experience in corporate regulation, financial services, and public policy. He served as Union Secretary, Ministry of Corporate Affairs, where he led key reforms in insolvency and company law, and later as the founding chairperson of the International Financial Services Centers Authority, helping establish India's first international financial regulator. He has also held senior roles as Union Sports Secretary and headed the National Pharmaceutical Pricing Authority. An alumnus of SRCC and the University of Strathclyde, he continues to contribute to corporate and regulatory governance through board and advisory roles. He is going to be in conversation with Dr. Lata Venkatesh, Executive Director, CNBC TV 18. Dr. Venkatesh is one of India's most respected business journalists, known for her incisive interviews and command over markets and macroeconomics. She has previously worked with the Economic Times and Dow Jones Newswires and has covered equities, currency, debt, and commodities across platforms. She holds degrees in economics and politics and also holds a doctoral degree in political science. Over to you, ma'am.
Hello. Thank you very much, IIMK and NSE for inviting me. I can't tell you what a treat it is to have Mr. Injeti Srinivas as my guest, because in my nearly 3 decades of journalism, if there is one person I regretted not being able to interview, it was Mr. Injeti Srinivas. So it is a desire of many years that you all have helped fill. So thank you very much. And I'll tell you why, Mr. Injeti Srinivas, because some of the most important things that happened in the corporate world, in the financial world, and in the Indian economy were triggered when Mr. Srinivas was the Secretary of the Ministry of Corporate Affairs. Some very seminal developments, like, very obviously, the Bankruptcy Code, and perhaps something which is lesser known, the MCA 21, that the database that he formed of Indian corporates, both unleashed some very long-standing changes in corporate behavior. And I'm going to start there, Mr. Srinivas. You must have triggered many things, but as a business journalist, these were 2 things that we thought were seminal. The Bombay view of Delhi, so to speak. First, an omnibus question. I will have many sub-questions on the Bankruptcy Code, on the MCA 21. But from your vantage point of 2015 to today, in the past 10 years, what would you say are the most seminal achievements of the Indian corporate and financial sector?
Yeah, so I feel that... Okay, so I feel that, you know, the entire process actually started after the 1991 crisis. There is no directional change. So we are moving in the same direction. But in terms of the depth and the impact, you know, there has been that
inflection point, you would say?
Inflection point, I can say. And if you say the deepest reform, in my assessment, has been the Insolvency and Bankruptcy Code, because it has had a huge impact in the behavior of both debtors and creditors. And even if we evaluate its performance, I think it has been far better than its predecessors. So whether it's SURFACE or DRT or whatever else, SICA. I think the second major area, because I have my perspectively more from the corporate affairs angle, so I may not be able to cut across the whole breadth of it. The second has been, I think, corporate governance. Corporate governance has been an area of focus, and there are 2 important players, to ensure high level of governance. One is the independent director, who is a very important player in the boardroom. And the second is the statutory auditor, who does the audit. So on both these fronts, there have been a lot of measures to see that the corporate governance improves. And so that has been another very major area. Another important point is ease of doing business. I think there's been a huge focus on ease of doing business and a firm belief that promoting ease of doing business will promote compliance.
Okay.
Yeah.
Okay, I'll come to the more sub-questions. But let me start with bankruptcy code itself. Clearly, from a Bombay angle, at that time, day after day, week after week, month after month, we were reporting on bad loans. I mean, it was not funny. Storied groups, the JP Group or the Amrapali Group, Lanco, GVK, you name it. I mean, large groups with 30,000 crore. Why? Even the ADAG Group. So many of them had been declared NPA. Now, the bankruptcy code was brought in to resolve it. Now, when we look back, we still feel that we should do faster in terms of resolution. But give me your view on what do you think are the seminal achievements of the bankruptcy code?
Yeah, so the most important thing is that the control shifted from the debtor to the creditor. So there was, no option to the debtor but to move towards some settlement, which hitherto was not the case. As one very senior banker had told me, the biggest change of IBC was that before IBC, the bank was after the promoters to sort of find a resolution, and after IBC, it was the reverse. So that was the major change.
Just to tell you how bankers spoke to us, and this is a common theme across countries. If you owe me 1,000 rupees, then you need me. But if I lend you 10,000 crores, then I need you.
Yeah.
I'm chasing you. So that's what happened in India. It was the bank which was dependent on the debtor and not the other way around.
Yeah.
So you think IBC could correct it?
So let's see how some of the major amendments took place. The IBC came into effect 2016-17, and the first major ordinance was Section 29A. Okay? If some of you are familiar with Section...
You need to explain.
Yeah, if you are familiar with Section 29A, it was that the promoter should not be gaming the system and buying back the assets at a deeply discounted rate. So that was the requirement.
Everyone but the promoter should have a right to buy.
Even the promoter could have the right to buy. So Section 29A basically said that, among others, if you are an undischarged insolvent or you're having conviction and all, those are disqualifications. But if you have an NPA beyond 1 year, you are also disqualified unless you settle it before you present your resolution plan. So the idea was that it's not a total debarment, but a conditional permission for the promoter to get into this. But at the same time, another amendment was carried out, that is Section 12A, which said that once a CIRP, a corporate insolvency resolution proposal is admitted, you can withdraw it with the permission of the creditors, committee of creditors. That means another window of opportunity is given to the promoters to resolve it to the satisfaction of the bankers. So I think it has been a act, a code which continuously we looked at issues and tried to address those issues. And another very major issue is that of, many of these insolvent companies were found to have committed fraud also. And what you call the technical term avoidance transactions. That means basically asset stripping and fraudulent transactions, siphoning of money. So in our Indian system and IBC, you're selling the asset as a going concern. Now, if I'm selling something as a going concern and a company is a legal person and the company carries that stigma and exposes itself to the investigation agencies, then why should I buy it and buy that problem? So looking at that, the IBC again tried to address it by carrying out another amendment, Section 32A, which basically said that all the offenses prior to the resolution plan, the acquirer will not be responsible. The old promoters came.
They are
here,
ring-fenced from the old criminal
so they
cases.
are ring-fenced. This is very important. See, without these measures, it was not possible that you will succeed.
You know, the constant criticism when people look back is that it still takes 650 days for a resolution on an average, or at least at its worst. The other criticism is, what has been the recovery? The recovery has been about 35–40%. Not as good as we wanted.
So,
what would your reply be?
So, I had the opportunity to review at least the top 100 insolvency cases in terms of the outstanding, in terms of the default. And we found that by the time they came to the IBC, there was a lot of value destruction already. So you cannot recover more than what is left. So that's my answer. It's not that you could not resolve. Had it come in a timely manner, you could resolve. I think that is one of the reasons. If you see now, if you look at the NPA, you see at that time over 30 lakh crore plus was locked in. Now banks are in a healthy position because of the behavioral change also. The creditor also is, seeing that they don't give, excessive lending, they don't expose themselves, and the borrowers also realize that if they're not sustainable, they'll lose the assets.
No, oh, absolutely. I can give you some numbers for it. We are historic low. I mean, not just 10-year or 20-year low. We are at a historic low as far as NPAs are concerned.
Yeah.
It is less than 2.6%. And perhaps for the first time, the NPAs of public sector banks is lower than that of private sector banks. So clearly those are big achievements, not directly, but indirectly.
Indirectly.
It's put the fear of God in the minds of promoters. The other issue that I want to hear from you, what were the problems you faced? I mean, I know about Bombay corporate lawyers speaking, telling me that they would come to you and say, appoint more tribunals. There is a pileup of cases because there are not enough NCLTs or NCLATs. What would your reply be? What was the thought process in terms of the bandwidth of appointing NCLTs?
So, we had about 60 members at that time, and there was a proposal to raise it to 100-member strength. But I still remember I worked with 3 Chief Justices, and we had interviewed more than 2,000 people. Getting the right people also was a big issue, because there are many successful people, but it did not attract those people because they found that they will have to sacrifice so much, or if there were some
best
people,
brains don't come for public service.
They don't come public service, and sometimes even if they want to come, issues of conflict of interest and other complications, stood in the way. So I think. The other issue is that IBC should not be the first resort. It should be the last resort. So I don't think, that's a very fair argument. So it's fine. And again, let me also emphasize that if you remember those World Bank rankings, the improvement in insolvency performance raised our ranks quite a bit. So today, it takes about 600–700 days for a case to be resolved, but that's far better than the 3.5 years it used to take prior to this.
That's true. No, that's absolutely true. And the fact that many of the cases are not coming because they get resolved even before they enter the
Pre-admissions.
Yes.
You're right.
Yeah, no, actually many things. The Reserve Bank also put in the CRILIC database, where the moment you default, the case, the name is entered. Any default over 5 crore is already entered into the system. So it doesn't balloon. Others are not giving, you're not loan shopping. So many advantages were there because of the
there is a figure, I'm not too sure, I read somewhere. So far since inception, 4 lakh crore has been recovered, and 14.4 lakh crore has been settled before admission.
There you have the numbers. Clearly, those have been the achievements of the last 10 years. Let me come to the other part for which we remember you, the MCA 21. Can you tell us what made you, for those of you who are new to that term, the MCA 21 is the electronic filing of P&Ls and balance sheets by corporates. Until then, you used to go to the Ministry of Corporate Affairs and file it physically. But starting from 2006, the electronic filing started, and by the time we came to 2013, we had a very good body of data of electronic filing, which was later adopted even for calculating GDP, because it was a ready-made and easy access to the data. But I'll come to the GDP part. You tell me, what you see are the advantages of MCA 21.
Yeah. So, as you said rightly, from 2006 onwards, this process was there. So earlier it was the Companies Act 1956 and then 2013. There has been a lot of refinement. And now I think it is among the best in the world in that sense. For example, if you want to incorporate a company, there is a combined form wherein you not only incorporate a company, but you also get your DINs, that means your directors, get registered. You get your TAN and PAN, you open your bank account, and under the labor codes also you get the registrations. So it's all in one. So, it in a way helps
ease of doing business.
Second is, the Companies Act basically regulates how companies operate, and there are a lot of reporting obligations. Now, you have 1.5 million companies. Now, there are almost 100 forms. That means flowing out of those sections, 100 forms are there for reporting. These are all structured. You don't have to, most of them will have drop-down boxes and all. And once you have this online reporting, then the data analytics, the enforcement of the Companies Act, e-adjudication, all this becomes easy. So now you have the e-adjudication also. You have, the ultimate significant beneficial ownership, those disclosures, how much deposits are there, and this is all public information. Most of the information public can access. Who are the directors in a company? What has been its annual reports or financial statements? Most of these things you can obtain. So I think in terms of, dealing with even information asymmetry, this has been a major initiative.
I agree with you. So we, from the press, very often are able to access the ROC, the Registrar of Companies, who is able to go through the data filed in the MCA, and we are able to access. So clearly that information asymmetry, which is the theme of this conference, that has gotten resolved because of the MCA. Now I'll tell you where the criticism comes. The MOSPI, the Ministry of Statistics, tried to use that as a quick way to get GDP. Because quarterly GDP is not easy. It is one number for the growth of the entire economy, and a lot of data is not available. Now, there the criticism has been, and I've noted it down because many of them gave it to me, the data gets outdated. There are a lot of untraceable, dormant, inactive companies which have not been weeded out. So comparability becomes a problem. That data had probably 1.5 lakh companies. Now you have probably 1.4 lakh companies or 1 lakh companies. These are the criticisms that come from the statisticians. What would you have to say?
Some of it could be valid, but I can tell about my experience. At that time, we had struck off 5 lakh shell companies. Okay. This database gives you the power of doing running the data analytics. Under the Act, if you don't commence business within 6 months, or if you don't report for 2 consecutive years, you can be struck off unless you give adequate justification. And therefore, we used to liberally use that because there is already a provision of acquiring dormant status. So if a company says for some reason they can't be active for a period of 3 to 5 years, they can acquire the dormant status. And therefore, you know that they are dormant and they're not doing anything hanky-panky. So if you don't acquire the dormant status and still you're dormant, you should actually be weeded out.
Yeah, that's right. No, actually, I would blame the statisticians. They looked for a shortcut to measure GDP because this was available. But the MCA was not construed to serve the purpose of GDP calculation. So I guess, this is what I would tell many people who would criticize the MCA 21 as not being an adequate database. It was not meant for GDP calculation. You tried to use it, you had problems. Okay, let me come to the other point for which we in Bombay thought, the Ministry of Corporate Affairs did extremely well, and that was in the ILNFS case. I don't know how many of you are aware, it was a huge infrastructure lending company, which when it went down because of NPAs, because it was not able to service loans, it created a domino effect. Because of that, many NBFCs, notably DHFL, were not getting money because, it was a domino effect. ILNFS didn't pay somebody and somebody didn't pay, other NBFCs. Now, can you take us through how you went through it? It was an extremely, massive case, and we thought that the Corporate Affairs Ministry did very well in resolving it. But can you take us through the process?
Yeah, so that was a very interesting case. ILFS was one of the largest companies with a balance sheet size of over 1,50,000 crore. It's a very large company. So what happened is that when we could realize that it is going bankrupt, there was a lot of worry in the government also that it will have the domino effect. So one wanted to sort of arrest it before things go out of hand. Now the problem was the complexity. This company had 305 subsidiaries, multi-layered, and it was present in several geographies, different parts of the world. Now IBC lacked two things. It even today lacks those two things. One is group insolvency framework. So how do you deal with an entire group? And the second is cross-border insolvency framework. How do you deal when you have a global footprint? So, and also, if you go to IBC, our fear was that suddenly the value may get destroyed, nobody can save it. So here is where I think we tried to experiment something, and we were lucky that it worked. You see, when the IBC was formed, prior to IBC, Companies Act had all the provisions for liquidation. When IBC was promulgated, those sections were removed, about 50 odd sections. 2-3 sections were left. Now, whether they were left by oversight or they were left intentionally, since I was not part of that team, I don't know. So when we were worried and just going through, we saw that section 230, 231 and all, there was some overlap. And because we represented public interest, I had to seek appointment with the chairman of NCLAT. Okay. I said, there's something which is absolutely of national interest and I have to bother you. So I went and explained him that, look, this is the situation. And we have no axe to grind, we have no agenda. But if it is going to IBC, it will get butchered. Number two, very technically speaking, I'll come to that later, IBC is not meant for financial institutions. FRDI was meant for financial institutions, but for some reason that was withdrawn. So I said, here there's a provision where we can have a scheme of arrangement and you can give directions. So if we can impose that moratorium through you and not trigger the IBC, then it will be better. And somehow, I think NCLT also followed that line, and we got a special dispensation for ILFS, where everywhere there was a moratorium, and then company by company, you could resolve. Here again, the problem is that once the company is in problem, then CBI had come, ED had come, SFIO had come. Now, no director was willing. I mean, suppose we ring up anybody. Of course, Uday Kotak was compelled to chair it. But nobody was willing. They said that, look, once we become director, then your Companies Act puts so many responsibilities on us. Then you will start questioning us. So it was a very, very difficult thing, where almost weekly meetings we used to have with ILFS, and everything used to be documented so that they derive so much of strength. And, ILFS, today I understand about 63,000 crore has been recovered.
Oh, yes.
So you were complaining that 35%, this was close to 55, 60%.
Yeah. And where it was extremely tricky because it's a finance company and not, a company like a steel company, like a Bhushan Steel, where there is a hard asset, where it is easier. you're addressing a bunch of students who are going to either public service or private service in course of time. And that is why I'm asking you this question. When you are handling a job like this, how do you get the trust of both the public at large, the corporate sector or the financial markets or the investor and the government? I mean, it's a very tricky combo. It is very easy for the financial sector or the Aam Janta to think that you are kind of a chamcha of the government. And it is very easy for the government to think that this man is not trustworthy, he may leak. How do you manage this very delicate balance?
No. So your question is on maintaining confidentiality or
as well
winning
as getting the confidence of the government.
So I'll give you an example. You just now mentioned Amarpali and JP and all those things. So home buyers were in deep trouble. Okay, their life's earnings was put into the home, and they were neither financial creditors nor operational creditors.
And I know the home buyers really struggled. Yeah.
Okay, so you have that dobi ka kuta na ghar ka na ghat ka. So that sort of situation kahin ka nahi tha. So now we said, how do we deal with this? So we had that insolvency law committee, which was a standing committee. We had RBI, banks, everybody, legal experts, everybody sitting, and we used to meet frequently. So the issue was, how do we resolve this problem? Because they are nowhere. So they can't even file with the resolution professional their demands. They can't even file. So ultimately, you see, when we discussed, naturally the expectation of the public is how our interest can be protected. Okay. Now, when you explain to the government that, look, definition of who's financial creditor, who's not creditor, ये सब तो हम ही लोगों ने किया ना. I mean, it's all some law, some rule, somewhere. Now, it is a fact that you, in a way, self-finance. Actually, what happens is, you are, as far as the person who's constructing firm is there, every 2 months or every quarter you are giving some money, then that is progressing.
Exactly, EMIs.
So what happens, under the accounting standards, so we went to the accounting standards, found a particular thing that in this sort of transaction, how will you treat a home buyer and other things, and said that he's a financial creditor. Home buyer is a financial creditor. Bankers vehemently opposed it. Okay. But he said, then we'll put your dissent in bold. No problem. But this is what we feel that it should be done. So what I'm saying is, if the intent is good, and if you have a transparent and consultative process, and what you talk makes sense, then both public confidence also will be restored, and government also will not, worry that, will you put them into some sort of trouble, or will it be something we can't then, come out of it. So I think this is a good example, and so many such examples I can cite.
Well, that's very good to hear, and I think all of you will be in positions where you have to balance public good with the fine points of the law. The law doesn't fit in, but interpretations are needed. So I'm going to ask you an out-of-syllabus question, and maybe even put you on the mat, as it were. What is the percentage of honest IAS officers?
No. See, let me, Lata, firstly, what is the definition of honest? Okay, this is one thing. Let us be very, very clear, because everybody...
You have my sympathy.
Everybody only think about financial integrity. But let me tell you, it goes much beyond it. And for a civil servant who is, exercising so much of power, it goes far beyond financial. People who are dishonest in terms of corruption, that is a disease. IAS is not immune from the disease. It is society-wide now, okay? Our former Prime Minister, I think Indira Gandhi, made some comment. I'll not repeat that. So I'll not get into that part. But what I would say is, a lot of criticism is there that, babus don't understand anything. I think if you are a babu for 100 days, you will realize what all a so-called babu goes through. And there are many upright people, okay? And that is why things are okay. And if everybody is, seen as a chamcha or is, amenable to anything, then there'll be chaos. So, aisa nahi hai. So,
no, I want to highlight the point you're making, that honesty may not be the most important quality you want.
No,
you want pragmatism. You can be very honest and actually block several
yeah,
things.
so what I would say is, honesty is necessary but not sufficient. So, it is a necessary requirement for any human being. For self-dignity, honesty is important. Why IAS officer? Everybody, you have to be honest if you are self-respecting, if you have your self-dignity, but that is not sufficient.
No, absolutely, I take your point.
I think the biggest thing is to take decision. That is the biggest challenge for any senior bureaucrat is, can you take decisions? Can you tell the top people, can you call a spade a spade? Can you say that, no, this may not be possible?
Now, I think this deserves a round of applause. What the former secretary and the chairman of NSE is telling us, it is much more important to take decisions than to hide behind the umbrella of honesty and actually not take decisions. Decisions will mean that you will be questioned. You may be dragged even to CBI after you have retired. So actually taking decisions is more important than, to simply hide behind and not think.
Just a small tip for any people, for people who are thinking they'll prepare for civil services and join bureaucracy or IAS or whatever it is. My thing was, whenever we took a decision, I, with my own hand, never used a PA. I always wrote why I'm overruling or why I am recommending this. 2 or 3 pages, handwritten, because you think and write. And I remember a case, there's no harm in disclosing. You see, at that time when Mr. Vajpayee's government was there, retail trade, there was a lot of, thinking retail trade, mom and pop stores will all disappear and all, and fair enough. But government in its wisdom had allowed cash and carry. So I remember a German company, I think Metro, had applied, and I was director FIPB, Foreign Investment Promotion Board. And we sort of analyzed it, and we said it is coming within the framework, and we permitted that particular case. 10 years later, that matter went to Supreme Court. And they said that these people were all, bought over or influenced or whatever they wanted to say. Supreme Court called for the file. And Supreme Court went through the notings and then dismissed that case. So what I'm trying to say is that it's all right. I mean, so long as you are meticulous, you document what you do, people will not use hindsight and say, nahi, ye tha. You are telling why you are taking a particular decision.
Absolutely. And I think these will come very handy for those of you who are over here and who will find yourself in positions where you're not always choosing between good and evil. You're choosing between evil and lesser evil. You're choosing between good and less good. And sometimes decisions will have, the second best decision will have to be taken because more people are impacted by the second best decision and fewer people are impacted by the best decision. This is the fact of life. And it's very nice when it comes from a person like you. Now let me come to the other office that you have handled and handled with distinction, the IFSCA, or what we know more fondly as the Gift City. Okay, so the big fear with Gift City is that will we be like Singapore and Hong Kong, or will we become like Cayman Islands? Do you think Gift City has delivered, that it is seen as favorable and not as a tax haven?
Okay. So first we'll have to understand, we'll have to compare apple with apple. So firstly, Singapore cannot be compared. It's a city-state. This is a continental-sized country. And Gift is a country within a country conceptually. So when we did Gift, it was like onboarding offshore jurisdiction within India. So that was the whole purpose of Gift. Now, we have one country, one system. We don't have one country, two systems. So except FEMA, which treats Gift as a foreign jurisdiction, jurisdiction outside India, all other acts apply to gift. ये तो फर्स्ट पॉइंट है. तो बर्मुडा और ये सब, आई मीन सॉरी, आई शुड नेम एनी कंट्री, बट नहीं बन सकता है. आई मीन ऑफशोर फाइनेंशियल सेंटर, टैक्स हेवन नहीं बन सकता है. इट कैन नॉट. The other thing is that everything what you have to do in gift has been hard coded. Okay? So what is permissible, what is not permissible, all that is very clear. Most importantly, gift makes sense because of the hinterland, because of the Indian economy. Okay? So if I take you back to 2007, by coincidence, 2007 was when the present Prime Minister, as Chief Minister, launched Gift City.
He grabbed it from Percy Mistry.
Okay? So to that extent, it's like a visionary. You know, you've seen some report coming and you've created Gujarat International Finance Tech City.
Yes.
Okay. So 2007, and it took, and it's 2026 now, 20 years it has taken. 2015, the IFSC was made. 2020, the IFSCA was set up. So 2015 to 2020, it was not an international jurisdiction. It was a national jurisdiction, but with some special dispensation, and the domestic regulators were regulating it. Okay. Today, in 2020, when IFSC was set up, that was COVID. So that COVID's 2 years were used to understand the regulations, best-in-class regulations all over the world, and 30 regulations were made, 15 frameworks were made, because IFSCA is empowered under 15 statutes. So under the RBI Act, under the SEBI Act, under SCRA, all those powers for this jurisdiction vest in IFSCA. So I don't think that fear stands. Now let us see, how do I substantiate it? What are the sectors that have really grown in gift? I think the most prominent is the banking sector. You have close to 40 banks, 20 foreign banks. Foreign banks from US, from UK, from Europe, from Middle East, from all places they have come. Today the combined balance sheet is 100 billion plus. What is this? It is having two components. One is ECB, external commercial borrowings, and the second is trade financing. In a way, it has democratized trade financing, because a small fellow cannot go internationally to London or something, and so the trade financing part also has been democratized. Even mostly big ticket fellows were getting support, so that has been democratized. And ECB, a bank like, let us say, I'll give you an illustration. HSBC has been in India for 150 years. They have some balance sheet here. I think it's 20 billion plus. In 1.5 years, they had a 5 billion balance sheet in gift.
In gift.
Okay. So that ability to scale up MUFG, it's just a Japanese bank came 1 year back, I think, or 2 years back, whatever. They also have crossed that 5 billion. So I think that's one area. Second area is funds. Now you said Mauritius and Cayman Islands and Isle of Man, all these places. Most of the Indian fund managers have now set up all new funds in gift.
Yes, they have.
And some have migrated from offshore also to the gift. So today you have more than 250 fund management entities and more than 350 funds with a committed corpus of 80 billion. So, oh, sorry. With a committed corpus of about 80 billion. Another one. Bullion. So I'm just telling you, where is the tax haven? Okay. Bullion exchange. We are the largest consumer
of bullion,
of gold, and but we don't dictate the price of gold. No. Huh? London neither consumes nor produces, but they dictate the price of gold. Now, for us to become
center to recognize.
Center, 25% of the global production we consume. 1,000 tons plus. So the bullion exchange has been a setup in GIFT. At first stage, the idea was we'll not do trading, but bullion will be, that means sourcing integrity, standardization, all that will be ensured. Bullion will come in. And that bullion can be even transmitted. That is, the bullion depository receipt can be converted to a electronic gold receipt. So you can become a bridge, a pass-through, a bridge. So that's gold. Aircraft leasing. We are the third largest aviation country in the world. We are importing all our aircraft from Ireland. I mean, leasing comes through Ireland. And our payout is almost 5 billion to 7 billion a year. Now, I won't say it's shifted because ecosystems should shift. It takes time for ecosystems to shift. But just the other day, a Tata guy who's in Air India was talking to me, and he said that, we have not done lease in, lease out. We have done the complete thing in GIFT. So, like that, there are several areas. Now, the most important. Earlier, the challenge was internal acceptability, whether all the domestic regulators also accept that you are a foreign jurisdiction. Very difficult to accept that you are a foreign jurisdiction, or you are an international regulator, 4-in-1, unified. Second is foreigners. How will they build their trust and confidence? They were always worried, will it continue? Will it continue?
That's true.
Will it be able to sustain itself? I think that is now behind. So those two very major challenges have sort of...
the hope is that if the bullet train, which starts about less than a kilometer from here, if it comes up, then perhaps we are going to see an exponential growth.
Exponential growth.
There is still that physical distance.
No, you're very right. Because that talent...
mental distance, which perhaps will be bridged. Actually, I'm running out of time, so I'm going to ask you the question that I wanted to begin actually. Do you think we have over-succeeded in equities and under-succeeded in debt? And do you think tax is to some extent to blame? I mean, banks are worried that, the debt market in other countries, when deposits decline and people are investing elsewhere, banks are able to churn through securitization, which has not happened for them over here. Government is worried that there are not enough buyers of fixed income in India. We should be worried. We have over-succeeded in equities. Any thoughts?
No. So I think both are important. What is important is the right balance between the two. You see, banks had no competition till recently. Now banks are getting a stiff competition. Household savings, financialization of household savings, now you see that is one thing which is happening. Savings are coming down. That's worrisome. But within whatever household savings, 18-19% savings you are having now, you see that the financialization of that, though even now real estate and gold takes away a lot, is now 11% or something. It has potential to grow.
The gross financial savings are there. It is net that has come down because of high liabilities.
Yeah, you're right. Net has come down. But ultimately, net is important. Yes. So I would say that the corporate debt, we are 50% of the bank outstanding. Yes. Today, if you see that's 100 billion, this is 100 lakh crore, this is 50 lakh crore. Now, this has the potential to double. I think that must be done, but you may have to have measures that MSMEs also can raise, risk pricing, credit enhancement tools, etc. will have to be there. So I think it's fine.
That ecosystem has not come, and it is one of my big worries, probably because I cut my teeth as a fixed income reporter first and then as an equities reporter. And my big regret is that probably debt is becoming a stepchild in the current tax system.
Oh, you meant, no, but debt means I was looking at...
I meant the entire debt market. It's kind of not progressed. If you look at debt mutual funds, for instance, debt mutual funds, no, but, the corpus was always higher than equity. But after the 2022 capital gains, indexation gone for debt mutual funds, now debt mutual funds have stultified and equity is just taken off. We may live to regret it, is my fear. I just wanted your thoughts on it.
No, I think it's not. There's no panic button yet. I think it'll balance. Banks have had an easy time. Now they'll have a little tougher time, and I think they'll find their own way to deal with this.
To work out of it. Okay, actually, I had more questions, but I've been warned time's up, and it is time for the audience. The chairman is here to answer any questions you want. I think everyone wants to go home. Okay, sure, Titaka.
Sir, I'm going to ask a very broad question. When I was a student, we had 180 universities. Today we have 1,200 universities, 45,000 colleges. Our primary enrollment numbers are 90+%. But by the time we come to secondary, tertiary, the number falls to around 28%. About one of our targets is in the new education policy is to at least have a higher tertiary education. In this information age, we find that most Indians aren't, for want of a better word, educated. How do you see, sir? You are in government for decades. How can we increase the amount of human capital in this economy? We keep talking about a demographic dividend. In this age, if we are not well educated, and I'm not talking about this cohort here, I'm talking about the whole of India, sir. How is it that we can lift our levels higher, sir?
No, but that's a very debatable point also. I think what should be of concern is the quality of education.
I agree.
In absolute numbers, things are going up and all. Of course, if you go to US and other developed countries also, in fact, in our country, people would have done post-graduation and they could be in jobs where you don't need to be a postgraduate. No. Okay? So it's not exactly that. It's not necessary that, see, I think vocational education has to be given a lot of importance. We can't have an elitist view on education. So that entire framework, a lot of people in developed countries, you find that after school they've just gone into vocational and then they get into some job and they're earning their livelihood. So it's not necessary, and then quality of education is the matter of concern. You're acquiring a degree, but are you acquiring knowledge? So that right from school, that problem is there. That, you are, going to school or going to college, but are you actually getting educated? So that education system will have to answer that. When we were, in school or college, our syllabus was limited, but we had to understand the, foundational concepts and everything, but you were not flooded with so much information you should learn. So I think education is becoming more information oriented and not. So वो एक बहुत general है, मुश्किल है to give an answer. I think we have this democratic dividend. There is fire in the stomach of the youngsters, and they're doing well. They're confident. What you need is to be confident that you can do. It's fine.
So I think we can take one more.
Yeah.
Madam, can we take one more question?
Sure, ma'am. Ma'am, actually, you'll have to take a couple of them.
Hello. Regarding the education, there is a difference between the foreign universities and Indian universities. Whenever you open a university or college in India, it has to be under non-profit organization. Now, if it is a non-profit organization, no bank will invest in it and no investor will invest in it. So, who can open a education or college? Only the person has a black money. They only can open a college because it is a non-profit organization. Bank does not invest in it, and investor does not invest in it.
May I use the power of my chair and not get this debate take away? We have him for something else. And while both of you are raising very legitimate questions.
He talk about quality of education. Yeah. The same Indian people do lot of good research in American universities, but they do not hear. Because
we will discuss this over coffee, sir.
That's
positively.
A different
I'm just
topic.
saying, let us keep this to financial corporate matters because we have an expert on finance and corporate over here. And if If you all don't ask finance questions, I'm going to ask a finance question. No offense meant. I'm just saying I'm bringing it back to the topic.
Hi, good evening. My question is not exactly from the finance side of things, but somewhere related to that matter. So we've seen that there is the problem of brain drain in India. And recently, because of taxes and other amenities, the high bracket of taxes that most of people in India 1, as we say, are facing, people in their mid-30s or late 20s are planning to leave the country to shift to places like Dubai or Singapore, where they get a bit more relief on taxes and get a lot more amenities so that they get to live a better quality of life. As someone who's taken so many initiatives in the government, do you think there is anything that we can do as of now to resolve this problem so that more people are retained in this country and gradually the tax slabs can be brought down a little lower for the upper income brackets as well?
Finance minister is in Mumbai today. She is better equipped to answer this, and she has the competence to answer. But see, I think, you know, if you look at the macro level, the reverse thing is happening now. A lot of people in early days and maybe until some years back were going abroad, but a lot of people are getting disillusioned with, you know, going out and are looking for opportunities in the country. So Abhi, it's a mix. You see, in life, it's a mix. What are your priorities are the issues.
I think we don't have adequate data on the comeback.
A lot of people are coming back also.
Details
and
as well.
you see, Dubai has no tax. You can't create those situations. But many things you get in India, in a sense, in terms of emotional support and other things, you won't get in Dubai. So you will have to measure what is your happiness index. If it's only the green note, well, it's fine. We can't match that.
Well, I'm going to steal one more question because it's finance, NSE, IFSC, and corporate affairs. So it's something I couldn't fit in the 45 minutes given to me. Are you worried about this extraordinary fascination that Indian traders have with derivatives? The government has come with a lot of steps. You know, SEBI increased the minimum lot. The government has increased the STT on FNO trades. And Reserve Bank just recently increased or rather prevented banks from
collaterals and
collateral, to give trade for prop trading.
Yeah.
Is this a worry?
So
of a very skewed development of equity markets?
I think we'll have to take a very overarching view of this because sometimes things may get exaggerated. So to put it in perspective, what I would say is derivatives is very crucial for the equity market, for the capital market, because it helps, provides liquidity, it enables better price discovery, it also provides the opportunities to hedge, and it also gives an entity like NSE, to build robust technology which can handle, millions of transactions and all those things. Now, the peculiarity of India is our exchange is a retail exchange.
Yes.
We are having 12 or 13 crore retail investors, 3-4 crore, maybe 2-3 crore active, but otherwise such a large
14 crore actually, unique investor IDs,
investors,
SEBI data.
14 crore, 21 crore demat accounts. So all this is there. Now, there are already some eligibility criteria. Now, how much of the volume and how much of the value is being contributed by that segment? If you look at that, say 10 lakh or below per month trading volume, then firstly, out of the 14 crore, less than 3% are into F&O, less than 3%. Those 3% should be educated. You should do investor awareness. This is not for a retail investor. It is for institutional investors and all.
HFTs maybe.
Second is the eligibility criteria also can be further looked at. Okay. So there may be some issues, short tenor and all those issues could be there. That the regulator is looking at. So anyway, government has taken some action, etc. So I will not comment, but I will say there's nothing to worry. It has to be handled so that, the downside should be contained And we have the unique position. That's fine. We need not be worried about it.
Fair point. It's not taking us down. It is just creating losses for a set of people who have been repeatedly told by SEBI that you are losing money. Now it is for them to
that
wake
set
up.
of people are less than 3% of the total retail investors, and their contribution to the value is less than 2%.
That's true. Fair point. So we're discussing a minor problem here. I take your point.
No, I mean, it's an emotive issue. Public interest and all those things raise a lot of debate. It can be handled, and it is being handled.
Certainly. Certainly. Yes, questions on corporate finance. Can we take one more, ma'am?
Sure.
Yeah. Allowed. Yes, please go ahead.
Your mic isn't on, please.
Hello. So my question directly isn't on corporates.
Closer, closer.
Okay. So my question isn't directly on corporates and finance, but how do we make ESG and sustainability a part of India's growth story without it feeling like just another compliance task for companies?
No, come again, please.
Yeah, that is a very important question. I think this business responsibility and sustainability reporting, that is an initiative taken by SEBI, where the top 1,000 companies in terms of market cap are mandatorily required to submit information, non-financial information on ESG sustainability. Now, the issue is that we need to go beyond sort of tick box compliance to actual effective implementation of this. When will you achieve net zero, etc. It is a change of mindset. It is again a behavioral change. We discussed about a behavioral change. Companies Act 166 says the fiduciary responsibilities of a director nowhere else in the world. It says ESG also is a responsibility. It's 1, 2, 3, 4, 5. So every director, there are 30 lakh directors in this country. Every director also should ensure that the company is responsible. It conducts business responsibly. Okay. So I would only say that it's a question of not a checklist compliance. It's a question of mindset being changed. And we are moving in that direction perhaps. And more society will compel. If society gives premium to ESG, company will give premium to ESG. If society is not bothered about, good practices and all, suppose I buy gold, I say, मेरे को क्या फर्क पड़ता है? कहाँ से ये sourcing integrity है, अफ्रीका से आया है, कुछ आया है, I am not bothered. तो फिर jeweler has no issue. Why should he? But if you say that unless you have this certification that it has met all those sourcing integrity and all those requirements, I will not buy. Then they will respond. So it's a two-way process. It is society and it is the company.
Fair point. Thank you very much, Mr. Srinivas, for an extremely wide-ranging conversation. You have educated us about what an IAS officer goes through and what people, tomorrow's decision makers, will face. That taking decisions is more important than hiding behind the umbrella of honesty and shirking your responsibility. Also, the behavioral change that the Bankruptcy Act has engendered, and the fact that we don't have as many cases, we don't have as many NPAs is more important than the number of days it takes to resolve. Cases are not even coming up for resolution. That itself is a very big achievement. Thank you very much. And finally, for even connecting education and sustainability, I think if you are educated in sustainability, I think the problem will be resolved. To wind up what was said. Thank you very much.
Thank you both for this far-ranging talk. I would like to now invite Shri Shailesh Pathak, Senior Advisor, National Stock Exchange, to present the mementos, please.
Yeah. No.
formally conclude this conference, I would like to invite Dr. Tirthankar Patnaik, Chief Economist, NSE, to deliver the vote of thanks, please.
Ladies and gentlemen, it's been a very interesting day. As we draw the curtains to the IIMK-NSE third annual conference on macroeconomics, banking and finance, it's my privilege to express our gratitude on behalf of the National Stock Exchange to everyone who has contributed to making this conference a meaningful and intellectually enriching platform. Throughout the day, we've engaged with a wide range of themes, from information asymmetry, corporate governance, to inflation targeting, national statistics, digital transformation, personal data protection, and developments in global markets, not to leave out the developments in Gift City and how the IBC came about and the various challenges that we saw and how they were bested. The depth and diversity, frankly, of perspectives shared across sessions reflect the value of collaboration between academia, policymakers, market participants, industry leaders, and media. We're deeply grateful to all our distinguished speakers and moderators who generously shared their expertise and insights. Your contributions have elevated the quality of discourse and advanced understanding of the many complex issues that we face today in markets and public policy. I'd like to extend our special thanks to Sri Amarjeet Singh, whole-time member, SEBI, for inaugurating the conference in the morning with his keynote address, to Sri Injati Srinivas and Dr. Lata Venkatesh for the engaging valedictory conversation on India's evolving economic and financial landscape, to put it generally. Our sincere thanks to Sri Ashish Kumar Chauhan for his excellent speech in the morning, looking at the information asymmetry and the asymmetry in power. Sincere appreciation to IIM Kozhikode, particularly Professor Midul Sagar, my partner in crime, and the URUPPIKA team for their academic leadership and partnership. My thanks to our colleagues at NSE, EPR, corporate communications, and so forth for their meticulous planning and execution, and to our media representatives for their valued and continued engagement. Finally, to all our participants, both here at BKC and both that joined virtually, thank you for your active involvement. We are very pleased to have over 600 participants engaging with the conference, both in person and virtually. Conferences such as these derive their true value from sustained dialogue, rigorous debate, and continued inquiry. We hope the discussions today contribute meaningfully to research, policy thinking, and market practice in the months ahead. Thank you, guys. Thank you once again, and we look forward to welcoming you at a future edition. I suppose there's food inside, please.
We now invite you to join us for high tea. Hope you have a wonderful evening ahead. Thank you.